Hey, fools, and hey, YouTubers as well. I'm Jason Hall, Motley Fool contributor, joined by fellow Motley Fool contributor Brian Orelli to Fool24. We're here to answer your questions. Brian, how are you, friend?
I'm doing good.
Good, good. I'm excited to have this hour. This is going to be an Ask Us Anything hour. Brian Orelli, for those of you that don't know, is a biotech and pharmaceuticals expert. He is one of the smartest people in whatever room he's in. If you have questions about pharma, biotech, stocks, get those into us. I know a little bit about a lot of companies and a lot about a few companies. So please ask us the questions that you want. We'll do our best to answer. How do you ask those questions? Go to slido.com. The event code is Fool24. So whether you're on YouTube or you're a Motley Fool member watching us through the Motley Fool live stream, again, same way you get the questions to us. Go slido.com. The event code is Fool24. Always want to remind all of our viewers, lots of expertise on Motley Fool live streams. We know a lot of things and we can give our insights and opinions. But remember, this is for educational purposes only. This is not individual investing advice. For a million reasons, you would not want to take individual investing advice from some people on the internet. But we want to make it clear that we are not here to provide personalized or individual investing advice. All right, Brian, you want to kick us off? I know there were some things going on out there in pharma world that you wanted to talk about.
Yeah, it's like Oprah Winfrey does obesity drugs. You get an obesity drug, you get an obesity drug. So the latest one is ABBV. As far as I know, ABBV did not have any obesity drugs before today or before this week. And then yesterday, they licensed a phase 1 obesity drug from Gubra, G-U-B-R-A. It's a biotech out of Denmark. It's traded on the Copenhagen exchange, I believe. And so the drug still goes by its code name GUB014295. From now on, just be called the drug.
Drug.
So it's in phase 1 development. They're doing a single dose. They did a single dose part of the study where they just give patients the drug once and that's it, and then they just followed them, and then now they're working on doing a multi ascending dose set study where they start with one dose and move up to higher doses, but giving the same patient multiple doses. But in the single dose study, they looked at 6 weeks, and the patients at the higher doses they got one dose but they so they tested multiple doses on, but only one patient. No, only patients only got one dose. So either the low dose or the middle dose or the high dose. And so the higher doses, the weight loss was 3% of their weight in 6 weeks, compared to a gaining of 1% for patients who got the placebo. So that sounds okay. I mean, it's hard to change that into 20% weight loss for drugs that have multiple doses, so we just don't know what the actual readout is going to be here. But AbbVie's paying up for it. They paid $350 million up front, and then the Gubra is eligible for up to $1.875 billion in development, commercial, and sales milestone payments. Now, presumably, most of those are going to be on the commercial and sales side of it. Let's say probably more than 3/4, possibly 80% of that 1.875 billion will be in the latter stages of the partnership. So they're only going to pay if it actually works, right? Of that 1.875 billion, but even 350 million up front for a phase 1 for a drug that's only gone through half of a phase 1 study, I think is quite a bit of an increase in it's quite a bit of a endorsement of the potential of biotech of obesity drugs, and Gubra's potentially specifically. So this is an amylin drug, so it's not a GLP-1 drug, but could probably be used in combination with the GLP-1s to increase efficacy or potentially lower the level that you need for the GLP-1s, which tend to have some side effects. So if
Right.
amylin drug doesn't have the side effects, maybe it gets used in combination with low doses of GLP-1, and therefore, you don't have the side effects of the GLP-1 and you get the benefits of the amylin. I'm not sure if amylin drugs are going to get used all by themselves, but we'll have to wait and see. This is, I think, a long-acting amylin drug, so there's been amylin drugs on the market that have been used for diabetes, but not for obesity, because they just haven't ever shown, a ability to lower weight. But I think that there's potential with a long-acting one, especially in combination with a GLP-1 to do that.
Yeah, that's one of the things that I'm really interested to see. My wife works in pharma and biotech as well, and seeing these combinations of different treatments to really continue to focus and optimize for different patients with different needs and reactions to different levels of side effects and that sort of thing. The next few years is going to be really interesting in this space. I want to just take a moment here, Brian. Natasha, I just sent a screen share because the past couple of days have been pretty tough. So this is today, and it's interesting because we have seen kind of a pre-lunch, a little bit of a recovery from the market. But if we just back it up over the past couple of days, it's been a bit tough. It has been a bit tough. And if we look past over the past few months, we're certainly off a lot of highs for the market broadly, tech stocks in particular. But here more recently, we've started to see with some of the retailers reporting, we talked about it the prior hour, Brian, with Target and Best Buy, that both tend to lean more towards discretionary spenders. Target has a lot of staples that it sells as well, but a lot of its profit comes from discretionary goods, versus like an O'Reilly Auto Parts that just reported earnings, and the stock's basically flat today, where the vast majority of what they sell is somebody has a broken car and they need to fix that car so they can get to work tomorrow. It definitely, the market looking forward has a lot of concerns about the economy, and it's broadly for the pharmaceutical industry, it's not particularly driven by the economy. There's some impact, right? People with health insurance versus not health insurance, depending on the job market. And there's some impacts around the edges to demand. But investors right now are concerned about this downturn with stocks and concerned about the economy and the impact of the trade environments between the U.S. and a lot of its trade partners. And what I wanted to talk about just briefly, we've had a few questions that have come in about it, is something that a few people have asked about, the idea of having capital ready to put to work. So we talked about that a little bit at the end of the last hour, but I want to talk about that for our YouTube audience as well. So the idea of not just keeping cash on the sidelines, 5% of your portfolio, 10, whatever amount, gives you some money to put to work opportunistically using index funds, total market index funds, to be able to do it. Here's an interesting one that I thought was interesting. This is kind of stepping up to the advanced level of investing, but Tax Accountant talked about using options as a way during market downturns, particularly if we think it could be protracted, to potentially get an attractive entry position into a stock at some point in the future. If the downturn doesn't persist and the business does fine, it could be a way to generate income. So using something like cash secured puts, selling a put, what that means is somebody else is giving me money, but I'm giving them the ability to make me buy a stock from them in the future at a certain price. The downside risk of that as an investor is if a stock falls a lot and falls below that strike price that they can make me buy the stock at, I may have to buy a stock for more than it trades for at that point, right? So there's risk there. The upside is I get income, and if the stock goes ballistic, I missed out on not buying it today, but I did get some income during a period where there was some downturn market volatility. So there's ways, if you spend some time, and the Motley Fool has an option service that's a pretty compelling and has a high rate of profitable investments. The percentage of those trades that Jim Mueller and his team do have been really profitable. So there are ways that you can use things like options in volatile markets on top of holding a little bit of cash. So we've got a couple questions that have come in for you here. Let's start with Zaxafool, came in about 6 minutes ago. Do you follow Evolus, ticker EOLS?
I
Brian?
don't. I don't.
I'm not familiar with the company at all. So Zaxafool, I apologize for that. I do know you're familiar with Twist Bioscience.
Yes. Yeah. Twist Bioscience. I like Twist Bioscience's ticker is TWST. So that company is they developed a way to make DNA very cheaply. So scientists use DNA to do research experiments to express proteins, that sort of thing. And the company developed a way to make basically small amounts of DNA. So in general, the old way when I was working in the lab and doing my PhD, we would order the smallest amount of DNA that possible, and it would cost, I don't know, $15. Back then it was like $15, for a small piece of DNA, and then we would have so much of it that we could do like 1 million experiments probably, and not run out of it. And sometimes you only need it for one, or sometimes you're ordering it specifically for one experiment. You do the experiment and you're done, and you maybe used 2 microliters out of a milliliter of an experiment, and out of a tube that they've sent you, but you were buying the smallest amount possible. So what Twist did is they figured out how to make the DNA on chips, and because they make it on a silicon chip, they can make it in a much smaller volume, much smaller amounts. Again, scientists don't need that much, so they're happy to have a smaller amount if they're paying less for it, relative to they're paying 10 times less because and getting 10 times less of the DNA is fine for them because they don't need that much, and so they figured this out. So they've been selling the DNA for quite a while here. They just opened a new plant, so they've been able to increase their output. That also allowed them to, they'd been so backed up that they were, people would order DNA and it would take a month to get to them. Well, that's, the more expensive way, you can get the DNA basically overnight, right? So you're not obviously you're only going to use them when you're doing really large experiments where there's so much, you're going to save so much money that you can wait a month to start the experiment, right? And so with opening the new plant, now they've been able to offer an expedited service where they can put you in the beginning of the line, because now they have extra capacity, and they can upcharge for that service. And of course the actual cost for Twist is the same. So basically they've increased their margins that way, without actually doing anything to increase their margins except having more capacity. And then they sell DNA right now, and then they have 2 other sort of medium-term and long-term opportunities. One is that they've been for a while partnering with biotech companies to help them discover antibody drugs. So with using their DNA, they can create antibody libraries of antibodies, and then screen them for biotech companies that say, hey, I want an antibody that binds to this specific protein. And so then they so they screen the library. They basically just hand back they say, this is the antibody that binds the best under the characteristics that you want, and then they let the biotech company go ahead and develop it, and they get paid up front for basically their services. They don't really make a whole much money there, but then they have milestone payments downstream where they could potentially earn money for clinical and regulatory and commercial milestone payments off the drugs if they're successful. So that's sort of medium term. It's sort of hard to value those because they don't really disclose how much the milestone payments, and they definitely don't disclose where in the process they're going to get those milestone payments. So it's hard to value those. But if you just assume that 1 out of 10 is going to be successful, you can sort of guess how much they're going to make off of the, I don't know, 60 or something projects that they have so far. And then the long term, they're trying to use DNA to store data. So this would be like long-term storage of data that you don't ever plan on ever needing, but you need to keep it around. And so your options are either keep it on a piece of paper in a box somewhere in a warehouse, or put it on magnetic tape, which is what they generally do right now. But magnetic tape degrades, so they have to continually copy the magnetic tape from one magnetic tape to another just to keep it alive, where DNA lasts a lot longer. And so you could write this DNA, write the data in the DNA, just like DNA, data is one bit, either 0 or 1, where DNA is 4 different bases. So you just translate that 2-bit into 4 bits and then write it as DNA. And then if you ever actually needed to read the data, you could just go back and sequence the DNA. And because DNA sticks around for so much longer than magnetic tapes, there's less issues with having to constantly re-update the data. So I like the company. I'm a shareholder. I think there's more long-term potential than short-term potential. So I think that don't buy it. Don't back up the truck right now. It's not going to jump up. Triple overnight. This is going to be a slow grower for a while until they become profitable, and then I think you could see some upswing in the price.
We've got a question. This was from earlier in the day. This was from AI, the user AI, not a question that was generated for us by artificial intelligence. AI asked, down 30% is Arista Networks. The ticker is ANET. A buy now or still too expensive? So I want to, as a starting point, I want to focus on Arista's financial results, which it's announced fairly recently here. I'm going to send a screen share through and just talk about some things that have happened with the business. So the first thing, and I'm going to try to not make people too dizzy here when I go back, and I just want to talk about how far the company has come in terms of market share. It's now larger than Cisco, both in revenue, dollars of sales, but also in terms of the percentage of ports for these enterprise applications in the data center. So it's really emerged, and as it's done that, it's done it while really being product focused and getting wonderful economic returns. So this was its fourth quarter results. Revenue was up 25%. With incredibly strong margins for a company that's not just hardware. There's also software that's a big part of its business and services, but incredibly, incredibly profitable. And also its ability to convert that revenue into free cash flow is remarkable. It generated, oh goodness, I don't have the number right in front of me, but I think it converted more than half of its revenue into free cash flow. Revenue was $7 billion last year, and I believe its free cash flow was over $3.7 billion, which is so incredibly impressive to me. And I'm going to move into some other outlook tabs here. So for the first quarter, another solid quarter. This is growth, continued growth. Again, keeping those really strong margins that we've seen it have. Goal is $8.2 billion in revenue this year on coming off of a $7 billion year in fiscal 2024. And they see the addressable market as being a $70 billion market by 2028. So about 3 years out here. So really big opportunity. They're the market leader. Obviously, the spend for artificial intelligence and the build out for capacity there is playing some role in its growth. But we're in the age of accelerated computing, Brian. So this is more than just AI, the cloud broadly. We're continuing to see more growth in the enterprise using the cloud. More data needs to be handled at higher velocity, and to be leveraged for these businesses to use, not just sales orders coming across from Amazon, but businesses using business intelligence to use that data to inform decisions in real time quickly. So you need the data to move quickly and reliably and securely. And Arista Networks is built for that. I don't know what their business is going to look like in 2 or 3 years if we do start to see some capital pullback, because it has a lot of customer concentration in these big hyperscalers, like Meta Platforms is one of its bigger customers. So those things could, we go through a little bit of a cyclical pullback in terms of that CapEx spending could affect its business in the near term. But I look out 5+ years, and I think Arista, the business, is built to continue to succeed. Part of the question was asking about valuation. And as we've seen the stock price come down and we've gotten those results and their cash flows continue to improve, if we go back, this is about as cheap as it's been on a cash flows basis in the past 5 years. So it's not cheap. 30 times free cash flow is not cheap for a business that's been around for over a decade and is operating in an industry with growth, but a lot of it is taking market share. It's not cheap, but this is the best company doing what it does in this industry. And in these sorts of markets, you want to buy the best business. It is the best business. I think over the long term, this price is going to work out for good returns. If your time horizon is 2 or 3 years, I think there's risk because of the uncertainty, because of the cycle. But I think 5+, 10 years, Arista Networks is going to work out to be a pretty good investment from this price. All right, you got another question? You ready to wrap? Go ahead.
Let me just ask you about ANET.
Sure.
How does the growth compare? You saw that peak went up and down for the price of free cash flow, but how does it look in terms of the growth? How has the growth been different over that time frame?
Growth rate's been very, very good over the past few years. I think at the growth rate, again, looking at it, that's call it 25% revenue growth and growing your free cash flow per share and earnings per share at much higher rates, I think that's sustainable. I think we could consistently get over the next decade, we could see it grow over that 10-year period, compound its free cash flow per share by 20% plus on average. So seeing it stay at the high rates now and that kind of terminal decline that's normal. That's why I think the business at this price can work out, because even if we do see a terminal decline of the growth rate, the growth rate is so strong right now and their operating leverage of converting sales to free cash flow. Even as we see the growth rate slow, it's going to grow free cash flow at a higher rate that I think it's going to work out. Yeah.
Right.
Yep.
Ryan asked me about an hour ago about Arcellx. It's spelled ARCELLX, and the ticker is ACLX. So this is a CAR T company. So what you do is you take cells from the patient that has a tumor, the immune cells, you add protein, you put DNA in that expresses proteins that allow the cell to express a protein that will target that immune cell to the tumor, and then it goes and in theory goes and kills the tumor. So this technology has been around for a while. They're not going after any new targets. They're going after targets that have already been proven. Their sort of claim to fame is that they think that they can manufacture it quicker. So again, this is like individually made products. So they take the cells from the patient, make the product, and then infuse the cells back into the product, into the patient. So timing is crucial here, and I think they think they can do it in about 17 days, which sounds fairly good compared to the first generation of CAR T cells. And then there may be slightly better potential is that they can they think that they have better safety so far, at least in the number of they've tested a small number of patients, but so far, if you compare their small number of patients to the much larger number of patients that that have been tested for the other CAR Ts, they look pretty good. These CAR Ts can have neurotoxicity, and they can overexcite the immune system and cause the immune system to go crazy, which is obviously not good. And so so far in the phase 2 clinical trial and the phase 1 clinical trial, they looked pretty good. But the efficacy was about as good as what's currently on the market, and then the safety looked better, and then they have this potential manufacturing benefit. So they're going to submit the phase 2 data to go into fourth line multiple myeloma. So this is like sort of late stage. Patients have already taken 3 different drugs already, and they've probably responded and then relapsed, and so they didn't respond, or they weren't they couldn't tolerate the drug or something like that, and so they've gotten to the point where they don't have any other options, and so that allows them to get approval on just phase 2 data, which looked pretty good. The response rate was 97%, and then they had then they had 62% of those. There was 97% responded, and then the 62% had either a complete response rate or a what's called an SCR, which is close to a complete response rate. So the most patients are responding. Almost every patient's responding, and most of them are responding almost fully. The tumor becomes the blood cancer, it becomes undetectable. And then, so they're expecting to launch it in 2026 in that fourth line. And then they're also testing it in second line. And they haven't given an update on when they expect that clinical trial to read out. So it's still early in the launch of that clinical trial. But that's a much bigger market. If you go from second line to fourth line, some of the patients are going to die, unfortunately, in that thing. They're not going to respond, and then they're not going to respond to the drugs, and then they end up not being able to get on a next drug fast enough, and they end up dying. So the market for second line is about $3.5 billion, where the market for fourth line is $3.5 billion, and the market for second line is $12 billion. So considerable potential to move up in the value, in the potential for sales, if they can get it approved, if it can show that it works in second line. And I don't think there's any reason it wouldn't work in second line if it works in fourth line. Those patients are more likely to respond because they have, they're in better shape, right? So and you're asking the immune system to do something. So obviously, patients who are in better shape are more likely to respond. So they have $626 million in cash, which will get them through 2027, and then they plan to launch in 2026. So probably they're going to have to raise more capital because they're not going to be profitable by 2027. So I would expect that they'll, hopefully they get the approval, and then they can raise more capital at a higher valuation. It's currently, the market cap is, I think, about 3 something. Let me, it's coming up.
You got it. Let's see here.
There it is, 3.7. It's a $3.7 billion market cap. So I think, that's kind of high for having one drug that's not going to be on the market for a year. But it does seem like it's working fairly well. So I don't know, it's like a fair price, but I don't see how it's going to change valuation much in the next year. So, I mean, I think that I like the product. I think that, I don't know if the valuation, maybe this is one where you do covered calls and you buy shares and then sell calls at a higher price and earn money on it while you sit and wait for the you know the valuation to go up as it potentially once they're going to read out more phase 2 data. I'm not sure how much that's actually in the middle of this year. I'm not sure how much it looks like it's working. So I think there's not a whole lot of upside for that phase 2 data. So basically the next inflection point is going to be the approval, which should happen next year. So, if you're going to buy it now, maybe a covered call strategy might make sense. Because I'm not sure that it's going to really move a whole lot right now, or maybe just leave it on your watch list and then look at it again in 6 months and see where the valuation is, or maybe look and keep it on your watch list. If it drops in valuation off of no news, then that's also a potential opportunity to buy shares. I mean, I like the company. I hadn't looked at it that closely, but I had time because I took a cheat look at the questions while you were on last hour, and I saw that somebody had asked the question, so I went in and did some research on it. So I'm putting it on my watch list.
There you go. Well, I think that says a lot. So, all right, we just got a question that came in from Investment Vertigo. I think a lot of us are feeling some investment vertigo over recent weeks, looking at our portfolios. Investment Vertigo says, "Good day, fools," and asks, "Can trade desk get any cheaper?" Probably a little, but is this a great re-entry point? Your thoughts on the trade desk? So, in these sorts of environments, you can always expect downside volatility, particularly for companies. In the case of the trade desk, that was extremely expensive. If we go back a few months ago, even coming into earnings and the stock had come down a little bit prior to earnings, but was priced for very high expectations. And a big part of that is because the company has delivered great growth over the long term, has established itself as the premier partner for the biggest ad buyers in the world that want to use its platform to inform their ad decisions in programmatic advertising and digital advertising broadly. And the other part of it too is the relative predictability of its results. I think something like, 30 or more than 30 of its past 33 or 35 quarterly results, the company was within a few percentage points of management's guidance, was very close or slightly exceeded management's guidance. That accuracy and predictability is a big reason why you bolt that onto a business that's consistently performed with great growth, is a big reason why the stock has traded for that premium valuation, because you just kind of expected to be able to do it. So the results that it reported, Brian, were not bad results. It reported a pretty decent quarter, but it missed estimates. And management lowered full year guidance that was far less than expected it would be. So it was a perfect storm of a wonderful business failing to deliver, and then Jeff Green, founder and CEO, saying, "We've made some mistakes, some operational missteps, and here's what we have to do to get back on track." So it upended the story, and the stock sold a lot as a result. At the same time, advertising is a cyclical business. And if we do go through a period of economic weakness, one of the first line items that businesses can kind of pull back on is their ad spend. And it usually is one of the first things that they do is pull back from the ad market. So there's implications of that for the trade desk, just as much as there are for the Alphabets and Meta platforms of the world that the vast majority of their business is built on ad revenues. So the stock certainly could get cheaper because the sentiment is still largely pretty negative right now. because it looks like there's some cracks in the armor, and the thesis maybe is not perfect. So I think the bigger question to answer is thinking beyond even, is this a great re-entry point, is, are there reasons to be concerned about the trade desk's long-term prospects? And my best informed analysis is that Jeff Green is a rare founder who's proven to be a great CEO for the long term. This business has been around for a long time, and we don't always see founders that need to stay the CEO as companies scale up and get more mature. But Jeff Green has earned trust and credibility from investors like me. I think this is an attractive place to invest, but I think maybe the approach that I'm going to take, I already have a pretty sizable exposure, so that's part of it, is I'm not buying a lot right now. I've used options to gain a little bit of exposure. And I want to see what happens next quarter. I want to learn these things that the company's struggled with over the past year that are now resulting in impacting its growth. Are they addressing them? And does that show in the results, right? In addition to what Jeff Green has to tell us. So I want to see a little bit as well, because it's not like the stock is just down because there's no reason. The stock's down because they're not delivering as well as expected. So I think it's a good opportunity to buy some. And then the business is going to tell us, based on the business results, if that was a good decision, and if it was, whether it's a good idea to add more. I think this is a great business to accumulate over time. You don't have to back up the truck or anything like that, particularly when there are some things that we want to see the business do a little bit better than they did. Brian?
All right, so I lied a little bit earlier this hour. Zach's a fool had asked about Evolus, ticker is EOLS, and I'd forgotten the name, but I have actually read about this, and somebody asked about it a few weeks ago, and so when I was on with Carl, and so Carl and I sort of went through it, so I do know enough about it to at least give some.
Hey, there's so much in that brain, Brian. Sometimes you have to rearrange the furniture to find where you left it.
And honestly, there are so many biotechs. Like when I started, when I started 17, 18 years ago, I could probably have told you I could have told you, every biotech. If you told me a biotech, I could have at least told you like generally what they're working on, that sort of thing. Maybe I couldn't give you like a full like synopsis, but now there's like just so many biotechs. It's like 800 biotechs or something, that are public companies. And it's just like, how do you keep all those straight? So this company it competes with Allergan, which is now AbbVie. They're Botox, so they have basically the same mechanism of action as Botox. It's a neurotoxin that helps with wrinkles, and then they've also got a dermal filler that they just got approved of, late last year. I don't think they probably have any sales of it for their sales, which they're going to read out I think they're doing earnings after the bell today. So maybe that's why we got the question. So they've already pre-announced 2024 sales. They're probably at JP Morgan in January. And so they hit 266.3 million in sales, which was above the guidance, which was 255 to 265, and they ended up at 266.3. They've given 2025 guidance already, which is 345 million to 355 million. So that's, well over 20%. Yeah. Maybe that's like, what is that? 350 compared to 266. So that's, it's about 20%.
Yeah, 320 would be about 20% growth.
Yeah, so more than 20% growth.
Right.
But they've only got 13% of the market share, and they're the second biggest brand awareness. So potentially they can, work on getting some more of that market share. I think they've done a lot this is not like your typical drug company where it's mostly about, trying to convince doctors just to prescribe the drug. There's more like interaction with the drug, with the company and the individual doctor, and trying to give them discounts, and if they do larger volumes and that sort of thing, because this is typically a cash business, right? So the doctor is buying the drug directly and then reselling it to the patient, in the form of them paying for the injection. Part of that cost is the cost of the drug. So if they can do individual deals with the doctors, they can sometimes get into doctors' offices easier. And this is also one of those things where doctors may not want to offer both drugs, Botox and the Evolus's drug, which is Juvea, Juveau. So I think that there's potential to become the drug for a specific doctor. And then they've also got this dermal filler, which I don't think they've given guidance on how much they expect sales to be, but there's potential for increasing sales for that. And then I guess they've actually given 2028 estimates, and they expect greater than 700 million in sales in 2028. So that would be a double from the 350 that they expect this year. So only 3 years out, they could potentially triple or double their valuation, their revenue. So I think there's a lot of potential here. The one downside is, you could imagine if there's a recession, this is one of those stocks that might get hit kind of hard, because it's one of those things that people can easily cut back on in price. It's not something that they actually need. It's not a drug. It's certainly not a treatment that they actually need. It's cosmetic, and so that's probably the downside to this company.
So before we take any more questions, Brian, just want to pause for a moment. Our folks watching us on YouTube, welcome. Thank you for joining us on the live stream here. We're answering questions from members, and we want to answer your questions too. Go to slido.com, put in the event code Fool24, Fool24, all one word, and get your questions into us. We'd love to share some insights and expertise. If you haven't figured it out already, Brian Orelli knows a thing or two about pharmaceuticals and the biotech industry and biotech stocks in particular. So if you have questions, get those into us. I know things about a lot of different companies and a lot of different industries. So try me, and we'll see what I can do. So there's a question here about Moderna, but before you get to that, Brian, I want to answer a question from a little bit earlier today about EMCOR. The ticker is EME, and we had an investor, a full member, just asking if it's a buy right now. So for those that don't know, this is a recommendation in one of the Motley Fool's services over the past year and a half or so that's done well. The stock has done incredibly well over the past few years. EMCOR's business it's an electrical contractor, does a lot of HVAC work as well, makes money when there's the build out of things with lots of electrical work. And we're not talking about residential communities here. We're talking 50 unit buildings and factories and data centers. AI has actually been a big tailwind in the market for the company, the build out of these AI data centers, because something like half the money, Brian, you might not know this is an interesting statistic, but half the cost of building a data center is electrical and HVAC. So it's definitely a meaningful amount of money for companies like EMCOR. But also, again, the nearshoring that we've seen, supply chain realignment with a focus on North America. Think about factories that are being built for tech things, semiconductor industry in Arizona, manufacturing facilities in Ohio and other parts of the Midwest that logistically are in favorable locations that have access to skilled labor. You need to build out the electrical for those things, but then you need to maintain and improve it too, especially on the HVAC side. So they have a pretty big services business as well, maintenance business as well for upgrades and service. So the results I'm going to share on the screen here. It's some of their results from their Q4 presentation. Natasha, if you can share that when you have a moment too. Revenue was up about 10%. Revenue growth rate has started to slow over the past couple of quarters, but an exceptionally profitable business with a certain amount of scalability in their costs. Basically, their electrical contractors and electricians that work for them have been running ragged. And as a result, they're very busy and the business is really profitable. So 9.6% revenue growth leading to 34% operating income, being really smart about managing your costs and expenses, buying back a little bit of shares, you get to 41% earnings per share growth. That's incredible for a business like this. A couple of things I do want to point out that I think are relatively positive for the future. RPO, remaining performance obligations, a little over $10 billion. That's up 14.2% year over year. So what does that mean? So a lot of the business that they do are things that they complete a contract in a couple of months, a few weeks, 6 months, as you know, you're building out these large facilities and it takes time. So that revenue doesn't show up in the RPO. Remaining performance obligations is revenue for services that they'll be able to recognize for services that they've not provided yet that are more than 12 months out. So this is a book of, basically it's their backlog of contracted business that's going to happen more than a year out. So that continues to grow. That's really, really, really good, obviously. And growing at a faster rate than total revenue is important. But I want to point out too, it's $10 billion, just did $3.7 billion in the quarter. So it's a sizable amount of money, but they still need to do a lot of other business to continue to grow the business year over year. So that's important. Full year results, I wanted to highlight this because again, 10% revenue growth versus 16% for the full year. We're seeing a deceleration of growth. Things are kind of slowing down. There was a just real run up in 2022 and 2023 that carried over into the first half of 2024, where they were just really, really, really busy. We're seeing some slowdown there. Let me try to find one more thing here I want to share. Let's see if they've got it in here. This last thing, so Miller Electric. This is an acquisition that they made that closed in February. So that was not included in the Q4 results. We'll see a little bit of the impact of that in Q1 when they report that this spring. What does this mean for EMCOR? So first of all, EMCOR has a history of doing acquisitions like this, small bolt-on acquisitions that largely give it geographic expansion into markets where they don't already have a sizable presence. They've been a really good buyer over time, buying these businesses, integrating, getting good leverage because you get the footprint that you're looking to establish. You expand your professional, skilled tradespeople that you need to be able to be an effective electrical contractor. And then you leverage all of your existing back office to drive out costs, to get whatever you paid for it, gets a better return on that investment than whatever your cost of capital was. In this case, was a $865 million deal paid for in cash off the balance sheet. And they bought a business that did about $805 million in revenue last year, has a lot of growth. You think about that core. EMCOR doesn't do a lot of business in Florida, but through Miller Electric, they're gaining a big foothold into Florida where the demographics are very favorable for continued economic growth. It's a business-friendly state. Taxes, infrastructure, skilled workforce, a lot of things that are favorable about that. And I think this Miller Electric acquisition is going to be a continued driver of value. But again, think about the business, $800 million in revenue compared to a business that did $14 billion in revenue for the full year. So you're bolting on about 5% revenue growth. So it's small. It's not going to change the game, but it's the kind of acquisitions that companies like this can do really well, where they're not making some giant acquisition. You risk affecting your corporate culture. You pay too much, doesn't generate return. This is exactly in the sweet spot of the kind of acquisitions they've done that pay off really, really well. EMCOR stock is not cheap right now, but I think it's a reasonable price for investors because it's a cyclical business. Eventually, the capital inflows that are going to building out these sort of infrastructure assets and the commercial real estate that's the focus of their business, and the industrial real estate that's the focus of their business, there's going to be a pullback in that capital spend where there's growth right now. The business is going to be able to scale down and still be profitable through those environments. They've generated positive free cash flow basically every single quarter since the company went public. I think they might have had one or two where they were about neutral. And every single year they've generated positive free cash flow. It's a really, really well-run business that's built to be able to scale up and down through cycles. But I think the larger trend around electrification and modernization of the U.S. electrical footprint are big tailwinds for EMCOR over the next decade plus. And I think this price is going to work out over the long term. I don't know what's going to happen in the next 2 or 3 years, Brian. We could go through a cyclical downturn, but it's the kind of stock that when we do go through a cyclical downturn and the stock price falls a lot, chances are the business is still really good, and it's just an even better opportunity to buy. I don't think investors have to wait. I think you accumulate a little bit now and build that position out over the long term, and you're going to be pretty happy. All right, Brian, back to you, bud.
So Gator 500, 5000 E, don't want to lower his valuation, asked a broad question about what will Moderna, tickers mRNA,
will Moderna ever be a good buy
Moderna
again?
ever be a good buy again? I don't know. I guess that it sort of implies that it was a good buy before, which I'm not sure is the case. If Natasha can bring up my screen share, there we go. So this is the valuation in market cap of Moderna. And I would say about here, I started saying it's not the valuation's way too high. And then, it went all the way up to here, and all the way up, I said it's too high. And then as it came down, I said it was too high. And even here, I said, I can't see valuing it at around $60 billion. I bought here like 2 weeks ago. Yes, I think it's a good buy. Here, just for comparison, here's Merck and Bristol Myers, very large pharmaceutical companies. It hit, it was larger than Bristol Myers and hit the same valuation as Merck at its peak. I mean, that was just kind of ridiculous that we would expect. I mean, basically, you had to expect that the 10 billion or 12 billion in sales of COVID-19 drugs were going to continue in perpetuity. Then a $200 billion valuation seemed reasonable. But I'm not sure why anyone bought at that level thinking that was going to happen. And obviously it didn't.
Brian, let's build on that, because I think part of the thesis wasn't just that those drugs were going to continue to be sold, but that the COVID vaccine was largely the test bed for their
that they were working on before the mRNA before the COVID-19, before they switched and went 100% COVID-19, they were working on a CMV vaccine, and that has now gained approval. But that just shows you the time frame that it takes to gain approval. They were working on it in 2020. It was their lead candidate, and it hasn't, to gain approval in 2024. So
that's the typical timeline for these things to get through.
Right. So the point is that you can't assign a huge valuation on a platform, right? The platform has proven itself out, but you still have to wait the time frame. You have to backtrack that valuation of, let's say, they've got a very solid phase 2 clinical trial. I mean, they didn't have this in 2021 when their valuation was, crazy, but now they have a very solid lung cancer study. Phase 2 data looked very solid. They're enrolling the phase 3 study. It's probably not going to read out until, I don't know, 2026 at the earliest, and then we got to wait a few months to process the data and then 8 months to a year for the FDA to respond, to gain approval. So we're not talking about till like 2077, 2028. So yes, let's say it's a 80% likelihood of success. You take that valuation, but then you have to backtrack it to 2025 to assign an actual valuation, because you need a return on investment between 2025 and 2028. You can't take the 2028, this drug is 80% likelihood of success, and take 80% of the value of that drug. You have to take 80% of the value of the drug and then backtrack it to the value in 2025. So the reason why 60 billion was too high was because, yes, everybody assumed that at that point the sales were going to go down, and now they expect, I think in 2025 they're expecting between 1.5 and 2.5 billion in sales. And so, if you just value it on that alone, then you can get to a valuation that sort of makes sense. So 1.5 billion is basically 10x price to sales ratio. At 2.5 billion, it's pretty cheap. At what, a little over maybe 5 times sales. So, and then if you look at the enterprise value, which will subtract out the cash and add in the stock, and add in the debt, which they don't have any of, that the enterprise value is only 4.6 billion. So I think it's really, really a compelling buy right now. I'm not, maybe not back up the truck, mostly because it's going to take a while to get the next major drug on the market, which I think is probably going to be that lung cancer drug, although they may have some other minor products that get approved between now and then. But I think it's it's one of those sort of wait and see, but I think the valuation seems reasonable, given if they can keep sales at 2 billion. Let's take the mean of their guidance for this year. If they keep sales at $2 billion, obviously they're spending some of that cash, so the enterprise value is going to go up just based on the fact that they're spending that cash. But if we just look at the market cap at 12 billion, even if they spend down some of that cash, it still seems like a compelling valuation. And the fact that they're going to be able to potentially have another blockbuster that's another $1 billion on the market in a couple of years, I think the valuation seems reasonable right now.
Brian, if there is some upshot especially for investors today, well, even for investors over the long term that bought prior to those peaks, I think they did some secondary offerings in 2020, and they were able to raise some capital for a lot fewer shares than they were probably anticipating having to do that on before. So that has helped fund the business and help maybe limit dilution a little bit as the COVID cash cow went away, and they've had to continue to pay to support these programs through the development process.
Yeah, you can see the market cap separates from the price. So that the reason for that is because when there's more shares, but the price, there's more shares, and therefore the market cap has to go up, because the market cap is defined.
That's the dilution.
The number of shares. And then for some reason they seem to come back together, but I think that might just be a scale thing. I don't think I think if we went to like 1 year, you would see a difference. So
right. No, that's exactly right. All right, Brian. Well, it is the 1 o'clock Eastern time hour, and that means that our time here is done. We're going to be joined very briefly or very quickly here by Travis Hoium and Will Healy for the next hour of the show. Brian, thanks. This has been a great hour. It's been a lot of fun. Fools, thanks for your question. Travis, Will, hey guys.
Hello.
Hi, Jason. How are you?
I'm good. I get to take a little bit of time off from the screen right now, which is good for viewers, and they get the two beautiful faces that are you guys. So we're going to leave now.
Yeah, I think I'll be back on at 6 o'clock. So if people have more biotech questions, ask them.
And I'll be joining you. So that'll be hour 2.
All right.
All right, fools. We'll see you around.
All right. Hello, Will. Let's just jump into it. I think you had a couple of things that you wanted to touch on early in the show. The theme of the hour is AI tech stocks and everything that's going on with AI. So feel free to ask any questions you have, but that's kind of what we'll kind of start with here. So what did you have on your mind on this wonderful Tuesday. We got a down market again today. So
we have a down market again today. Not all stocks are down though, and one of them that was not down in the AI tech space is Okta. So it seems earlier in the week, in terms of AI tech, the focus is on cybersecurity, specifically Okta and CrowdStrike. The CrowdStrike earnings come out a little bit later, so I'll give a little preview of those. But first, I want to go into Okta, which reported yesterday. Okta is up almost 17% as of now on its earnings. For those of you who don't know Okta, they're best known for their single sign-on service. So it's instead of having to know a gazillion passwords to get into your,
you just have to use the Okta app 1,000 times a day.
Yes. So exactly. So I mean, it sounds like a good business. However, it has not been growing as fast as the other businesses, and even in Q4, revenue grew by about 13%, which is not a horrible growth rate, but it's kind of lagged its other peers in cybersecurity. The reason why it's up so much is the remaining performance obligations grew 25% year over year. That means they're about to have a huge surge in revenue growth. And I think that's going to bode well for them. Another factor that they seem to have gotten past is they were running losses for years and years. Well, now they've turned profitable. They earned $23 million in Q4 and then $28 million for fiscal 2025, which ended on January 31st. A huge problem for them had been stock-based compensation. However, they did cut back a little bit on that. At $565 million, the stock-based compensation is still substantial, but it was down from $684 million a year ago, and I think that allowed cutting back there allowed them to report a GAAP profit. So things are looking up for Okta. Looking at their valuation, they have a forward PE of 35, which for a newly profitable company is very low, and then price to sales ratio of just 7. So for cybersecurity, most of the cybersecurity stocks have been trading at a PS ratio above 10. So to see one at 7 is pretty unusual. So all these factors seem to bode well for Okta. So it may finally be getting its growth rate to be closer to its other peers in cybersecurity. So things seem to be looking up for that stock finally. Do you follow Okta, Travis? Travis, you're on mute.
I don't follow them a whole lot. I peer in on them every once in a while. And they went through those challenges. Was that 18 months ago or maybe 2 years ago now? The time passes so fast with all those security breaches that end up happening, but it does, it obviously didn't really derail their business. I just pulled up the some of the numbers at a glance. At least 15% compound annual growth rate from fiscal 2023 through fiscal 2026 is what they're expecting. So pretty solid growth. I was just going to look up some of the valuation numbers. Because that's the one thing that's always, we've talked on these shows a number of times. Forward price to earnings multiple of 27. Price to sales, enterprise value to sales right now is about 5 because they've got a market cap of about $15 billion. So not a cheap stock. Also not the most expensive you can find out there. So I think really solid company. The question is, to me, there's so many of these kind of sign-on services. I use a bunch of Google's products, and they've just gone to, we're going to handle all this ourselves. We've got the Google app or YouTube, whichever one, and that's how you're going to, sign on to all your things. So you have like the two-factor authentication. So, maybe kind of limits the potential size of your business. But a 15% growth rate isn't too bad. It's just not an overly compelling. Is this one you own, by the way?
I do not, but I do own CrowdStrike, which I will talk about when we're done with this one.
Yeah, I can take this down and pull up some of CrowdStrike's info as well. But CrowdStrike reports today.
They report after the bell. Looking at their looking at their numbers, they're in terms of revenue growth, they're expected just the consensus is 1.04 billion, an increase of just over 22%. That's a little bit of a slowdown from the past, because until recently they were growing revenue at above 30%. So it seems to be showing a natural slowdown there. Although for the fiscal year they're looking at 29%. So I mean, yeah, maybe. Or I guess that's we're on the fiscal Q4, so that wouldn't apply as much. But yeah, it looks like.
And the stock is up 75% since that dip in what was it, August, late July, early August last year.
Yeah, that because that they had that they caused an outage basically with Microsoft.
They fixed it with a gift card though.
I'm sorry.
They fixed it with a gift card.
They fixed it with a gift card. No, but I think what really besides the gift card, I think what helped them is they were they were very upfront about claiming responsibility for the mistake and fixing the mistake. The stock suffered for a few weeks still, but within a few months it was back to its record high, despite losing about half its value at one point. So I do think they handled that well. So we'll see what happens with CrowdStrike. It's down. It's in correction and maybe bear market territory from its recent highs. So it's kind of hard to say.
Let me grab that quick. So we're 15.5% down from the peak, which would have been February 18th. So, it's fallen with some of the other tech stocks in the market and kind of the high growth stocks. Doesn't seem like it's, but we'll see what happens with earnings, because this is another one where enterprise value to sales is 24.
Yeah,
much more expensive. But that said, the 3-year trailing compound annual growth rate is 43%. So you're paying up for quality there.
Yeah, it's the fastest growing cybersecurity stock. I think it's also the most expensive. You're looking at the price to sales ratio on it. That's 25. The one I kind of see as second place in industry, that being Zscaler, which I also own. That's trading at a price to sales ratio of just 13. So, it's roughly twice as expensive as Zscaler. So, it's kind of hard to say what it's going to do after earnings. I mean, you have to think maybe it's going to come down some. You never really know, but because it has, as Travis pointed out, it's fallen more than 15% in recent weeks. So we'll just have to see what happens there.
If anybody has any questions, let us know. I'll leave some of these questions. I don't really have the one from Ed about 15 minutes ago, Chewy or Toast. I think Toast is a really solid business, but I don't necessarily have a strong opinion. I think that's another one of those where the price on some of those is just not necessarily all that compelling. I did want to get a little bit, since we're talking AI tech. I wanted to get a little bit meta and ask your thoughts here, Will, because one of the things that we've seen over the past few weeks is a real pullback in some of the kind of infrastructure companies. I was just going to pull up NVIDIA. Currently, the drawdown is 22% from their high. That's pretty significant. It's not unheard of for NVIDIA. As recently as 2022, they were 65% off their highs. They periodically drop 80% from their highs if you go back to like 2022, 2023. So, typically a very volatile stock, but I do think a number of things have changed. And one of them that I think is interesting to think about is what happened with Grok. Grok essentially came from nowhere. This is xAI's artificial intelligence model integrated into Twitter, but there's also an app you can download. But they basically came from nowhere to create arguably maybe one of the best LLMs that are out there today. So I think it really raises questions about how durable some of these businesses are if all you have to do is just buy a whole bunch of chips. By the way, most of these chips were supposed to go to Tesla. Elon Musk just directed them to his other company. Something I think should get more attention if you were a Tesla investor, but that is what happened. And so they've built this huge cluster, created a really good LLM, and then it sort of calls into question, is there value in OpenAI? Is there value in Gemini? Is there value in any of these artificial intelligence models going forward. And I think we really have to question that, because somebody eventually has to pay for the chips if you're looking at NVIDIA. And that's what's at least one of the things that I think is in question right now. So what are your thoughts there on Grok kind of coming from nowhere and turning the AI model business on its head?
Yeah, it's really hard to know what to make of that business. But you see all the spending from Meta, from Alphabet. I think Alphabet's going to be spending $75 billion on CapEx this year.
Right.
It's a company that can afford it, and Meta could probably afford to spend nearly that much. But with all that spending, you have to hope that they're going to get something out of it, and that the competition in this business does create some concern there. So I think it's too early to tell the short answer, but it's going to be something to watch.
Well, the question to me too is going to be, where does the value end up accruing? If it's not in the LLMs and the model makers, this is one of the reasons that I think Alphabet, we'll talk a little bit about the Meg 7 next hour. I'll stay on here as well with Danny Vena, but Alphabet has arguably the best just distribution in artificial intelligence with all of its products. I mean, of course there's Gemini, but it's now folding into Google search. I mean, I always use my wife as a proxy for these things, and she will look up things and not realize that she's looking at, an AI overview from Alphabet. And I think that's naturally how most people are interacting with a lot of these things, as opposed to going to OpenAI. I know they have, I think it's like 400 million weekly active users, but how many people are actually using that on a daily basis compared to Google, or just the search bar that you have in Chrome in particular, which is still the most popular browser out there. I think that distribution point is going to be extremely important. And also think about monetization. XAI came out with a phenomenal model from everything that we understand, but how are they going to make money off of it? And that gets to your point, which is, yeah, these big tech companies are burning a whole bunch of money, but what about these startups that are also burning money and they don't have a business model behind them? Elon Musk is really good at raising money, but not necessarily quite as good as turning that into profit. Even Tesla has never earned back all of the money that it has raised from both private and public markets. So it's going to be interesting to see who can actually turn this into a real business.
Yeah.
Sadaf asked about if Coinbase is going to benefit from the U.S. crypto reserve. If the crypto reserve happens, I do think we need to caveat that, and especially the fact that crypto fell back, in trading yesterday, basically gave up all of its gains that it had on Sunday. I don't know that that's ever going to pass legal muster. So I wouldn't put a whole lot of stock into the U.S. crypto reserve announcement. Is Coinbase going to benefit? Incrementally, they would probably be one of the companies that would benefit just by increased exposure, increased knowledge about what's going on with the cryptocurrency market. But I don't think that's like a reason to be bullish on a company like Coinbase. I'm much more worried about what's going to go on with the infrastructure on the blockchain and what's actually being built that's real utility, as opposed to memes and the reserved crypto reserve trade. Which is something that a lot of people have been talking about for a while. So that's I guess my general thoughts is I'm just a little bit skeptical that some of these news items that typically move cryptocurrencies on a short-term basis aren't really the value drivers long-term. So I don't want to. I don't think we should get too distracted by things like that.
Yeah, I don't know how that affects Coinbase per se, but we have countries now that like El Salvador that's kind of made Bitcoin sort of a national currency. So I mean, it is definitely something to ponder. But yeah, I'm with Travis there. I don't really. It's hard to know what the U.S. per se is going to do with this. So
yeah, the U.S. and El Salvador.
Yeah,
I don't know. I question that that's ever going to be a real thing. Now, what is a real thing is like USDC, Stripe taking payments in USDC and that being lower cost than making a transaction with a credit card. That's a real thing. That's real value. That's real disruption happening. That's, I think, where we need to focus attention, not just on number go up, number go down stuff. But I've been saying that for years on these shows. So
yeah. So Real Madrid fan asked about 3 hours ago. There's a question from a few days ago about Spotify. So it was nagging me that I was always passing it up. So I went and looked at Spotify a little bit, and then this question came up. What do you think about Lululemon, LULU, and Spotify, symbol SPOT? How much may they be affected compared to Mercado Libre, MELI, and Shopify, SHOP, and others you are discussing?
And that is that in relation to tariffs, or how are they going to be affected by?
Yeah, that's a good question. I'm not exactly clear on that. What caught my attention is the fact that all four of these companies really do basically different things, and even Mercado Libre and Shopify. Mercado Libre is itself an e-commerce company, whereas Shopify is they sell the e-commerce platform and services in their ecosystem, but they don't do e-commerce themselves. So it's those two are different for that reason. And then Lululemon, I don't follow that closely, but of course they're famous for their stretch pants. And then Spotify, I kind of struggle with Spotify. I have a bias against it personally because it's kind of an app without an ecosystem, and that tends not to bode well for a stock longer term. I remember Garmin back in the day. Before the iPhone came out, they were making a lot of money on their GPS systems, but when the smartphone came out, GPS was just one of the many apps on the iPhone, and Garmin survived that, and their stock suffered quite a bit for a while. They ventured into areas that a smartphone wouldn't necessarily go into. They were able to survive. Spotify is also one of these few survivors. They made an alliance with Samsung rather than Samsung developing their own music service. They partnered with Samsung. I think that was very smart. I think that might have saved them. They've also gone into podcasts or starting to do some videos. So they are getting a little bit of traction there. So I think it's maybe fairly valued to a little bit overvalued here. I'm just looking at the valuation. Let me pull that up.
Yeah, while you're doing that, I'll take the opposite side on Spotify, because I think this is one of the companies that is really misunderstood because you have to understand the dynamics of aggregation and the way that the digital world works, the internet works, is what are people choosing to interact with every single day. And you have a ton of competition in the music space. I mean, Apple should have every advantage on the iPhone, but Spotify has won that business. They beat Apple at their own game, arguably the thing music that kind of turned Apple's business around. The iPod was really what turned Apple around in the early 2000s, and then bring in iTunes and all that kind of stuff. Then you come into a world of streaming, and Apple has bigger fish to fry. They want to sell phones. They don't necessarily want to be the company that's constantly innovating in the music business. Spotify said, okay, we will do that. And there's a lot of challenges there between those two companies. But at the end of the day, Spotify has built a really good business because customers choose to go to them over and over and over again. And so that's what's ultimately built a profitable business for them. They are aggregating all of those customers, and then they're using their app to help them discover music or podcasts, or now much more video as well. And that's become a really big business. And I think that's going to continue to be a phenomenal business for them long term. And they've just really started to learn how to actually make money. This is what's kind of interesting in the last few years. Some of these companies that kind of grew up in the 2010s, where it was just growth tailwind after growth tailwind. Now you get to a point where the market demands that you start to make money. And it turns out there's some of these companies Spotify is definitely in that camp. I would put Uber in that camp as well. So I think they're in a really great spot, compared to all these other companies. And if we are talking about tariffs, they're going to be the one companies that's not going to be really impacted by that kind of stuff, because it's a digital good, unless we're talking about digital tariffs. But yeah, I think they're in a phenomenal position, and no reason to think that people are going to cancel their Spotify, no matter what happens with the economy over the next couple of years.
Yeah, I do think they'll make it. I've always just been a little bit uncomfortable with companies that they're companies like this, because you're at a competitive disadvantage. it's, but Spotify is a very smartly run company. They found a way to innovate in music and more lately video, and and then partnering with certain podcasters and such to bring in business that way too. So I think it's very smartly run. I just don't. I'm a little. I don't think they can completely overcome that competitive disadvantage, but I'm not necessarily going to bet against them either. And it's from a price to sales ratio standpoint, that's about 7. That's near a 10-year high. So that may not bode well for the stock in the near term. That doesn't mean it's finished by any means, but in the near term, I'm not so bullish on it for that reason.
Yeah, and the other side of that is that it's never had margins that are higher than this, and it's never generated more cash flow. I'm not arguing that it's a cheap stock in any way, but I don't think if you just look at the free cash flow trends, they're just like rocket ships up and to the right. It looks like an NVIDIA chart. So, I don't know what happens with the valuation from here. It has been on a crazy run. Let's see here, 122% in the past year. That may be a little bit overdone, but we'll see what happens. Definitely, this is one of my bigger holdings. There was a question that came in from 307 Fool. What holdings of yours are you most concerned about today, and why do you feel that way? I'll let you noodle on that for just a second. I'm looking at my holdings here on our system.
Yeah, that's why I hadn't looked at my holdings that way for a while. There is one I was with. I guess I'm still in Innovative Industrial Properties. For those of you who don't know that stock, they're a real estate investment trust. They lease they lease space for growing to medical cannabis companies, and I think what's hurt them is the medical cannabis industry, or the industry in general, really is highly competitive. And while IIP has an advantage because they just lease the space to them, they've had relatively few clients, and then one client kind of defaulted for a bit and needed to renegotiate their deal with IIP. They've done that. I think that the immediate concern has passed, but the stock hasn't really recovered. And that could happen again with it. So the dividend is very high now as a result of that. But the fact that we had that client default and that they have so few clients in the first place does cause me some concern. This compares to my other real estate investment trust, Realty Income, symbol O. They have, what they do is they lease single tenant properties for commercial purposes. They have about 15,600 buildings, I think. So they have hundreds or thousands of clients. So I'm not so worried about one client necessarily not paying. But when one client doesn't pay with IIP, it gets a little concerning. So that's probably the one that really sticks out in my own portfolio.
Yeah, I'm just looking. One that I can't believe that I still hold, and I think every time I look at selling, I just think the valuation is too compelling. But that's XYZ Block. I guess the ticker is XYZ. Owned it for years. I'm sure it's a profitable position because I bought it at such a low cost basis. But I remember during the pandemic, that was one where I was going, oh man, this is going great. And then suddenly it just completely tanks. That's one that maybe I just leave it in there to think about the lessons learned with that one. Another one that I've been very, very, very small position, but Virgin Galactic is one that I have been interested to follow because they're doing the things that they say that they were going to do, but they're on such a tightrope from a financial perspective that this is a company that could be very valuable and very profitable in the future if they can actually get to commercial operations next year, build their 3rd and 4th spacecraft, all that kind of stuff. I actually went down there last year to their 6th spacecraft launch, and really interesting to see how much demand. I mean, it's a very niche product, and if you're not a multimillionaire, probably not something that you're going to spend $600,000 to go into space for a couple of minutes. But that said, there's a lot of people that do fit into that category and are willing to spend a lot of money for that kind of experience. And I think there's a real business there if they can get to actually producing their spacecraft in larger numbers than the 2 that they can actually afford to build right now. That said, it's down something like, 98% since I originally bought it. So has not been a winner, but I keep looking at it from here. Is there an opportunity? Eventually, maybe there will be, but I'm just going to, again, maybe that'll go to 0 and I'll just take my lessons from that one, but continue to think that's one of those like 100x or 0x stocks, and there's kind of nothing in between.
Yeah, I was not in that one, but I was in block for a long time. I loved it when it was square. I sold about 20% of my position near the top, back in 2021. I eventually sold the rest of it in certain lots, so I don't really have it anymore. I think it's trading about where I originally bought it back in 2019 or 2020. So it's been a wild ride. I love Square. Don't care so much for block.
And it's one of those where Jack Dorsey is just somebody I should just stay away from. Proven to be a phenomenal entrepreneur in starting new businesses. I don't know, maybe starting Bitcoin. Who knows if that speculation was correct, but not really somebody who's great at running a multi-billion-dollar business. I think that's probably fair.
Yeah, I would like to know if he's the real Satoshi Nakamoto. That's been a mystery for quite some time. The rumor is he's one of the suspects.
It would explain some of the obsession within Block for building on Bitcoin instead of building on potentially better blockchains, which there are dozens of now that would be better to actually run financial transactions through. A question just came in from Ed. Which of these riskier companies do you like better, Rocket Labs or ASTS? And obviously it's on the screen there, but we can't give personalized financial advice. But these are a couple that I've looked at and haven't done a ton of deep dives on, in part because I can't get my head around with either of them what the economics look like long term and what the ultimate competitive advantage is. Rocket Labs looks a little bit like an automaker to me, where if demand dries up, you just got a whole bunch of operating costs that you've got to eat on an ongoing basis, and we don't know that sort of what their marginal costs are going to be. But it's not a recurring revenue business in maybe the way that you would like with some technology companies. ASTS, so early on, and again, so much competition in that space, in the satellite to phone space, and they're not even the one that's ultimately connecting with customers. They're actually using companies like AT&T and Verizon's spectrum. So if I have to pick one, I guess Rocket Labs intrigues me more, but that's just because I can't get my head around how ASTS is going to live up to their current valuation. I don't even know what it is. I'll look it up here, but they're basically still a pre-revenue company, $5.1 billion valuation. And that's with a few satellites and $4.4 million worth of revenue over the past year. That's very speculative to me. So Rocket Labs is at least proven that there's a real business there.
So about Sadaf, about 3 hours ago, Sadaf had a question. It feels like the semiconductor industry is a new weapon of this new world order. I don't like to be in the middle of a crossfire. Any advice on this? Well, I think that kind of depends on what you mean by new world order per se. That's a term political term that can mean a lot of things. I will say I think you're touching on that concern though, that the overwhelming majority of semiconductors, especially the advanced semiconductors, are made in Taiwan, and of course, if you follow any geopolitics, China has been threatening to invade Taiwan since before the semiconductor industry existed, and the threats have stepped up in recent years. So that is a concern, because if that were to actually happen, we depend on semiconductors for Taiwan. So obviously, the industry would be in a world of hurt if that actually happened. I don't happen to think it will happen personally. It's one of those situations where China can have Taiwan, or they can have access to these advanced semiconductors, or at least some of them. I don't think they can have both right now. As long as they can't have both, I think it's safe. That said, if you might recall that Berkshire Hathaway was in Taiwan Semiconductor for a brief time. It does look like a Warren Buffett stock, or it in many respects, or at least it did at that time. However, Warren Buffett stepped in. He was not comfortable with that China Taiwan risk, and he pulled Berkshire out of TSMC.
With a quick little profit, by the way.
A quick little profit. That's true. So I mean, again, we can't give personalized advice here, but it sounds like by the nature of the question, you're not really comfortable with that risk. If you're not comfortable with that risk, there's absolutely nothing wrong with selling it and moving on to a different investment or different types of investments. Like I tell people, I think there's nearly 10,000 stocks trading right now. You don't have to like all of them. You don't have to be comfortable with all of them. But with that many stocks out there, there's probably some that you can build a comfort level with. If you're not comfortable with TSMC or the semiconductor industry, feel free to get out and look to other things.
There's a question for me from Vihan. Where do you stand with HIMS? Is the thesis, and that's the ticker is HIMS, HIMS. The company name is HIMS and Hers. Is this thesis intact, and are you rethinking the investment after the drop in the stock? I want to put the drop in the stock into a little bit of perspective. So shares, let's see, their drawdown currently is 42% from their high, which was hit in kind of middle of February. Okay, so pretty quick drop. But the percentage change so far this year, the stock is up 59%. Over the past year, the stock is up 72%. And over the past 3 years, it's up 769%. So again, I think we have to remind ourselves, long-term investors, foolish investors, think about the next decade or two, not just about what's happening right now. So if you're not familiar with HIMS and Hers, the company reported earnings last Monday, I believe it was. I'm gonna get the exact numbers so that I quote them correctly, but I believe revenue growth was 95.1%. 95.1%. Okay, so phenomenal growth. The question mark with HIMS and Hers was what was going to happen with GLP-1s. So this is the weight loss treatment. HIMS and Hers was using kind of a loophole with the FDA where if treatment is under shortage, so a lot of the GLP-1 treatments from the branded medications, so like Wegovy, I'm not going to remember all the names, but the Eli Lilly and companies like that have been making GLP-1s, but they were on shortage. So if you wanted them, you couldn't necessarily find them. So then the FDA allows you to what's called compound those. Compounding is basically just mixing them in a qualified facility. Compounding is, by the way, not a crazy thing. My now 8-month-old son got a compounded antibiotic a couple of months ago when he was sick. So it's basically, it's normally used for if you have you need a treatment that's personalized. So let's say there's a 5 milligram version and a 10 milligram version, but you need a 2.5 milligram version. They're going to compound that product. I'm kind of making those numbers up, but it's personalized for you because the off the shelf product isn't necessarily appropriate for you. So that's how it's normally used. And then there's this during shortage, other companies can actually produce compounded medication. So that's what HIMS and Hers was using to produce GLP-1s. A large chunk of their growth, so that 95% growth, over half of that growth was from GLP-1s. That loophole, that the compounding thing will end in May. They said that they're going to stop selling GLP-1s by the end of the first quarter. So that means that likely in the second half of the year, the revenue is going to slow. And there's just a ton of questions around what is the actual growth rate? Is it 25%? Is it 90%? Is it? And everybody's speculating on kind of what the real growth rate, what the underlying non-GLP-1 growth rate is, and are they going to be able to move people from GLP-1s to other weight loss treatments? So lots of questions around the company. Take a big step back and just listen to these numbers here because these are crazy. Since 2018, HIMS and Hers has grown revenue at a 95% compound annual growth rate. They are also now profitable, something that's extremely difficult to do when you're growing at that rate because usually you're increasing things like your sales and marketing spend and your overhead and your, building out capital infrastructure. They're acquiring companies, all kinds of other stuff. So they continue to grow. So is this a company that's going to grow 95% for the next decade? Probably not. But do I think that it's still the kind of company that I want to own for the next 10 years? Absolutely. So from that perspective, I don't think the long-term thesis is has changed really at all. That doesn't mean that the stock couldn't fall 50% over the next couple of months. The thing I always go back to is the enterprise value to sales multiple today is 5.9. That's a pretty reasonable multiple for a company that's growing, even if it's just, let's say, 30% per year. And I don't have the number in front of me for what guidance was for next year, but their guidance even for the second half, excluding GLP-1s, was extremely high. I don't want to misquote the exact numbers, but it's well in excess of 30%. So I think you need to look at this. This has been my argument all along. This is much more of a platform company than it is just a product company. So focusing on any one given product you're going to miss the forest for the trees. And just look at this as a company, again, on the internet. Who are people choosing to interact with? They put a chart in their last earnings report. They have something like 50% of the market share in kind of this, direct to consumer healthcare business, and they're expanding the number of offerings that they're having. So that's exactly where I want to see them going. Don't know if that means that they're going to, 5x their revenue over the next 10 years, or if they're going to double their revenue. But I like where they're positioned. And I think it's, probably a reasonably priced stock, but that'll probably be very, very volatile as well.
So about 3 hours ago, Ted Has Options asked, if you are sitting on some cash, does it say wait 5 days to see where values settle? Yeah, it's hard to say. I mean, maybe if that's what your instincts are telling you, maybe you consider doing that. I will say, it's been 3 hours since the question was asked, and I was looking. The market's kind of made a comeback in the last 3 hours, especially the Nasdaq. So the short answer is you never really know what it's going to do. If you feel more comfortable waiting 5 days to buy, you can certainly do that. You could also tiptoe a little bit in and then wait a couple days and maybe buy a little bit more, depending on how you feel. There's lots of ways you could do this, but we don't really know what the market's going to do from minute to minute or day to day or even week to week. So it's kind of hard to make those determinations. But I think if a stock is a bargain, it's probably worth buying, even if it's possible for it to go down some more, or it might be a sell, even if it's possible for it to go up some more. You don't really know where things are going to go in the short term. So I think you have to keep that in mind all the time when you're investing.
There was a question from Gordon about the agreement to move forward with making more TSMC chips in the US. Is TSMC going to benefit? Yes, I think is probably the short answer for that. The challenge for TSMC is a very close relationship with the Taiwan government, and that has been a huge beneficiary for them. There's currency stuff that goes on there. There's all kinds of things that have helped TSMC grow in Taiwan. There's also geopolitical reasons that they want to have most of those leading edge fabs in Taiwan. My understanding is that even with this most recent announcement, is investment is going to be coming to the US, but it's not going to be like the leading edge chips. It's going to still be a few years behind. So if you're a TSMC investor, I of course like seeing diversification of where that supply is coming from, especially given the geopolitical risks that are coming from China. But don't necessarily read into that too much that, suddenly everything's going to change and they're going to move from being a Taiwan-based company to being a company that's making half their chips in the US. That's not really, I think, the way that this is going to play out. But probably good to be diversifying their production, and then having customers in the US too is going to be good for them.
Well, yeah, there's a lot of political pressure in the US to manufacture more chips here. Intel has more foundries than any other company, but TSMC makes the best chip, so it's natural that the U.S. government would want TSMC to be here, and it benefits TSMC also just for that geographical diversification, and if that looming geopolitical threats as well. So, and you also asked, would it hurt NVDA? I'm wondering if that's NVIDIA that was just
Yeah, that makes sense. I tried to look up what that. Yep, that's probably right.
Yeah. So yeah, it's I don't think it would. Well, assuming no invasion happens, I don't think it will. I don't think it hurts NVIDIA per se. I think the one thing to keep in mind is the U.S. is a more expensive country in general. Manufacturing is more expensive here. That could have a temporary inflationary effect on the chips made. Semiconductors by nature are deflationary. The longer you wait, the better the technology you'll buy for the same price. And that could temporarily change in the short term. But yeah, I think maybe the benefit of having that certain supply chain may make up for the higher cost.
Yeah, and I think the recent reports were that the chips that are coming out of the Arizona fab are pretty on par with what's coming out of Taiwan from a cost perspective. So it is one of those things where it's not, you can't compare all manufacturing on an apples to apples basis. You can't say, oh, it costs 3 times as much to make a shoe in the US as it does to make it in China, and then assume that it also costs 3 times as much to make a chip as it does in Taiwan. That's not really how it works, because you're still buying the same equipment, and the equipment is really the most expensive part.
True.
Really, for TSMC, the problem is the brain power. The brain power just doesn't exist in the US, and so they need to build that up. And so that's going to be a multi-decade kind of thing, because you need to have people like me when I was in engineering school wanting to go work at a TSMC fab, which that's if you grow up in Taiwan, my understanding anyways, is that that's a phenomenal job. That's getting like the cream of the crop job there. It'd be like moving to Silicon Valley and, working it for a great startup. I don't think that's how TSMC, at least today, is viewed in the US, but we'll see how that plays out in the future.
And it also takes several years to build a fab. So even if half of the production is coming here eventually, that's going to take years or possibly even decades. So I wouldn't expect any big changes anytime soon.
There was a question from Gator 5000. Any thoughts on Sirius XM? Buffett seems to keep buying, but other commentators are not as strong on the stock. I've looked at this one just based on Buffett's buys and going, oh, is there something interesting here? And I don't get it. I really don't get it. This reminds me of when he was buying a whole bunch of Paramount.
Yeah.
And I didn't understand that either. And I think he eventually abandoned that one. But you could maybe look at this as a value stock. I don't know exactly what happened with their net loss in the most recent year, but they're generally kind of consistently profitable. But if you just want a company that's generating cash flow and buying back stock or something like that, I think there are better options out there. And I don't understand what the competitive advantage is over a company like even Spotify is in a much better competitive position than Sirius XM. So
yeah, I'm like you. I tried to look at it, and I really don't get why Buffett's team would be interested. My only thought is that it could be the dividend. They don't. When you're investing at that level, you have $334 billion to play with. That will buy out most of the companies in the stock market. So any position that Buffett's team takes is going to get a lot of attention. So the serious dividend pays more than treasuries. I think that might be the interest. But they have I don't remember the proportion of the company they own, but they own a huge chunk of their stock already. So I don't expect too many more purchases unless they're just going to buy it outright.
Yeah, their yield is 4.3% right now. I don't know. Just he's made some interesting moves, and obviously he's not making all the moves. He's got his lieutenants there as well, but he's made some moves that I just look at and don't seem terribly Buffett-like to me. Ironically, Taiwan Semiconductor seemed like a really good opportunity. It seemed like a perfect kind of a Buffett stock.
Yeah.
Because it's such a valuable company in the world. Sirius XM doesn't seem to fall into that category, but maybe he sees something that I just completely don't.
Yeah.
There's a question here for me. What is the Celsius bear thesis? As I have a Celsius here next to me. Pretty simple. It's a very, very competitive environment. And if they're like the Celsius brand itself was losing market share, at least over the past quarter or so, based on kind of some of the survey data. So long term, they're gaining market share. They gained market share in 2024, but Q4 market share was probably lower than Q2. And this is the stuff that kind of ebbs and flows over time. So the bear case is their margins just deteriorate to the point where they're not the growth and high profitability business that we once thought they could be. I think the addition of Alani Nu, which they announced that acquisition, that'll close, I think, in a couple of quarters. That was actually a really compelling price. It was actually, I think, once the market kind of digested that, it was a little bit like, I was wondering too why they were selling for a price that was significantly lower than where Celsius itself was trading, even though Alani Nu was growing faster than Celsius. Was there something there that we were missing as investors, or was there or was it just the case where they wanted liquidity, they wanted to sell, and that was the best option as opposed to going public and going through that whole rigmarole? But yeah, I mean, it's a competitive market, and if their competitors, Rockstar and Red Bull are going to be the two big names, want to eat into their market share, they can lower their prices, they can introduce more products, they can lean on their distribution, all that kind of stuff. There's some sort of bottom, or at least there was, where they had a really good balance sheet. They're going to use up a bunch of that cash buying Alani Nu, but I think they're probably in a little bit better position now than they were a couple of quarters ago from a growth perspective anyways, with those two companies combined. But still a lot of questions ahead. So a lot that can, when you think everything has gone wrong that can go wrong, there can always be more that can go wrong operationally.
That is true. And I think the entire industry was slowing down too. I don't think it was just Celsius. So that's why they had the distribution issues. And also if the distribution issues go on longer than expected, that could be bearish. I am in Celsius stock. I am bullish, but it's things still could go wrong. So it's just one to keep watching.
Yep.
About 8 minutes ago, Ed asked, what tech sector has not been doing well that you are bullish on? Well, this is going to sound very strange, but I'm actually bullish on the semiconductor sector. You might think that's strange because NVIDIA has been doing so well, and I think that part of the business is at the top of the cycle. But the thing is, semiconductors are in so many things. It's not like 20 years ago where it was just PCs. It's smartphones, it's servers, it's 5G, it's IoT, it's a lot of things, and most of those sectors have been in a downturn now. One that comes to mind especially is Qualcomm. Qualcomm was doing well for a while. I mean, it still leads in terms of smartphone chipsets. It had taken a hit when the 5G upgrade cycle ran its course, and now it was hoping to revive itself with an AI upgrade cycle, and I think that's been partially successful. Looking at the PE ratio, it's only trading at about 17 times earnings right now. So it's one of the cheaper stocks in this industry. But with the DeepSeek breakthrough, I think there's going to be a lot more lower cost AI there. That's going to provide an incentive to upgrade to an AI enabled smartphone. I think with its low valuation and the fact that it's in other industries now, automotive has been especially strong. IoT, they're in the PC business now. So I think between the low valuation, AI and its other businesses, I think it can go up from here.
Yeah, some of the bigger companies, Alphabet is one that I have a nice position in. I think that's where there's opportunities. Some of these companies where investors are pricing in some sort of disruption happening, and I don't necessarily see, especially with AI, I don't see as much disruption as I think a lot of people do. I see it as more of what you would call a sustaining innovation, where we're just going to, the companies that own distribution today are going to be the same companies that own distribution 10 years from now. We're just going to be maybe using their products a little bit differently. But I'm still a little bit skeptical from a valuation standpoint to jump into some of the companies that I would maybe like to own in the tech space because the multiples are still extremely high. I'm not seeing, if we do have some sort of crash in the market, that's where I'm going to start to see a lot of deals out there. I'm just not really seeing them quite yet. There was a question for me that I think it would be good to get your thoughts on as well, Will. How are you approaching your cash position? What percent of net worth is indexed? I don't personally index anything that I have right now, partially because this is what I do, is look at stocks all day. So I feel like I'm better position to own the pieces of the market that I want to own and get the right kind of exposure. Same thing with the money that I manage for family, whether that's my parents or my kids. We're buying individual stocks there as well. So that's my personal decision. Not necessarily the right thing for everybody to do. Cash position, again, depends on, who we're talking about here. My parents, I've been building their cash position for the last year or so, when I look at the portfolio and I see stocks that are maybe highly valued, or maybe I don't like them as much as I used to, I've been taking some profits. A company like Apple, completely sold out of Apple, because Apple at 40 times earnings or whatever it was trading for and not growing at all was like here's a good opportunity to raise some cash and look for an opportunity in the future. I will change that if the market pulls back and we get some better opportunities. And just to kind of put that into context, when I'm talking about pulling back, I want to be able to be aggressive if we have a 2001, 2002 range pullback, or a 2008, 2009 pullback. The market dropping 5% to me is not all that compelling of a buying opportunity. So, and then for me personally and for my kids, we're adding cash every single month. So there's always cash to be invested. Sometimes that cash builds up for a couple of months, sometimes it doesn't. So that's something where, again, if we have some sort of pullback, I'll be more aggressive with what I'm adding to my portfolio each month, because that's when I'm going to see opportunities. And so yeah, those are kind of the things that the way that I'm thinking about those things personally, is it kind of depends on where I look at the long-term profile. But I generally stay almost 100% invested, and it would just be kind of what's added automatically each month, and then maybe forget about going into one of my accounts and allocating that money. But for the most part, I'm fully invested.
Yeah, I'm not indexed either, for the same reasons as Travis. I wouldn't necessarily recommend that for our audience, unless you just happen to be able to spend all day looking at stocks. I mean, not that I'm discouraging individual stocks per se, but if you don't have a lot of time to invest in it, or you don't have the interest, that would be an indication that you want to look at the indexes more. I am not fully invested. I've been burned too many times, so I haven't looked at the percentage lately, but I have about 25% or so in cash or cash equivalents. So I think one thing that concerned me is, Warren Buffett's Berkshire Hathaway. They have $354 billion in cash now. I really can't see a reason to have that cash, although you can have cash for a lot of reasons. I don't really see a reason besides they're waiting for lower stock prices and looking to invest then.
Yeah, that's a good point. And that's about what I have for my parents as well, who are kind of in that early retirement phase. And that's the other thing that's changed in the last couple of years is cash sitting there can earn 4 or 5% interest. That's fine. That's a decent return. I think it was much harder when interest rates were zero and cash sitting in a brokerage account or even in a savings account was just earning nothing. That was tough to watch. But yeah, if you got a sizable chunk of cash sitting there, you can get a nice little bit of interest every month.
Yeah.
I do want to note that and I think we talked about this on other shows, but based on our trading rules, there are stocks that we can't talk about. Will and I discussed that before the show, but if we are skipping some of your questions, not necessarily because we don't want to talk about them, but because we have trading restrictions on what we can discuss on some of these based on when we're trading stocks. So just wanted to note that.
Well, and I'm leaving in 5 minutes, so there'll be another host, and maybe the future host I think that we're seeing later today can probably address some of the stock questions that we cannot. So
exactly.
If you're not getting your questions answered, hang tight. I had one, even though it's not really AI. I found it interesting. 4 hours ago, Ed asked, "How will fast food restaurants fare if consumers cut back on their spending in comparison to retailers?" I actually think fast food will do quite well because, in good times, if you're going to the fancy steak or sushi houses, when times are tough, you're probably not going to stop going to restaurants completely because you just need to,
got to feed the kids.
Got to feed the kids. You got to do something a little different. So if anything, fast food restaurants like the McDonald's or the Chipotle's of the world, that may actually benefit in such times, because a lot of times the higher end restaurants will lose business to them. So I don't worry about fast food restaurants in times in down economic times.
Yeah, and one of the interesting things, and Target reported this morning. I haven't dove into that completely, but I looked at the high level numbers, and when the economy kind of slows down, especially for more budget conscious consumers, two of the companies that typically do pretty well, and I think are doing pretty well right now, are Walmart and McDonald's. So take that as a bit of a warning sign. When Walmart's saying, "Hey, everything's going great," that's telling you that people are not shopping at Restoration Hardware or at Target or kind of the higher end retail places. They're going to Walmart instead because they have lower prices. So as you kind of look across the retail landscape, there's a lot of moving pieces, and we still have some pandemic overhang. It's all kind of confusing to fully understand because there's not necessarily a direct line from here to there. But that's one of the things that I keep looking at is, okay, Walmart's growing at same store sales at like 5%, Target's growing at 1%. What is that telling us? They're both saying customers are being more budget conscious, but that is also telling you that people are shifting their spending towards Walmart, which is generally not going to be bullish for like GDP overall. General thoughts there. I was going to look at what same store sales were at system wide. Oh, comparable sales for Walmart or for McDonald's. I guess they're about flat right now. So maybe not looking all that great, but they were great during the pandemic. Ironically, when they were, I wonder if part of that is they had to lower prices because Walmart got a little over their skis with their, or because McDonald's got a little over their skis with their pricing during the pandemic. We noticed that as a family, right? Like you go through the McDonald's drive-through and it's like $50 to feed everybody. Like what?
Yeah, it sounds a little high for McDonald's.
Let's maybe not do that again. So that's come down noticeably in the periodic trips that we have going there.
Yeah, we have about 2 minutes left. And Ed asked again on the same vein. I like Dutch Brothers, but not at today's price. Do you think it could go back down to 50? That's always possible. I was looking at that when it was in the 20s and 30s, and kind of thinking I should pull the trigger and didn't. And I regret now that it was in the 80s after after their latest earnings. I haven't looked at it in a few days, but it's always possible it could fall back there. I think it's probably a little bit overvalued at its current price. Let's see. Well, it has fallen back some. It's at just under $73 a share right now. But I think that it's certainly possible. I would keep it on the watch list. With the market down over the last few days, it's probably even more possible. Yeah, but again, you don't really know when these stocks are going to bottom. So I think that's just to be determined.
I did want to address. Ed asked at the beginning of this show tonight. Donald Trump addresses Congress. So there's I don't know exactly what time it is, but there is a joint speech against the joint Congress. Will that be a lightning rod for stocks to move up tomorrow? Put simply, I have no idea. But I think one of the things that I'll be at least reading about, I'm not going to watch it, but trying to decipher is, do we get a little bit more clarity on sort of what the thoughts are, particularly on tariffs and some of the cost cuts that are going on in the government, the things that are causing consumers to maybe be a little bit more cautious this month than they were a couple of months ago, based on some of the survey data and things like that. Those are the things I'm going to be kind of watching for, and I'm sure investors will be watching for as well. Do I expect that there's going to be some specific pop? I mean, if there's something specific said that's going to be either phenomenal for the economy or terrible for the economy, maybe. But I don't. I guess I just don't. I try to take my logical brain into these sort of moments that are inherently very political, because oftentimes, and we're seeing this right now, oftentimes what happens with the market and what happens with the economy writ large is the opposite of what you would think. Because when you put that political hat on, it kind of clouds the judgment that you have. So I wouldn't read too much into it, but if there's something that's clarifying about some of the uncertainty that's happening in the market right now, maybe that will be helpful or hurt the market. But we just generally don't know.
Right. Okay. Well, here's Danny. So I will sign off. So Fool on, everyone.
Thank you, Will.
See you,
And
Will.
I'm going to stick on with Mr. Danny Vena.
How are you, Travis?
Good. We haven't been on a show for a little while, but some of the valuation stuff that we have talked about periodically has reared its head in the last couple of weeks. So
it is coming back, isn't it? We have talked about that.
So it is, it's an interesting. We're maybe not at the point where, I'm going to get super aggressive, but we are at the point where I am much more interested in some of the stocks that are at least on a watch list for me than I was even just a few weeks ago. Because if we do continue to see some sort of pullback, we're going to get a pullback in some of the names that I would like to own, but don't at this point.
Yeah, I was just looking at the chart for the, excuse me, the Magnificent Seven stocks, and I've actually noticed that there are two of them now that are looking relatively inexpensive, and it's two of the ones that I think are really positioned well for the future. And even one of the ones that we have talked about that is monstrously overpriced has come down, and it's still monstrously overpriced.
Yeah, so let's bring up so our topic for the hour is favorite and least favorite Mag 7 stocks. Do we want to start on the positive side, and we can get to the negative stuff a little bit later? What are the two stocks that you think are compelling at this point?
So from a valuation, I should probably back up for just a second and say, different parts of my brain talk to me when I am looking at potential investments. There's one part of my brain that says these two stocks are really undervalued right now, and they look potentially attractive in that way. There are other stocks that I look at and I say, that stock is not as undervalued as some of the others, but I think it has probably the best potential over the coming 3 to 5 years for capital gains. And then there are others that I look at and go, ooh, and it pays a dividend too. Different parts of the brain. But starting with, valuations, the two that look really almost dirt cheap right now are Alphabet and Meta Platforms. Tickers GOOGL and GOOG. And for Meta, META. Meta right now has a price to earnings ratio of less than 27. And Alphabet has a valuation of less than 21 times trailing 12-month earnings. Alphabet, I mean, I understand what's weighing on the stock, aside from the macroeconomic and geopolitical issues. Alphabet was taken to court for acting in a way that made it monopolistic, was charged with monopolistic practices. It was found guilty, and we're in that phase where the prosecution goes to the judge and say, these are the half a dozen potential remedies that I see as fair, and then the judge evaluates all those and makes a decision. Some investors fear that Alphabet will get broken up into a search company, a cloud company, a digital advertising company. And when it's broken up into these various pieces, it won't be as efficient or effective at its various jobs. I don't necessarily believe that narrative. I think that Alphabet, even if it gets broken up, will still be, several wonderful companies instead of one wonderful company.
It might be more valuable.
Absolutely.
Yeah.
Because you're going to unlock value, because these companies will be independent and So yeah, I think
Well, and arguably,
Alphabet-
to just hammer on that a little bit, arguably
Sure.
the thing that has held back Alphabet more than anything else is that they're not focused on making phenomenal products. So you look at like artificial intelligence, Gemini's fine, you know, but it should be better than all of these other companies because they have some of the best engineers, they have the best infrastructure, they've got all kinds of these kinds of advantages, like a bigger context window than all their competitors. But it just doesn't translate to a phenomenal product because those little things aren't the things that Alphabet generally focuses on because they're worried about monetizing search just a little bit better. That's a bigger needle mover for the company than making your app just slightly better. So that's been fundamentally a challenge for them for years. I mean, go back to like Google Drive should have like killed Office. But it didn't because they just don't care about it that much. So if you break it into a bunch of different companies, you put different managers in charge. I think it's very possible that they monetize better. That would be the same case as AT&T. I think when AT&T was broken up, that was ultimately more valuable as separate different companies than it was as a conglomerate. But sorry, that's my soapbox.
No, that's exactly what we're here for. So yeah, I think I completely agree with everything that you just said, and I think that because I mean, when you talk about a company that is the world leader in search, a company that is the world leader in digital advertising, is one of the big three in cloud computing. And I know our viewers have heard me say this again and again. I mean, this is a company that has compelling market positions in 3 different areas, and yet it's selling for, what did I just say? 21 times trailing 12 months earnings. I don't see it. I think that's ridiculous.
Yeah. At what point, I put this question out on Twitter, I think, a couple hours ago. At what point is Alphabet just a complete no-brainer?
From my perspective, I think the valuation could still tick lower, as could the price, over the coming.
It always can, but like I'm constantly reminded of this. It can always go lower.
My favorite economist, John Maynard Keynes, the market can remain
Irrational.
There you go. Longer than you can remain solvent.
Yeah.
So yeah, I think it's important to remember that it can go lower. I don't think we're that far from no-brainer. I think we're in a bargain territory right now, and I don't think we're that far from no-brainer. I don't think Alphabet ever gets to, let's say, mid to low double-digit PE ratio. I think the market will go, yeah, no, that's crazy, and start buying the stock up.
I think it's been so long since we've actually had a real recession that we forget how crazy things get during recessions. And this is one of those. I don't know what the next 6 months or year, or 18 months or whatever holds. But if we do have a recession and the market pulls back and everything is sold off, this is this time to start looking at what are the really phenomenal companies that you maybe don't own or you don't own enough of, and go, what is that price where like I would go, what did I miss here? Because it will happen. It will happen eventually again. And so I was just sort of going through that process. And I mean, I remember in 2008 or 2009, Apple stock trading for single digit price to earnings multiple. I mean, the iPhone was new. Like I was in the cohort of people who was buying iPhone and the iPhone early on. That was crazy. But it happened. And even when you're buying a stock that good of a company for that low of a price, you still feel uneasy because the stock is going down and you're going, what am I missing? So I could see the stock falling to, yeah. I mean, I think the lowest I put on my question was a 12 price to earnings multiple. I don't think that's not going to happen ever. But if it does, man, that would be a back the truck up kind of moment. Because I agree. I think that's my top out of the 7 stocks in the Mag 7.
You know, I just went and looked over the past 5 years. Alphabet's low, which was during the recent recession, it had a PE of 16.5, and its
Mhm.
high is
You're talking during the pandemic?
37.7. So, we're not terribly far from its lowest point in the past 5 years, and in the most recent recession. So yeah, it's getting compelling.
And your number 2 is Meta.
My number 2 is Meta. Meta is also one of these companies that basically dominate their marketplace. Some would argue that they have some competition from YouTube. They have some competition from TikTok, but they are unmatched in terms of their user base. We're talking more than 3 billion people visit the platform or one of their social media platforms regularly, whether it's Facebook, or if it's Instagram, or if it's WhatsApp. A lot of people go to Meta's site. Now, right now, Meta Platforms is trading for an interesting valuation. It's 27. Now, this one could fall quite a bit further than what we were talking about with Alphabet, based on historical averages.
It's just kind of more volatile business too. I just want to highlight, Alphabet now is a very, very diverse business. Meta's still an advertising business, and it's got a
digital
couple of apps.
advertising.
Yeah.
And in late 2022, its PE fell to below 9. It was like 8.5 in late 2022. So I mean, that was a steal back then. And I don't remember exactly at what point during the steal, but I know that at some point in 2022, I said, "Yeah, this is crazy," and I doubled down on my position in Meta Platforms, because we know that during a recession and during economic uncertainty, the first thing companies do is they cut back on their spending. And generally, the first place they cut back on spending is advertising, because you're in a tough situation. Consumers are spending less money, and advertisers, as a result, are paring back on their ad spending. And as soon as you hit that trough, spending on advertising tends to pick up rapidly. And that's what we saw in late 2022 with Meta Platforms. And it went from a low of a PE of 9, and it shot up in less than a year to a PE of 38. So
again, know which companies are the phenomenal companies that when the market goes crazy, what do you want to buy?
And you want to buy something with a proven track record, and something that was hit harder than some of their peers during.
Well, remember that was ATT too, which was a direct shot across the bow from Apple at Meta Platforms specifically.
So yeah, those are my two. Now, I wanted to say that that, like you pointed out, still much more volatile. It still could go down to a PE of below 9 if we end up in a recession. That said, that's the reason for having this list that you so eloquently alluded to, which is know exactly what the stocks are that you plan to pounce on when you're looking at the world and the market believes that the sky is falling.
Ed put in rankings for the top 7. So I think if anybody wants to put that in Slido, sli.do, code is Fool24. I think that would be interesting to see what people's rankings are. Ed has Alphabet, Amazon, Meta, NVIDIA, Microsoft, Apple, and Tesla from top to bottom. I was looking at, would I change any of those? One of the ones I can't wrap my head around right now is Amazon. And the reason for that is so much of their growth an increase in profitability over the last few years has been because of advertising. And I think advertising is one of those things that really looks really good on the financials, and it's a horrible user experience, and it's making their business worse, but making their financials better. And that's a trade-off that I don't really like. And
So when you say making their business worth, can you kind of expand on that a little bit?
yeah, so when you go into Amazon and you search for something, towels, the first 5 things you see are sponsored advertisements.
Right.
So you have to really scroll down. Just it's just like the 10 blue links on Google, but it's almost like more in your face than Google. And I don't know if that's just a perception thing or not. Part of it is that if I'm going to Amazon, I'm looking for something specific, and I don't necessarily want to see an ad for something that's like a Chinese knockoff of. That's
what you're looking for.
What's that?
You don't want to see an ad for a Chinese knockoff of what you're actually looking for.
Of what I'm actually looking for. Right. And Amazon was always, it's like the consumer experience first company, and that just kind of goes against that. The other thing, what it ends up doing is it makes the user experience worse, but it makes the seller experience terrible, because now the seller has to figure out how to advertise in that market, and it squeezes their margins. And so now you have a world where if you have a really good brand, you actually don't want to be on Amazon, because you don't want to be in a scenario where somebody goes out to Amazon to look for your products and they see someone else's products there first because they paid to bump, or you have to pay to be at the top of the list if somebody is searching for your products. It's just sort of it creates weird incentives in the ecosystem. And now that Amazon is primarily a third-party seller ecosystem, they are not actually buying and holding inventory themselves. They're counting on other people to buy that inventory and then hold it in their warehouses. It creates sort of a loop of deteriorating experiences to me. So that's where I just become kind of uncomfortable with that situation. And I think we've already seen their US business. You take out the advertising, and the US retail business isn't profitable or is break even. It's so you're
Flat.
basically buying AWS from a profitability standpoint. And I don't know. I think I would rather own Alphabet, but I'm of many minds with Amazon, but I've been wrong on Amazon for 15 years. So take that with
Well, and I still own Amazon, and I don't plan on selling any of my Amazon shares. But that said, to your point, they've done the same thing with Prime Video. Prime Video is something that has always been a benefit to Amazon Prime members that you just got. Yes, you went for the free shipping, and you stay for the Prime Video and the Prime Music and some of the other little benefits, the Kindle. But yet recently, actually earlier this year, Amazon decided that the default in Prime Video is going to be advertising.
Yep.
And so depending on how, and I haven't entirely cracked the code, but it seems like to me that the more popular a program is, the more likely it is to have advertising and more likely to have more advertising, which kind of makes sense, because that's the ones that are going to get the most eyeballs. And now you can still opt out of that. And when they first said $3 a month.
Yeah.
And when they first said that, I went, I'm already paying Amazon enough. I'm not watching that. But the first few times that I went to Prime Video to watch something, and I got those ads in my face, and it was always the stuff that I wanted to watch that had the ads, I finally said, you know what, for $36 a year, I'll just pay it so I don't have to deal with the ads. And my wife, who likes watching episodic, ghost programs, she was on board with it immediately. So that's another place where Amazon is making money from their advertising, but they also have IMDb, which is the Internet Movie Database website. So they get advertising there. They get advertising for National Football League programming and other live event programming that they automatically have commercials. So there's a lot of different places that they're getting that advertising dollars from, and you're right, it does look good on the business. And last time I checked, I'm just going to pull up Amazon's. So advertising services looks like in the most recent quarter, it was up 18% year over year. And they're now getting in the neighborhood of about 17 billion a quarter. So that's not bad for a side business. Although, when you look at Amazon's overall business, AWS has 28 billion in a quarter. And the net sales of e-commerce was like 115 billion in the most recent quarter. So
bigger than Walmart now, I believe.
So I read.
Yeah, it's the other analogy here would be that I, again, also am a little bit uncomfortable with is Apple, which I think is probably more naturally a little bit lower on people's lists, especially if you look at the valuation. Apple currently trading for price to earnings multiple of 38.5, forward price to earnings multiple of 32 for a company that's either no growth or negative growth. I guess their 3-year growth rate is 1.5%. The only thing that's growing in their business is their services business, which, just like Amazon's advertising business, is essentially a tax on the stuff that's going on their platform. Again, not saying that's a bad business. I'm just uncomfortable with that being the value driver, because that's kind of like the end state. That means that you have you've grown as far as you can, and now you need to start extracting value from the ecosystem that you built. That positioning makes me uncomfortable. There's a question that came in about, based on my comments, would I prefer Shopify over Amazon? I would prefer Shopify's business over Amazon. I have never owned Shopify, in part because their valuation is just something I've never, again, this would be on my list of companies. If Shopify's stock drops 70%, I'm in. But their current price to earnings multiple is 72. Their forward price to earnings multiple is 75. Price to enterprise value to sales is 15. Those are just prices I generally am not going to pay for a stock to buy today. So that's just generally where I'm thinking about valuations. But again, that it would be on my list of, if that stock gets, craters for some reason, we go through another great financial crisis, that's going to be on my short list of companies that I want to own that I've never actually bought.
So another question, this one came in from Jimbo, has a question. How low will the trade desk, ticker TTD, fall? How will the trade desk fare in a recession? I'll start with the second question first. How will the trade desk fare during a recession? Depends on whether you're talking about the stock price or whether you're talking about the business. The stock price lost, I would estimate, somewhere between half and 2/3 of its value during the most recent recession. That's just what happened. That's the way it is. I haven't actually looked. Let's see. I'm going to go back 5 years.
I've got the numbers. Are you looking for the drawdown?
Yeah, it looked like it lost like 66% of its value in late 2022.
Right, middle of the year. Yep, it hit its low. Yep.
So that's how will the trade desk fare during a recession? The stock could fall as much as 2/3, 66% of its value.
It's already down 51%.
51%,
Yep.
Starting to get intriguing. How low will the trade desk fall? I don't know the answer to that. I don't know that anybody knows the answer to that. However, I think when you get to a point where the valuation starts to look silly, then I think there is the potential there for the stock to start rebounding, simply because investors are going, well, that doesn't make any sense. Now, you have to understand, though, with the trade desk, is this is a stock that has never been particularly cheap.
Right. Right.
If you look at it now, it's let's see, over the
Enterprise value to
past,
sales is still 13. So it dropped 51%, and the enterprise value to sales is still 13.
and you know, price to earnings is still
90.
pricey. I mean, we're talking its price to earnings dropped to 88. Its forward price to earnings dropped to 38. But if you go back and look at the trough between 21 and 2022, it's actually as cheap or cheaper now than it was during the recession. How much lower can it go? It can certainly go lower. History tells us that. But I think we're getting to the point. I think sometime between now and the next earnings, unless we have a recession or a black swan event, with those as the qualifier, sometime over the next, say, 2 months, I think the trade desk will bottom out and begin to rebound. And if I hadn't done it during the last recession, I would certainly be considering adding to the trade desk position. Although right now it's still my 7th largest position, and there's no need to add to it because it's doing the heavy lifting.
Yeah, and it's one of those companies that just continues to compound their revenue growth year after year. So, yeah, it's becoming much more intriguing to me. I hadn't actually looked at this in a little bit, so I'm surprised it's down as much as it is. But that is now I got to go do a little bit more homework. Let's get back to we talked about our favorites. We're about halfway through the show. Let's talk about the companies who are on the bottom of our list in the Mag 7. Do you want to start, Danny?
I have a feeling this is going to end up being dogpile on the rabbit.
Oh, no.
So a company that was one that I have admired for a long time has become a company that I'm troubled by.
What company is that, Danny?
What's that?
What company is that, Danny?
That would be Tesla. Tesla is a stock that I bought many years ago. The stock has performed remarkably well. I believe at the time that the company came out, there was a fairly simple investing thesis. This was like the first car company to, excuse me, the first car company to, be created from scratch in the United States in a long time. They were groundbreaking in the demand for their electric vehicles. And right place, right time, right audience, right product, and has done remarkably well. Now, in recent months and or quarters, demand has begun to fall off. Demand is not growing what it was once. Now, part of that has to do with when do you get to the point where the market that you are targeting is saturated to a point where your growth begins to slow. Mm-hmm. And also, we have the politification of Elon Musk. I'll call it that for lack of a better term. Elon Musk has jumped into the political arena with both feet. We are in a highly polarizing political environment, which means half the people in the country love what Elon Musk is doing, and half the people in the country hate what Elon Musk is doing. That's an oversimplification, and the numbers are probably not that. But if you take that as a given, you're alienating half of your potential market by getting into the political arena. I'm not saying whether he's right or wrong, although I have an opinion on that. But I do think that what he is doing as the leader of a company is damaging to the company and to the company's brand. We've seen sales in Europe fall off a cliff.
Yeah, can I put the numbers on this?
Please.
January sales of Tesla vehicles down 46%. I wanted to get the exact number here for February, because only a couple of countries have actually reported so far. But the countries that have, which includes France, Norway, Sweden, and Denmark, down 38% in February from a year ago. Now, there are a couple of explainers, like they're updating the Model Y, so maybe there's not enough inventory. But I'm going to add to that, because Europe, yes, you're right. All of that stuff plays in, and you're talking about, polarization in the US. I think the response in Europe is even more exaggerated as far as like Tesla's brand deterioration in Europe. The one that's more important, because this is the only area that Tesla grew in 2024, is
China. Are you talking about China?
Yeah. My Reuters article keeps crashing. So their sales in February, I believe, were down 49% from a year ago. And their January through February production or deliveries from their Chinese factory was down. I'll get the exact number here in just a second, but was down
a lot,
28.7% year over year. So, and by the way, that's not just, there's the same explainers, but BYD was up 90% in that period of time. So this is a Tesla specific thing that is going on, and it has been going on, by the way, for years. Their demand and their margins have been declining since the end of 2022.
And if you look at the fact that Elon Musk is now in the political arena, and the person that he has joined himself to at the hip, President Donald J. Trump, is waging an all-out tariff war, and one of the biggest countries impacted by that trade war is China. There is a lot of national pride and unity in China. Yep. And when they see the United States as the aggressor in a trade war, that is of necessity going to negatively impact sales of products from the United States, Tesla's included.
I want to pull something up here just a second. But here's the other piece that I think we often lose is just, and we have to understand that Tesla is run very specifically. They use a business model that really Apple kind of pioneered, Steve Jobs kind of pioneered, or at least popularized, where the person at the top makes all the decisions. They're the editor, if you will. So you have a whole bunch of smart people underneath. They're doing stuff. They're doing smart people stuff, but they're not making a decision on like, are we going to make the Cybertruck look the way the Cybertruck looks? That is ultimately Elon Musk's decision. Can you tell me what vehicle this is right here?
I cannot.
Okay, this is a Tesla Model S. Can you tell me what year it is from?
I cannot.
That's my point. This is a 2012 Model S. 2012, 13 years ago. And the style has not, basically the style has not changed in 13 years. We're running into this point with electric vehicles and with Tesla specifically, where the auto industry works in a certain way in a certain cycle that if you're outside the auto industry seems archaic. But if you're in the auto industry or you're a consumer, that's the way things work because it works. Like, you don't want to sell the same vehicle that you were selling 20 years ago or the same look that you had 20 years ago because people get bored. People don't want to have the same vehicle that their neighbors have because that's boring. People want to have a vehicle that where when you drive by somebody, you go, "Oh, what is that? What's that one? What is Danny driving?"
Oh, that's
today?
a new one. That's
a new one. Danny's got a convertible. That's what we want in vehicles. Time to get a convertible, Danny. And if you look at their growth, they grew through basically the saturation of the market of the Model 3 and the Model Y. And then once that market got saturated, they haven't done anything else because their structure is not a divisional structure. They don't go, okay, Model 3 team, we got to update the Model 3. What are we going to do? All the people moved to the Cybertruck. And then the Cybertruck, I think it's pretty easy to say it's flopped at this point.
Bombed.
You know, then people move to FSD. Well, we got to make FSD and the robotaxi. FSD is not anywhere near the point where it's actually going to be fully autonomous or doing, you know, autonomous drives in a robotaxi. So your business model and the structure of your business can be a point of strength or it can be a point of weakness. And that was a real point of strength for a long time for Tesla because they just needed to push the Model 3 out. Once we get the Model 3 out, we'll hit this growth curve, yada, 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 profitability. But now we're at the point where they're a scaled company and they need to refresh their models. And they need to refresh them in ways that companies often do every 6, 7, 8 years. And they're just not doing it. And now, and at the same time, other manufacturers are coming to the market with really compelling electric vehicles. And, you know, that add that to everything that you talked about, and demand goes down for Tesla vehicles. Their margins go down. And at the end of the day, they're a manufacturing company and they live by the laws of supply and demand.
Now, there is one other potential issue with Tesla. No. And this is probably one of your favorite issues to talk about, I think. And that is, what is Tesla's valuation compared to some of its peers?
Do you want to pull it up here, or do you want me to grab it?
I was actually getting ready to. I have to pull the min and max lines off my chart here, so that you know, we can have a clean chart to look at.
And by the way, those peers have similar margins now, potentially, depending on what happens in 2025, have potentially higher margins. So just wanted to point that out, because that was always the story, right? Tesla is going to be more profitable. That hasn't been the case.
All right, I'm sharing my screen here, and this is the valuations of the Magnificent Seven stocks. And that big green line that you see is Tesla.
Are we doing? Is this price to sales or price to earnings?
This is price to earnings, trailing 12-month price to earnings. And that green line is Tesla. And Tesla has always been expensive. It's less expensive now, but if you look at it, it is selling for 137 times earnings, when NVIDIA, whose growth is much more impressive than Tesla, has a PE of 40. So,
all right, now, I want you to add a couple things. Let's add a little bit more context to this. Can you go down to like the 1 year or 3 year chart?
All right, let's change this to a 1 year chart.
And
wait for it to catch up.
Yeah. So, and then do price to sales instead of price to earnings.
Yeah, we can do that as well.
All right. Now we're gonna go crazy here. Can we put GM and Ford in there instead of
GM and Ford?
Yeah, and just click off the tech stocks.
Yep.
Oh, Ford is the other Ford. If I can see that correctly.
Oh, sorry.
F, not Ford. For some reason.
Just not fast enough.
Okay, and you're still on price to sales, right?
Still on price to sales.
Okay, so scroll up there so we can see it. Look at the premium price to sales multiple of Tesla versus their most direct competitors in the auto industry.
So more than 10 times.
Yeah, is that what it is? What are they at right now? I can't see that. Quite see the number.
Yeah, I have it as large as it goes. So right now, GM has a price to sales ratio of 0.28, and Ford has a PS ratio of 0.20.
Yeah, and what's Tesla?
10.
Okay, so 30 times more expensive. 30 or 40. I guess 50 if we're looking at
30 or 50 times more expensive.
Yeah, 30 to 50 times more expensive. And their economics on selling cars is not as good.
And now we have issues with the politification of Elon Musk, of declining sales in China, declining sales in Europe,
and the US.
Nobody at the helm steering the ship.
Yeah. The other thing I want to add is the subsidy piece, which is something we don't talk about a lot. But one of the things that's been touted for a long time is the energy sector for Tesla. The energy business is the profitability of the energy business is almost entirely driven by subsidies. So if there's a policy change, in the next year or so, which that has been promised, I'm not talking about the $7,500 tax credit. I'm talking about the production tax credit for making batteries in the U.S. and all that kind of stuff. Tesla was a massive, massive beneficiary of that. That will subside over time as other competitors come into the market, but that profitability could dry up. And there's even questions about I was reading yesterday about the profit pool or the tax credit pool that that Volkswagen, Ford, and another automaker have with Tesla related to the EV credits that they have to have in Europe. And basically Tesla may not meet their requirements for that agreement. So that's very possible that will ding what is basically a 100% margin business, which is that credit sales.
And if you lose that, then your sales fall off a cliff even more.
No, but that's just like if you look at their profitability, like half of their profitability is just that EV credit sales. Because I think I have the number somewhere. It was like $2.6 billion in the last year. Automotive regulatory credits, $2.76 billion in the past year was their regulatory credit sales, and their net income over that time was $7.1 billion. So about a third of profitability comes from those credits. Yeah, no, I'm with you. And look, you could have made a lot of these arguments a long time ago. I think what's become clear is kind of the deterioration of the focus of the company and the innovation and the level of competition, frankly. You go out there, if you want to look at an EV right now, you go out there, there's a lot of options, and there's a lot of really compelling options. I'm going to convince my wife to get an ID Buzz eventually, but we're not quite there yet.
All right, so this question from Ed: what are the safest Magnificent Seven stocks? He put several potential possibilities in there. I'm curious what yours are.
The safest Mag 7 stocks.
Now he proposes Microsoft, Amazon, Google, maybe Apple.
Here's the reason I don't think Apple is all that safe is you have the problem of not only potential operational decline, pretty easy to put off a $1,000 phone purchase for another year.
Right.
But two, you have the potential for massive multiple compression. I think, Alphabet falls into the safest category in my eyes. Microsoft is probably up there. Yeah, I guess I agree with that. Yeah, I would maybe go Alphabet, Microsoft, Amazon. Sure. I'll go Microsoft.
And now my question is, when you say safest, are you talking safest from the potential of the stock price falling off a cliff?
Yeah,
Or
I guess
are you
my
talking-
interpretation is, let's say we do go through a market correction and maybe even a recession in the next year or two, which ones are going to hold on the best? And that would be the way that I would look at it. Because it's very possible. I mean, NVIDIA has been on such a growth tear that if all these companies, and they've got a handful of customers that account for a huge percentage of their sales, if all of them just go, you know, we're not going to spend much next year,
right?
they could have both sales decline and massive multiple correction. So I'm looking at sort of both of those things. What is the odds that the operations are hurt? Microsoft is a pretty sticky business. Same thing with Alphabet, and their multiples are not quite as crazy as some of those things. So those two combined would be what I would be looking at.
Yeah, I think of the seven, I'm throwing Tesla right out the window. I would say, yeah, safest in terms of if there's a recession, NVIDIA certainly falls off pretty quickly. I would say, I don't want to dismiss Apple out of hand, because even though you had, we had a recession, Apple was still able to maintain a level of growth that was surprising, given that they have a $1,000 product. They were able to make up a little bit of what they lost in iPhone sales from services. And so the stock didn't get hit quite as badly. The revenue and earnings didn't get hit that badly. And from a safety perspective, Apple has a ridiculous amount of cash on hand, and bringing in more regularly. So
although they
think
keep spending it on their very expensive stock.
So, yeah, well, they said they were a couple of years ago. I think the narrative was that they were trying to get to net zero in terms of bringing their stock ownership down, and basically having their cash flow be zero. I haven't paid that much attention to it lately. I know not everybody takes to his style, but Wedbush analyst Dan Ives estimates that there are about 40% of the active iPhones out there have not been upgraded in about 4 years, which means the pool of potential upgrades is pretty high. So
my grandma's not going to upgrade her iPhone anytime soon. I've asked.
Your grandma's not, but I'll tell you what, there are a lot of people's kids who are.
Possible. I just can't trust somebody who wears Hawaiian shirts like that. So that's the
what?
No. Yeah, there's always like these weird arguments for how Apple's gonna grow next year because something, and you dig up some random fact like that, and it just doesn't happen, partially because like it's just the products they're fine, the new ones are fine. I don't know. I had my last iPhone for 3 years, and the only reason I upgraded because I use it for video, and the camera was good enough that might as well get a new phone rather than buying a camera. So I don't think most people are using it for the same thing.
I have a really good question here from Ajit Jain about 3 minutes ago. Which one is a buy between Google stock GOOG and ticker GOOGL? I'm not able to figure out the difference. So the difference has to do with Class A stock and Class C stock. And I always have to look it up because I just don't pay attention well enough. And it doesn't stick in my memory. So ticker GOOG is Class stock, and ticker GOOGL is Class A stock. Now, the difference between those has to do with voting rights.
GOG has no voting. Is that what you got?
Yeah, I was looking to make sure. So GOOG has no voting rights. Ticker GOOGL has voting rights, but from a performance standpoint, the stock. I think at one point there was an argument for pulling up the two charts side by side so I can look at them again. But at one point, there was an argument for buying GOOG because it was had not performed as well as GOOGL. But right now, if you look at the stock chart going back 3 years and going back 5 years, they've essentially been in lockstep.
Yeah.
And there's only a few cents difference between the price of the shares. So my take on that is there's not one of them that's much cheaper than the other. So it depends on how you feel about voting rights.
But I will add this: your vote, as with a lot of tech companies, doesn't really matter because you're not buying Class B shares, which is what Larry and Sergey have, and they have most of the voting rights for the stock. So, yeah, to be fair, I think I only own the Class C, the GOOG, just because that's what I bought. No rhyme or reason. But if I were to optimize a little bit better, I would just buy the one that's maybe a couple cents cheaper, because typically there's a couple cents between them, but there's really no difference.
And if you go back and look at the stock chart between 2021 and 2022, there were a couple of periods there where one outpaced the other one, and then they switched places.
Yeah.
And then the other one outpaced the other. So unless it's one of those periods, I would say it really doesn't make much difference. If you want to vote your shares, I would certainly buy the GOOGL. If you don't care, buy the GOOG. And to Travis's point, if Larry and Sergey decide that they want to do what they want to do, your vote probably doesn't count that much.
It's like voting in Meta's votes. You know, what are Zuckerberg's like 100 to 1 or something like that? He's got some super hyper voting rights on his shares. What Jimbo asked a question, what happened to the idea that Tesla is more than a car company? I've never bought that. So I know that's the story, and that's the story that they want to tell. But at the end of the day, if Tesla stops selling cars, they don't have a business. I mean, that's a car company to me.
And it really depends on who you are as an investor. I know some people that are diehard believers that Tesla is going to be the first company to come out with a mass market robo-taxi, and as such is going to dominate that market. Cathie Wood is certainly among those. Cathie Wood is the founder and CEO of ARK Investment Management. There are other people who equally just don't believe it's ever going to get off the ground because the company is trying to focus on too many other things at once, and Elon is trying to focus on too many other things at once. And so, yes, that's an argument, but I mean, you have to believe that in order to say, I'm buying Tesla at this point, because its current car sales, which have been keeping the company afloat for all these years, while it works towards that narrative that Travis was talking about, those sales are falling off the cliff. And so, if your sales in China are down, what did you say, 80%? 90%?
50% in the month, and I think 30% for so far this year.
Okay. And they're falling in Europe as well. I think there's a problem. And if you don't keep up with the sales of your current product, then you get into a situation where you may not have the money to continue to do the development that you need to do in order to get that robo-taxi to fruition.
Yeah, and the thing that I like to say is the way to make money as an investor is to buy companies with upside you don't have to pay for. So what is the optionality that you don't have to pay for? One of the reasons I bought shares of GM a couple of years ago is, hey, I'm buying shares of GM at 4 times earnings. They're buying back 20% of their stock, on an annualized basis. At worst, I own GM and it's a cash flow machine, but at best, they figure out this cruise thing and they become a leader in autonomous driving. That didn't work out, but I didn't pay for a business that didn't yet exist. And so I still made a really nice profit because I bought kind of a value stock and just kind of rode it a little bit higher. Tesla, you are paying for FSD, a robotaxi, and an Optimus business that don't yet exist. And my personal take is, and look, I'm looking for investments that are 10x opportunities, but you're paying for that opportunity. And just think about what happens to Tesla stock if they don't become a leader in robotaxis and Optimus is not a profitable business 10 years from now. What happens to the stock in the meantime? You're paying for a lot of business that doesn't exist yet. So I think there's a lot more risk there than there appears to have been over the past few years. And those of us who kind of follow the fundamentals have been scratching our heads for a long time with this one. And so maybe that valuation is coming home to roost.
So we have a question from Matt, and I have an opinion on the matter, and we'll see what Travis has to say since both our names are on it. How concerned are you about some activist investors ratcheting up the pressure on Portillo's, ticker PTLO? Portillo's is a company that I own. It is a fast casual chain that originated in Chicago, and they are one of the fastest growing regional chains. They have an average unit volume that is well ahead of all of their competitors. And I didn't even know about this, but I was just looking at a headline, and apparently activist investor company Engaged Capital has nominated 2 directors to Portillo's 8-member board and have acquired a 7.3% stake in the company. And they're looking for an increase in restaurant level performance, which I think is an interesting characterization, since their restaurant level performance already outpaces all of their, not only fast casual, but many of their fast food peers. They're looking for modernizing outdated locations and strengthening their national marketing. So whenever I see a activist investor coming on the scene, I usually don't like it because 9 times out of 10, it's a distraction for management. Instead of management paying attention to their knitting and paying attention to, in growing their revenue, growing their earnings, increasing the store count, increasing their same store sales, they're worried about their activist investor. I think it's going to depend on shareholders to decide whether or not, this is something that they want management distracted by. When it comes to voting, I almost always vote with management unless it's something egregious. I think Portillo's is doing just fine. I don't think they need any activist investor getting up in their business. So I personally plan to vote against their slate of board members if given the opportunity. So with that, I think I've run us out of time, and I think Jose is going to be joining me here in a moment, and I think Travis is going.
All right. Well, enjoy your time, Jose. Thanks. That was a fun hour, Danny. Sorry, we got a little riled up a couple times.
Indeed. Well, that's what makes it fun. Jose, it is
Hey,
good to
Danny,
see you,
how's it
my
going?
friend.
Yep. Pretty excited for today's episode.
We actually, Travis and I were talking a little bit about valuations in the last hour, but surprisingly, we stayed away from the two companies that you and I are primarily going to talk about, which at this point is NVIDIA and Palantir, tickers NVDA and PLTR. However, that said, viewers, feel free to, if you have questions about valuation in general, if you have questions about valuations of some of these companies we're going to talk about, or anything else for that matter, feel free to get those into Slido, sli.do, and Fool24. And I would also say, I wanted to take a minute and talk about valuation. I would love to hear your take on it too, Jose, because there are a lot of people that swear by valuations and primarily swear by price to earnings ratio or price to sales ratio. But there are limitations to what those valuations can tell you about a company. For me, PE ratio or price to earnings ratio is an important valuation metric, but also it's looking backwards and it's telling you about stuff that's happened for the previous 12 months, whereas the stock market in general is a forward-looking mechanism. And so that kind of, can cause some issues where a valuation might not necessarily reflect the direction of the business. What do you think, Jose?
Yeah, Danny, so I agree. I think valuation metrics, especially trailing 12 months, are not my favorite. I want to say I do look at valuation metrics mainly forward basis, Danny, but they also come with their own kind of caveat, right? These forward-based PE ratios or price to sales ratio are ones that are determined more on analyst expectations, right? And sometimes the thing there is, are analyst expectations either one, too bullish, or two, they could be too bearish, or maybe somewhere in between, they might just be just right. But when I look at ratios, Danny, I try to more understand. I use it to understand the following: how is the company being valued? So if I see kind of like high forward PE ratios, I'm not at one point looking exactly at the actual value, but if it's a high forward PE ratio, I'm like, okay, this is a company that's valued at the moment as a high growth player. So this is something that the market is going to be very crucial about in things like earnings and stuff like that. And with these high PE ratios, obviously you can have quarters where they might not represent the type of growth that's expected in them, that you can kind of see these massive volatility moves in the stock price. So I look more at the PE ratios, Danny, for a few things. Like I mentioned first, more to understand how the market is looking at this kind of company. Then I do want to say the company that I follow pretty well, I try to see how well analysts are at kind of projecting their forward earnings. Like about a year ago, maybe 2 years ago, when NVIDIA was kind of seeing this boom in AI revenue, no one knew exactly how much this company can grow. But over time, I think analysts that follow the space, Danny, have understand the supply chain a lot more than previously expected. So now those expectations, while they can be wrong, are a lot closer than how they previously have been. So maybe I might look at the valuations and say, hey, look, I believe maybe the overall market, based on my knowledge, might be underestimating. So then I can kind of look at that PE ratio and determine how I really see it. So I think PE ratio is a great tool, but you need to have other tools to kind of really, or just price to sales ratio, any ratio in general. It's a good tool, but you need a whole toolbox to make it really work and to be able to kind of like finish building whatever you need with that toolbox.
That's a great segue, because one of the other things that I wanted to talk about was another ratio. And one of the ones that I really like to use, particularly when you're talking about high growth companies, and that is price to earnings growth ratio. And what's interesting about this is, if you have a company that is growing very quickly, one of the shortfalls of price PE ratio and PS ratio, price to earnings and price to sales, is that they don't necessarily, capture, they're not really geared towards correctly evaluating a stock that is growing quickly, because again, if you're looking in the past, you've got earnings that happened over the previous 12 months, which obviously for a fast growing stock, that's not representative of what's happening over the coming year. And the other point is that if to Jose's point, if you have Wall Street estimating the company's growth, and Wall Street isn't doing a very good job of estimating that growth, then the PE ratio and the PS ratio can fall short. And so that's why I like to use the price to earnings growth ratio, because and it's commonly called the PEG ratio or PEG ratio. And what the PEG ratio does, it goes a step further than the PE ratio, and it divides the stock's price by its earnings per share, which gets you to the PE ratio, but then it's divided by the expected earnings per share growth rate going forward. And generally speaking, if you have a stock that has a PEG ratio of less than 1, then you generally have a stock that is considered to be undervalued. But what's great about that is a lot of times you'll have a stock, and like NVIDIA is a great example. NVIDIA currently has I'm going to pull up a couple of ratios here real quickly so that I can talk intelligently or more intelligently. So just talking about NVIDIA right now. So it has a PE ratio of 40, which, seems kind of high, but it has a forward PE of 26, which is actually beginning to look a little compelling to me. And if you look at its PEG ratio is 0.27 right now. And since that's less than 1, that kind of points to a stock that may be undervalued in terms of its growth rate. So, Jose, I wonder what other ratios do you like to use besides the forward PE and PS ratio for determining, whether or not you think a stock is a good buy?
Yeah. Yeah, Danny. First, a question here on the PEG ratio. I've heard about it a lot, but it's when I don't use it. Sometimes I just stay with my kind of simple metrics. I still feel like this is pretty simple as well. But like you mentioned, NVIDIA's PEG ratio was about 0.27 for this trailing 12 months. How should an investor look at it when and you mentioned anything under one is really exciting. How should we see it where I kind of see the PEG ratio forward, which is the next fiscal year, so about 12 months from now, increases to about 0.5. So it's still below that point, below that one that you kind of discussed. But you do kind of see a bit of a increasement from this year. So how do you kind of see something like that? Should that be seen as a bearish case, or am I looking at it wrong?
Well, I think that's just instructive. I think what it's telling you when you see the price to earnings growth ratio increasing, further down the road, I think what that's telling you is the fact that the company's growth rate is expected to continue accelerating. And so as that growth rate continues, then when growth of their earnings continues and the growth rate of the earnings continues to go higher, that's when you see that PEG ratio continue to go up. And as you said, even though it's still under one, it's increasing a little bit, and that's because the stock is more valuable from that perspective because the growth rate is going up.
Definitely. Thank you for that, Danny. So another ratio, again, I try to keep it simple. I just kind of look at price to sales ratio as well, and very similar. Sometimes I might be looking at a company that is in the software space. In the software space, technically, the PE ratio might not be the best to look at. Another segment is right now, in NVIDIA is a perfect example. Is the PE ratio, Danny, looks pretty attractive. But one of the bearish cases that I've been reading about is obviously the earnings look pretty high because this company has been able to maintain high margins in general, higher margins than previously expected because their overall demand has been pretty strong. So maybe it might be good to look at another ratio that might not shift too much based on margins, and that might be your price to sales ratio. This is a ratio that would stay pretty similar no matter it will stay similar no matter based on margins. But so price to sales ratio in the trailing 12 months kind of peaked at around high 36, and this was something that I kept hearing, kind of a bearish case that it's extremely high. But now I'm looking at it and it's starting to cool off a little bit better than expected. So we can see that price to sales ratio at 22, forward at 14. Now, Danny, there is another kind of one that we kind of sometimes discuss, and that's forward 1 year. And forward 1 year is the next fiscal year. So forward 1 year for NVIDIA here would be about 24 months from now. I kind of take those numbers, Danny, with a little bit of a grain of salt, because I mean, I don't know how easy it is. It's already pretty hard to try to project 1 year out. Not trying to project 2 years out, that seems pretty scary. But maybe I use it more kind of to see a shift in tone. Is the market expecting further growth? And if you see a decrease in ratio, the answer is yes. Or is the market expecting some other form of cycle to continue? Which could kind of give me maybe a little bit of understanding of what the market is valuing the stocks like right now.
That is fair enough. So we have a couple of questions that are starting to come in. William Wright just now asked, I'm curious about Microsoft. Buy, don't buy, or hold? Let me start by saying we can't give personalized investing advice. As you see from the scrolling bar at the bottom of your screen there. But I can tell you what I think about Microsoft. Microsoft is a company that I have been intrigued by for a while. But again, since we're talking about evaluation, it's interesting that Microsoft right now is selling for a little bit of a premium. It's currently selling for about 32 times earnings about 30 times forward expected earnings. And I think the reason for that is Microsoft was one of the earliest to jump on the AI bandwagon. You go back a couple of years, they spent about $13 billion investing in OpenAI, the parent of ChatGPT. And so, there are a lot of expectations. Now, I think they were able to capitalize on that somewhat they came out very quickly with their suite of copilots, which are tools that use generative AI to improve their workplace productivity products. So I think that there's a lot of expectations already built into the stock right now. But I think Microsoft has a long track record of performance. They continued even when during the economic downturn, Microsoft was still able to grow 2 out of its 3 major segments, albeit at a slower pace, because consumer spending had fallen off a cliff, and so its consumer goods statement or segment didn't do as well. PC segment. But that said, I think Microsoft is a good stock for me to hold. I think they can continue to expand on that AI opportunity. The one thing that I would say is that this is a company that's not cheap. So if this is a company that I'm buying now, I need to be prepared to hold it for the next at least 5 years in order that I should get the most for my money. Jose?
Yeah, Danny. I mean, I agree that this is. I own Microsoft as well, and it's one that I believe is going to be pretty good in my portfolio in the long term. It's already been pretty good, and I think you hit it right on the nail where the market is expecting a nice amount of growth from there due to their advancements in AI with that partnership with OpenAI and the investment in OpenAI. And for that reason, it trades at a premium. While I do own Microsoft, I personally, obviously, no personal advice, I enjoy another cloud provider a little bit more right now in forms of valuation. I think one that I believe is also doing really well in the AI market and can grow in the cloud share in general is Alphabet. I think Alphabet is, if I'm looking kind of like those big cloud server providers, I enjoy Alphabet a little bit more. Obviously, with Microsoft, you get a little bit more of the enterprise market. You also, like you mentioned, then you get more of like the consumer spending as well. So they both have their uniqueness, but I think in the cloud space, I am more of a favorite in Alphabet right now, as I do believe they can start to get more market share during this supply constraint market that we're seeing right now in capacity of cloud solutions.
Yeah, it's interesting that you mentioned Alphabet, because in the last hour, when Travis and I were talking about our favorite and least favorite Magnificent Seven stocks, both of us highlighted Alphabet as being compelling at its current valuation. So that's you heard it here first, folks.
Yeah, Danny. I mean, I think they obviously they have so much strength with their core products in advertisement. But I think the market sometimes believes, Danny, that because they might not be releasing, even though it seems like recently they've been releasing more competitive AI solutions, the market sees as they don't have a real solution in the AI space. But it is crucial to remember that Alphabet has billions of users using their platform, a range of their platforms from search, from YouTube, and to be able to kind of have an AI solution to be used on all of those would be too expensive. So I think Apple purposely doesn't release all their cool AI solutions because it would just be too expensive right now. But as we're going to see in the next few months, Danny, I'm going to believe AI is going to continue to get cheaper and cheaper. And once we get that, we will see kind of the full strength of Alphabet's AI suitcase that they have. And it would be pretty impressive for investors.
I like it. So I'm looking at one of the questions here. This is from Ron H. About 18 minutes ago. So what do you think of Axon's current stock price? Axon is ticker AXON. This is a company that is the pioneer in non-lethal law enforcement technology in terms of the taser. They also are a cloud provider and one of the pioneers in body cameras used by law enforcement. And I think the thing that makes them pretty sticky is the fact that with these body cameras, they also upload this footage to the cloud. And a lot of law enforcement agencies have chosen this as their provider for maintaining these cloud records. Now, in terms of Axon's current stock price, Axon is an interesting company. Over the course of the past year or so, Axon has seen its price. Let's see, I'm looking at the chart here. It's gone up, oh my goodness, about 72% over the past year. However, the stock is actually down off its high, and it's lost about 24% right now. It was actually down as much as, I want to say, closer to 29 or 30% at one point. The thing that's weighing on the stock is the fact that there's a very high-profile spat between Axon and one of their providers, which is Flock. And Flock is a company that has license plate reader technology that integrates with Axon's offerings. There was a disagreement between the two companies about whether or not there was an even exchange of information between the two companies. And so their respective CEOs got into a little bit of a public argument over that, and Axon kind of cut off Flock's access. I think this is something that falls under the heading of "this too shall pass." Either they'll work it out or they won't. And this is a stock that it is certainly not cheap by any stretch of the imagination. And honestly, it hasn't been for a very long time. I pulled up the chart here over the past several years. Axon, let's see, its current price to earnings ratio on a trailing 12-month basis is 113, and that's down a little bit from its high back in, it actually was pretty high back in 2020, but it's been pretty reasonable over the past few years. I'm going to jump back to 3 years so we can get some more realistic information. So PE ratio of about 113, forward PE of about 92, which are both very expensive when the market's running at about 30. Price to sales ratio about 20. If you look at, and we were just talking a price to earnings growth ratio, right now, Axon's PEG ratio for the trailing 12-month period is just over 1, where 1 or below is considered to be undervalued. So I would say in terms of its growth, and if the company continues its level of growth or even increases it a little bit, then from a PEG ratio standpoint, Axon is undervalued, although it certainly doesn't look that way if you're looking at the more commonly used metrics, which goes back to our point earlier where that Jose so eloquently made, that you need to have a lot of tools in your toolbox so that you can adequately determine whether or not excuse to determine whether or not a stock is what its valuation means to you. I don't own Axon stock, but I think certainly its valuation is getting more compelling than it has been in recent memory. So certainly now's a good place to start looking at it, I think. Jose?
Thank you, Danny. I do have a question here I can take. It came about 30 minutes ago from Carlos. And Danny, sorry, I don't have much to share with Axon. I don't own the stock,
Sure.
and I don't follow it. So Carlos, about 30 minutes ago, mentioned any thoughts on the Stargate project? Question mark, and then question mark, OpenAI. So for those that are not familiar, Stargate is a massive AI investment happening here in the United States, pretty much driven by three main players. First is going to be SoftBank. SoftBank is mainly known for owning companies like ARM Holdings, and also investing in tech plays. It also includes OpenAI, so SoftBank is going to be more like the money player. You have OpenAI, who's going to be producing AI technologies and AI innovations. So they're going to be like the brain of the thing. And then you have Oracle, which is the third company that's really into the Stargate project. And Oracle is going to be helping provide kind of the infrastructure solution. And OpenAI, even though they're providing the infrastructure solution, it's not like they're going to be giving it for free to OpenAI. OpenAI will be kind of like renting it out and paying Oracle some form of fee, very similar to how they do with Microsoft right now. So I think the Stargate project is going to be great news for, obviously, AI chip players. I mean, they did mention that the technology, one of the tech critical partners here is going to be NVIDIA. So NVIDIA is going to be able to sell chips to this Stargate project. This Stargate project is not going to be just one massive data center. There's going to be data centers all over the United States. And remember, data centers take time to build up. It's not something that you can kind of just say, hey, look, I'm going to spend $500 billion and you're going to spend it all at once. They do mention that for the first year, it's going to be $100 billion already. And they already have the data centers being built up in Texas, in Texas, sorry, not Texas Instrument, in Texas. Now, I believe the biggest winner here, Danny, is actually going to be Oracle, because Oracle is going to be able to build up massive amounts of infrastructure in the United States and already has kind of like a customer, OpenAI, that's going to be willing to kind of pay already for that compute capacity. So for them, it's almost like a low risk where, hey, look, I'm building something already because I already kind of have like a long-term contract that someone's going to be renting out these servers for a long while. So overall, I think this is very beneficial for the AI space, but I think the biggest winner is going to be Oracle. Now, I'm not saying this is negative for Microsoft. Microsoft has this investment in OpenAI, and OpenAI already uses Microsoft's clouding play. I think Microsoft wanted to control their spending, and that's why they didn't really opt in to be a player here in the Stargate project. And because they didn't opt in, I do believe they're capping their growth a little bit. I think Microsoft will still be able to do fine, but they're capping their growth at the expense, or of maybe not the expense. They're capping their growth at the gain of not spending a lot of more money in AI infrastructure. They're saying, hey, look, we don't want to spend that much money, but we'll let you go to Oracle so they can spend that kind of money for your infrastructure, and we can still benefit from your overall IP. So I think the Stargate is going to be really, really great for Oracle. Now, does the market have that priced in? Maybe. I mean, PE ratio for Oracle, Danny, currently is 39, and forward PE ratio is about in the mid 20s, about 26, 27. So it is trading maybe a little bit kind of in a premium, very similar to Microsoft. And I think the market might just be expecting a lot from this Stargate project.
Fair enough. So we're one of the companies that we have on our banner for today was NVIDIA. So kudos to Jimbo has a question for asking us about one of these. How are chip restrictions to China going to affect NVIDIA? I think it's important that we go back a little bit because there have been chip restrictions on NVIDIA chips and sales to those from China going all the way back to October of 2022. The country, the U.S. first enacted those restrictions because there were concerns that China would use these high-end processors to develop AI technology that would then be used by its military and in its advanced weapon systems. Now, that was only the first salvo. There have been several times since October of 2022 that the U.S. has come back and has expanded those chip restrictions. It did it in mid 2023 again, mid to late 2023, and there were some updates to that recently. Now, from its standpoint, NVIDIA says that as long as those restrictions remain in place, that it's going to impact sales to China. However, here's the thing. Right now, NVIDIA is experiencing supply constraints. It is basically selling its graphics processing units, its GPUs, which are used for AI processing. It's selling them as quickly as they can be produced. And if you look at the major cloud providers, they have all said the same thing, that they're not able to get NVIDIA's GPUs as fast as they would like. So I would say that as long as the company is supply constrained, and as long as NVIDIA is selling those processors as fast as it can make them, I don't think that there's going to be any major adverse impact from the fact that it can't sell as many chips to China because everybody else right now is picking up the slack. Now, if we get to a point where they have market saturation, they've increased production on those chips to the point where they have a supply of those chips in reserve and they're not able to sell them to China, I think the market might re-rate the stock a little bit. I don't know if you have anything to add to that, Jose.
Yeah, Danny, I just wanted to maybe pull up some of the numbers that we're seeing right now. NVIDIA did post their 10K already. And it definitely, I want to say, I agree with you, but just to make things fun, I want to kind of maybe throw some of the bearish thoughts, Danny, because it's no fun when we both just continue to agree. So right now, China, in their most recent year, Danny, made $17 billion. And this is on NVIDIA's. And remember, you mentioned, Danny, I think most of the restrictions actually came in maybe early 2024, maybe even as far back as 2023. So it's definitely been a while. So these China for 2025 fiscal year, these are all NVIDIA chips that are legally able to ship with export restrictions. So 17 billion is a nice amount of money. It's a little bit over 10% of total revenue, maybe closer to like 14%, where we're getting to a level where maybe a year ago you told me $10 billion, and $10 billion, I would say maybe the market can take that appetite. We saw United States was only about $26 billion last year. But now with the United States being about $60 billion, do they still have that same appetite to be able to take that 17 billion? I think as this becomes bigger and bigger, and we see about a 70, I would say that's a 70% growth versus last year. As that continues to grow, you need to, I think the risk increases if the other players are still hungry enough to take that appetite, and that appetite needs to get bigger and bigger. So I think the market today, if we see more export restrictions, would hit the stock price a little bit more than previously. But that price volatility might not indicate the truth behind it, just like you were trying to mention, Danny, where we would have to definitely wait till earnings call to see what management says. Will management say that the appetite from every other player is still big enough that it doesn't really matter? And then also we have to remember that NVIDIA can also just continue to maybe they'll make things more competitive heavy, but NVIDIA can maybe even make their chips even weaker, so they can not bypass, but legally send those new chips. So they can continue, because NVIDIA has had to make their chips weaker twice. First, they couldn't send the H100, so then they made the H800. But then the United States said, hey, look, you can't send the H800, so they had to send the H20. Now, if they say, hey, look, you can't send the H20, NVIDIA is going to send the H.01. So it could just get smaller and smaller as long as there's somewhat competitive to whatever China is making as well.
I love it. And that's the reason we're here. If we just gave them the same answer all the time, our viewers would find no value. This question from Foolist about 9 minutes ago: is NVIDIA legally accountable for its resellers selling Blackwell to export banned countries? That's an interesting story. This recently just came up in the fact that we have, let's see, there was a report that Singapore had detained 3 people in the country for fraud-related charges because they illegally re-exported NVIDIA's GPUs to DeepSeek, the company that came up with this AI model from a few months ago that caused such havoc in the AI marketplace. And what I think what's really interesting about that is it kind of shows that NVIDIA can do the best that it can to ensure that these trade restrictions are abided by, and make sure that it only sells to third-party resellers that are legally allowed to receive its chips. But then on the other hand, it has no control over what these third parties do once those chips get into their hands. And so there's been an investigation ongoing because apparently some companies have been using the recently released Blackwell graphics processing units, GPUs, and they've been shipped from Singapore to Malaysia. And then Malaysia is a country where they believe there's been smuggling of those chips from Malaysia into China. So this is kind of an unfolding story, and we don't really know all of the details yet. But that those arrests were just reported just moments ago, recently. But the investigation into what's been happening in Singapore has been ongoing for several weeks now. So to answer the question, no, I don't believe that NVIDIA is legally accountable to these resellers, because it has no control over what they do once they have chips. But if they go against these trade restrictions, NVIDIA can just cut them off, and they will no longer be an authorized reseller. Jose?
Yeah, that's the thing, right? And then it's going to be, I think well, first with the Singapore revenue, there's been a lot of discussions about that. It is important to remember the easiest way to think about it is Singapore is kind of like the Delaware of Asia, where many companies try to build an entity in Singapore because there is a lot of kind of tax benefits from it. So that's why you kind of see a huge revenue market. Or if we remember looking at the numbers, I think about 18% of revenue for this fiscal year was from Singapore billing, but only 2% of the chips went there. Companies like Google, they have a entity in Singapore, Danny, for their Google Cloud. So if they're buying somewhere in Southeast Asia, there'd be due to maybe tax benefits, they would purchase and send that billing to Singapore. So it's Dell, another big player in the AI server, also has entities in Singapore. So if you're kind of somewhere buying chips around that area, you're going to most likely use that as your billing point of material. Now, would NVIDIA be legally accountable? I am not a lawyer here, but I saw some of this, Danny, when I used to work at General Dynamics, and sometimes we would have kind of meetings and discussions that if you are sending stuff to some players, you have to at least do your due diligence. You can't just play, hey, you're negligent. So NVIDIA has to make sure that and not anybody can just buy it, like you mentioned, right? You have to be an authorized seller, Danny. You can't just start up a brand new company and go to NVIDIA. Hey, look, I'm going to buy 2 billion worth of your chips. NVIDIA has to do a background check on your business. Hey, how long have you been in business? Where is your prime location? And they have to do this research, this background strategy on you to make sure that you're not going to be someone who is just opening up some random LLC so they can buy some chips and then send it somewhere else. So there is some form of background check. And as long as NVIDIA showcases that they've done that background check on these businesses, I think they're A-okay. Now, again, if you are a business, a reseller, you're not going to want to lose, like you mentioned, your license from NVIDIA to be able to sell their chips, because that in the long term is going to be more long-term pain, because if now that is considered a form of a national security thing, your company, your reselling company might enter a blacklist where not only might not you be able to sell NVIDIA chips, you might not be able to sell other companies' products as well because you have entered this list. So I think these smuggling things is going to happen with any type of product. And it's going to be a very small amount. I don't think there's a huge portion of revenue really kind of escaping into illegal hands, just because there has to be a lot of checks and balances on a lot of these players out there.
Yeah, I actually just found a statement that was released by NVIDIA. An NVIDIA spokesperson said, anonymous traders cannot acquire, deliver, install, use, and maintain Blackwell products in unauthorized countries. We will continue to investigate every report of possible diversion and take appropriate action. And as you were talking about, that appropriate action may be, they get struck off the authorized resellers list, or they're not able to, buy NVIDIA chips. And, for somebody in the AI space, that would be a tough nut.
Yeah, Danny. I actually like this question that came in about 16 minutes ago. Danny, it's directed towards me from Matt. So Matt, Jose, if you once worked at GD, why do you have more interest in the defense-related stocks? So obviously General Dynamics is one that is a government contractor, so they focus a lot in the defense space. I worked in General Dynamics, and within General Dynamics, obviously like any other entity, they have different types of businesses. I used to work, Matt, in a part called Mission Systems, and Mission Systems, I would say, is more like a startup phase of General Dynamics, is where kind of like a lot of the cool projects get pushed out. So I was seeing a lot of new tech coming in, of random new projects, and that kind of made me want to invest more in kind of the growth phase, as I saw how these types of investments, and it obviously helped me understand that even though there might be a project that an engineering team might be working for a year or two, it might still end up as a failure. And it shows me that growth stocks are pretty much that while there might be some market opportunity for them, not everything is going to be successful. So I do believe working at GT, even though it's more of a defense play, where I was working at had more of an environment of a startup. So it focused me, it kind of guided me more into liking emerging technologies and emerging segments in the growth in the tech space.
So we've got another question here about Axon from Luella 17 minutes ago. Any opinions on the long-term impact of Scottsdale nixing Axon's development plans? Eisner saying Axon may leave Arizona. Tantrum or important? For investors who may not be following this, last year, Axon decided that it wanted to build its headquarters in Scottsdale, and they presented that to the city council. The city council actually approved their request, but then there was a lot of pushback from some of the citizens who opposed the company building its global headquarters there. And basically, they were saying that they, didn't necessarily want the traffic congestion that it would create, and it would change the character of the city. A bullish argument was that it was going to put Arizona on the map for tech companies. And so, there was basically a citizens led initiative. They formed a group called the Taxpayers Against Awful Apartment Zoning Exemptions, which I thought was pretty interesting. Basically, the city council had voted in favor of Axon's global headquarters. They rezoned the area for mixed use, which would allow them to put their headquarters there. And then, after all of the hubbub, Axon announced that it was halting the groundbreaking here, and it was going to open a nationwide search for a new location. So I don't necessarily think, I don't think it's that important. I don't think it was a tantrum so much as it was, on the ground, people were objecting to it, and Axon really didn't want to deal with the basically all the hassle that was coming from it. And so now they've opened it up. I'm sure there are a lot of cities in the United States that would love to have Axon's global headquarters. I think what you're going to see in the weeks and months to come is that there will be companies offering certain tax breaks if Axon will build there. And there may be a more favorable environment. So this is just one of the things that happens whenever a company is planning to break ground in a new area. Sometimes, the local community doesn't really want that development, and so they'll come out against it. And in this case, Axon said, fine, you don't want us there, we'll go somewhere else.
Thank you for that, Danny. So I'm going to take this question from 8 minutes ago. Jimbo has a question. Jose, and it's kind of relating to what we were talking about, NVIDIA's AI chips in the China market. Jose, if they make it, being NVIDIA makes its chip weaker, eventually China will not buy it anymore since they won't make their own. And I think this is where eventually there's going to be kind of a balance in the export restrictions. I think hopefully, the United States governments will see that, hey, look, without NVIDIA, there's already other chip players in China making some form of performance. So maybe this should be our benchmark. Maybe we shouldn't be able to send a chip stronger than that, but we should be able to at least send chips that are around that market, because it really wouldn't accelerate too much. So I do agree if we kind of see more restrictions where NVIDIA, the AI chip players in China have just too much of an advantage, no one's going to buy NVIDIA's chip. But I'm going to guess it just makes common sense to me that in export restrictions, if there's already a product out there, to just at least maybe the maximum performance is something that matches what they can already make. So I, as long as we stay there, I think maybe it won't be that bad. But I agree with you, Jimbo. If it just becomes too weak and it's not competitive, then obviously, if it's not competitive, no one will buy it.
Yeah, I absolutely agree with that. And, this is one of those cases where I think the United States is trying to thread the needle in effect, trying to make sure that China doesn't get AI capabilities that are far beyond what they have now, because they could potentially use those capabilities in their military infrastructure, in their weapon systems, and that's what they're trying to avoid. On the other hand, if the country is already developing processors on its own that are, equal to the task at hand. I think that the United States, it's probably in our best interest to let NVIDIA sell those processors to China, and that's kind of what they're doing. They've gradually been bringing, the capabilities of those chips down, rather than just banning them outright, because I think that's what they're trying to do.
Yeah,
So
and
there
Danny,
was
haven't. Oh, go ahead.
Sure.
You can. Yep.
Oh, I was just going to say, so this came from Ed a couple of minutes ago. Over the next 3 years, at current prices, which stock does the best? I'm assuming in terms of stock price returns, Axon, ticker AXON, CrowdStrike, CRWD, and the Trade Desk, TTD. Since we're just playing fun with numbers here, I'm going to kind of go out on a limb here and tell you what I believe is going to happen. At this point, we're talking about 3 stocks that have fallen from their peaks. Right now, CrowdStrike is about 14% off its peak. Axon is about 25% off its peak. And the Trade Desk is 51% off its peak. Without knowing those numbers, I was already thinking that I was going to go with the Trade Desk, because we've seen the Trade Desk stock react this way before. Investors kind of overreact to a piece of news. Wall Street thinks the sky is falling. The stock loses half its value. And then within a relatively short amount of time, depending on the situation, the stock is back at new all-time highs. And I think that's the case with the Trade Desk here. The Trade Desk growth decelerated from somewhere in the neighborhood of 27% year-over-year growth to 23% year-over-year growth. That's not a lot of slowing of the growth, and yet the stock's down 51%. And I think investors reacted to CEO Jeff Green's commentary, that they messed up. They took ownership of it. I would think that's, to me, that's what I want to see in a company. I don't want to see a company making excuses when they screw up. I want them to own it, and they did own it. So the fact that the stock is down 51% now, and the news that drove that stock down really wasn't that bad, I would say that I think the Trade Desk is going to be the best performer of the 3 over the next 3 years from March 4th, 2025. I don't know if you have a different answer, Jose.
Danny, I don't really follow Axon or Trade Desk, but again, if we're just playing fun, I'm gonna go with number 1, CrowdStrike. All right, in the next 3 years, I do believe as we continue to innovate in this software play, in this cloud space, in this AI space, there's going to be a lot more bad actors online. And I think CrowdStrike can definitely benefit not from just getting new members, but also from just upselling to their current members. And we know that we've seen from CrowdStrike that is just that alone, just upselling to their own members more modules is a massive growth opportunity. So CrowdStrike, I think based on just the evolution of the innovation of technology right now. I'm going to say Trade Desk would be my number 2, as again, I believe just the overall ad segment in a top level overview, I think it's just going to get better with AI, more efficient. And I think Trade Desk will be able to manage that really well. And just the third, just because I'm not too familiar with Axon, minus what we've heard from you and maybe other fools, I would put that at number 3. But yeah, so CrowdStrike, Trade Desk, and then Axon for me. Danny, let's see what else we have here. I like this one from Susan about 38 minutes ago. What are our opinions on Cadence and Synopsys, ticker CTNS for Cadence and SNPS for Synopsys. So for those that are not familiar, these are two companies that are competitors with each other. They help big tech players and chip designers kind of design chips and validate those chips. So pretty much, let's say you're building a house, you need a blueprint. Think about this as the blueprint for the chip players. Now, it's not just chips, right? If you open up like your TV or whatever, you have one chip, but then you also have a whole circuit board, and that circuit board has a lot of chips. So there's a lot of ways that you can kind of use this type of software. It's not just, hey, it's only a selected amount of customers. A few things is right now, both these stocks have taken quite a hit after earnings. Overall, I am bullish in the long-term tailwind for them. One, just big tech in general is developing more of their own chips. So they're going to be using more, there's going to be an increase in licensing here. The other thing is, as we're getting for new technologies, eventually if robotics need a thing, every type of robot part is going to need its own circuit, its own chip, or whatever. So when technology evolves, you're going to have a lot of competitors. So overall, I think there is a nice growth opportunity for these players. I don't own them. I wish I could stop talking about them because these are definitely ones that are high on my watch list right now, Danny.
So there's a question in the queue that I thought was worth addressing. Ajit Jain from about 1 minute ago. Any thoughts on the CrowdStrike earnings tonight? And the reason that I wanted to address that is because this is an opportunity for our viewers tonight at 7 p.m. Eastern Time. Jose and Jeff Santoro will actually be covering earnings from both CrowdStrike and GitLab, tickers CRWD and tickers GTLB. Again, that's tonight at 7 p.m. So I wanted to put that plug in there for you, Jose, in case viewers wanted to, come in and take a look at that at real time. I would say briefly that, I think CrowdStrike is an intriguing company. It's one that I follow. I think a good many of the analysts on Wall Street, there are 51 who cover it, and 38 of those rate the stock a buy or a strong buy. And right now, the stock is trading for just a little under $400 a share. But I think this is a company that Wall Street is really thinking is going to go places. They're expecting revenue growth in the current quarter of about 22%, but then for the current year, 2025, they're expecting growth of 29%. And also, from their earnings, they're expecting earnings to grow not quite as fast as the company is investing heavily in its infrastructure and in its cybersecurity solutions. But personally, I don't really know how the stock is going to react in response to the earnings. But I think CrowdStrike is I think the company is doing remarkably well. I think they are taking some market share from some of the other players, and I think it will be interesting to watch. I don't know if you wanted to add to that, Jose.
Yeah, I mean, a great plug. I completely forgot about that. But I mean, Jeff and I were going to definitely be looking at some nice earnings. So feel free to tune in. CrowdStrike, like I said, I'm super excited as how AI, I think, is CrowdStrike was kind of built on top of an AI platform, right? That's what they've discussed. So as AI continues to innovate, I love listening to earnings call from companies like this because it gives me a better insight of kind of just the AI market, not just solely focusing on how chips are evolving with my semiconductor companies. This can give me an insight of how just software spaces are evolving with AI. So they can give me those real world solutions. And CrowdStrike is definitely going to be an interesting earnings that Jeff and I will be discussing in a few hours.
Well, we have about 1 minute left. It's amazing how quickly the hour goes. I didn't looking to see here. Jimbo has a question. I'll just take this one quickly. Has Palantir stock fallen enough, or is it preferable to wait for more of a drop in the coming weeks and months? I don't have a crystal ball. I don't know the answer to that. But I will say that right now, from a valuation standpoint, since we were talking about valuations, the stock is more compelling than it has been. Now, it's still, we're talking a PE ratio of 152. We're talking a forward PE ratio of, let's see here. Yeah, it's not even showing up there. And we have a PEG ratio, a forward price to earnings growth ratio of less than 1. So I think we're getting to the point where it may be a buy, but still, I think that it still could fall further in the days and weeks to come. We simply don't know that.
Yep, agree, Danny.
And I think that we're being joined by Toby and Will. Gents, take it away. Jose, it's been a pleasure.
Guys.
Thanks, Jose.
Fool on.
All right. Alrighty, my friends. We are up at 4 o'clock on the East Coast, 1 p.m. on the West Coast. Markets are closed right now, and a day ahead has been, has it not, Will?
It really has been. We started out way down, and at least the last time I checked, the Nasdaq actually was up. I didn't get a chance to see the other indexes.
Yeah, it's nothing's up right now as we close.
Okay.
Except no, I take that back. The VIX is up, Will.
The VIX is up yeah.
Today, as one might expect. 1,300 points down apparently for the Dow in the last 2 days. So we have ourselves a good old-fashioned market sell-off here, which is great if you have cash on hand, but it can be nerve-wracking. Who knows when this will end? We don't know. We don't know when this ride is going to reverse here. But it is the end of the market day. We do have companies that are reporting and have reported today. So we're talking earnings with you guys today. We're going to look, try to take our minds off of the daily gyrations of the market at large and focus in on the fundamentals of the companies we own and that we follow as they report earnings here. I think some of these we're going to try to do live, right, Will? As we get some of these reports that come in. The two we want to focus on, Best Buy and C Limited, but anything else that you guys want to know about. If you've got a company that is reporting, that has reported, you want to take a look at that. We're happy to look in on that. The ones that are reporting right now, you're going to get our first look, right? So first impressions, nothing too detailed because we'll be looking at it right here along with you. But this is fun to do. Right, it's fun to both look at your immediate reactions and then take a step back a couple hours later, a couple days later, digest the whole thing and see what it means in context. So we like looking at this from both angles. So what do we got right now, Will? Did C Limited, are they aftermarket or did they report this morning?
Actually, the three I've been looking at, that I was thinking Target was aftermarket, but in fact reported this morning. So we can talk about that too. But looking at we bought C Limited first. Looking at C Limited, it was up pretty big today. I only see where it ended. Yeah, it ended up 7% up today. It's been kind of on the comeback trail. It was up big in the 2021 bull market. It made some strategic mistakes, lost about 90% of its value at one point. But the fintech segment of it was always strong. The e-commerce segment started to make a comeback last year. Now we're finally seeing some signs of life in the gaming segment, which long had been struggling. I think the big thing in the gaming segment that people are watching for, their return of Free Fire to India, that's still hampered by delays. Last I checked, but it's the digital entertainment segment, which includes gaming. Bookings were up 19%. Revenue for it was up 1.6%, which if you saw some of these 50+% revenue drops a few quarters ago, what 1% is actually quite good. So overall revenue was up 37% for the quarter, and then 29% for the year. So yeah, we're definitely on the comeback trail with the stock. And despite the bounce back, it is still fairly cheap. At least on a forward price to earnings ratio basis, the forward PE is only 37, which for a fast growing stock like that, I think is pretty cheap. And then the price to sales ratio is about 5, which is not that much higher than where Amazon is, and well below where Mercado Libre is right now. So this is a good report. It looks like it's finally making a comeback. Will it reach those highs that it did in 2021? I still think that's going to take a while, but this is definitely one that you need to keep on your radar.
Yeah, it does look pretty good. Bookings for the gaming division, for the digital entertainment division, up 34% for the fourth quarter. Right, so that's nice. Those bookings are looking strong. Gross merchandise volume on the shopping platform, the e-commerce platform, of 28% in the fourth quarter, over 100 billion now. Will, for that gross merchandise volume, which is great. And I think that's the quarterly number there. So looks pretty good. I'm wondering, I'm trying to find out if, do you know what their guidance was looking forward? It must have been reasonably good.
Question. They often don't, they haven't published.
Maybe they don't give guidance, right?
Yeah, they might have in their on their earnings call. I don't think they publish it on their report itself.
Yeah, I don't see it in the thing, but it was solid, right? SOC's doing well. SOC is what did we say, up 8%? I think
close up 7%. It spiked a little higher at the opening. It came down a little bit, but that's still a pretty impressive reaction. And like I said,
I think so.
It really, at least on a forward PE basis, it's not that expensive. So I don't think this one is anywhere near done going up. At least from what I see.
Yeah. So I think for C Limited, we say pretty good report. Good to be back on track. We like what we see. Now we are still well off our highs over a 5-year period for this one.
Right? See, the high was nice. Yeah, the high was I think it got up to 372 at one point in 2021. So it's at 132 right now. So we're not even halfway back to that right now. But we're well off the lows in the high 30s from late in 2023. So
and we did have Hold Long and Prosper wants us to talk about CrowdStrike as they reported. We'll look at that. We have 2 questions on CrowdStrike. We'll look at that right with you guys as they report in real time. I don't see the press release up yet on their website, Will, so maybe we'll give this one a couple more minutes. There was another one. Best Buy. We wanted to check out Best Buy too, right?
Yeah, Best Buy wasn't quite so rosy. I think it closed the day. Let's see. Let me get the final tally. Yeah, down more than 13%.
Oh, that's not good.
No. So it's been a very slow grower for a long time, though. So, and unfortunately, actually, if you look at the if you look at the comparable enterprise comparable sales, you're looking at you only 0.5% for fiscal Q4, down 2.3% for fiscal 2025, which ended on February 1st.
Now, I will say last year they had a 4.8% decline in comp sales. So 0.5%, it's moving in the right direction, right? I mean, we'll give them that. Like an increase is better than a decline. So hey, let's call out positivity where we see it. Revenue to beat expectations. So good job on beating expectations, except it was a decline year over year for Q4, right?
Yeah.
So what that's telling us is that people were thinking this is not going to be an awesome quarter, and it wasn't, but it was maybe a little more awesome than anticipated.
Well, the one good thing I see is gross profit was up slightly for both Q4 and the year. So maybe that's positive. But yeah, revenue is down. Net earnings are down substantially. Looks like I can't do the math on the fly, but it's well over 2/3 down for the quarterly net income, and then maybe 25% ish for the 12-month period. So this is just a company in a very highly competitive environment. Yeah, I don't know. They did actually increase their dividend, surprisingly, which, well, maybe not surprisingly, but because they've been increasing it every year. They did increase it 1%, but yeah, trying to see if I can find about free cash flows, but
I do
okay.
know. So the guidance for next year was light.
Yeah,
At the low end of guidance for both revenue and adjusted earnings per share, we would be lower than the prior year, right?
yeah,
So at the high end, a little bit higher, but they basically came out and said we might do worse next year than we did this year, and that's not great. And the kicker, Will, is they said the guidance we're giving you, cautious as it is, doesn't factor in any potential impacts from tariffs.
yeah.
So they're also saying, and you know what, might even be worse than that. Who knows? People don't love to hear that, right? They did. The CEO commented, Corey Berry said that, look, hey, there's going to be a potential impact from these tariffs we're seeing, and we expect that our vendors are going to pass on those costs to us, right? And then therefore we're going to have to pass on those costs to consumers. So telegraphing price increases here potentially. Yeah, a lot not to like in terms of the look forward guidance here from Best Buy. So it's not surprising to me to see a sell off in the stock, all things considered.
Yeah. Well, they did spend $500 million on share repurchases last year. I guess they can repurchase more shares at these prices. On cash flows, I misled you on that. I apologize. It turns out they generated about $1.4 billion in free cash flow, which was substantially more than they did last year. So that was enough to cover the dividend and the share repurchases. So that there's at least some good news there. I guess they can technically afford to keep those dividend increases going for now. But I kind of worry if they don't change the trajectory of this company long term. I think that dividend's going to go by the wayside. So I'm not saying a lot I like in this company, and unfortunately, they operate in a very competitive environment. So that's not going to bode well for them either.
Yeah. We'll see. This is one to watch. I don't know. I'm not super impressed by what we've seen there. Improvement for the past year, the past quarter, sure, but it looks like maybe that was short-lived if their guidance holds out. So yeah, we'll see what happens there. All right, let me see.
Yeah,
Here we go.
CrowdStrike's down 5% after hours. So obviously they've released something.
Yeah, they just reported. I'm trying to pull up. There we go. They do have a press release. So we'll take a quick look at CrowdStrike with people here. So there was a question from BH on C Limited a couple minutes ago. Does C Limited send customer information to China? Do you know, Will? I suspect probably if they're doing business in the country.
I don't know that the e-commerce division anyway doesn't do business in China. They're in 7 Southeast Asian countries. I don't think they're in Taiwan, but that's separate. So
okay, yeah. So yeah, I'm not sure on that actually.
If they did, it would probably come from the gaming division. The gaming division is the one part of it that operates all over the world. The other 2 segments are primarily Southeast Asia. Although I guess the e-commerce segment still operates in Brazil too. That's left over from the time they tried to expand to all those countries where they had no competitive advantage and had to pull out of most of them pretty quickly. They did stay in Brazil, but other than that, it's almost exclusively Southeast Asia.
All right, so let's see what is happening with CrowdStrike here. We do have the earnings report, and you said they were down. They're down like 6% after hours.
Yes.
Right now. So let's take a look here. What is going on with CrowdStrike? 25% increase in revenue for the fourth quarter. Fourth quarter ended, I think, into January. Is that right?
I think they were I'm going to pull it up again, but I think they were looking for 23%.
23%. All right, so 25% increase, over $1 billion, 1.06 billion.
Yeah.
For the quarter. Subscription revenue at 1.01 billion, so 27% increase, so just over $1 billion for subscription revenue. That's nice. ARR, annual recurring revenue, grew 23% as of January 31 is when the quarter ended. As of the end of that quarter, that's like 225 million in new ARR during the quarter. That's solid.
Yeah.
77% on subscription gross margin. Operating loss. So they had a net income last year, or operating loss this year in Q4, right? So $85 million loss versus about a $30 million income last year. So that's not great.
Okay, because they were forecasting a profit, although that could have been non-GAAP too. So that
yeah,
I think they had a GAAP
loss.
profit. They've been having a GAAP profit for a while, so I'm a little surprised that
They
there's
were
a net
right.
loss there. So that's
So yeah, so it's we're seeing some losses. So they're not profitable this quarter. Cash flow is slightly down. Cash flow from operations and free cash flow also down a little bit, but free cash flow 240 million for the quarter. So that still looks pretty good. Gross margins consistent, 78% for GAAP gross margin for the full year. And they are a net loss on the full year, net income about 19 million. So 19 million net income for the year. Why is this just related to all of the expenses they had from the whole fiasco last year?
I don't know, but that would be my first guess.
That's my guess. Is what's going on. They're working towards a 10 billion. Their goal is 10 billion ARR. So 10 billion in annual recurring revenue is what they're targeting. We'll get a little ways to go to get there, but that's what they're still on. They're also targeting that. Let me see. Just looking at this here in terms of, let's see, their net loss. What do they say about that? I'm not seeing that. My guess is it's related to the expenses. Providing the following guidance. Guidance for the year. Revenue about 1.1 billion for the Q1. 4.74 to 4.8 billion for the full year. So
that's within guidance.
That's our guidance. Yeah. It looks pretty good, pretty reasonable. I don't know. We'll see on the conference call. I guess it's just not. Let's see.
Yeah, you have to realize though. I think they were trading at 25 times sales before the before the report. So let's see where we are with that now. Yeah, it was 26 times sales before the report, so it's still gonna be pretty close to that, even with a 5% drop. So yeah, it may be getting towards the point they're priced for perfection, and investors just have a very high expectation that they're not meeting. So my gut is that's what's going on with it. I don't think it's nothing that compromises the value proposition in the long run. But
I'm not saying anything that I'm super concerned about yet. I mean, we'll see what they say on the conference call, but it's just kind of, and it's not going a little bit lower here. So just not quite what I think people were looking for. I think part of this too, Will, is we did have a pretty roaring comeback from mid last year, right?
We really did, yeah.
After that decline we saw, if you look at the year, we're still we're actually up on a 1 year basis, up like 24%. Even after the decline, well, I don't know, not after the decline we're seeing after hours, but up to the market close today, we were up at about 24%, a little over 24% for the full year, even accounting for that huge decline we saw late July, early August.
And it lost nearly half its value then, but it made up the value, within the next, maybe 5 months. So.
Right. And so you ask yourself, right? I mean, we could probably, like, if that had never happened and all we got was a 24% increase in the stock over the past year, we'd be looking at a 6% drop on this report and probably saying, man, it is what it is. It's fine. Business still looks strong. Yeah, and so maybe there's some lingering concerns over that. That's probably what's driving the net losses here. Some expenses related to that. Yeah, I don't know. I feel like it's fine, guys. At least that's my first glance. We'll dig into this a little more. We'll look at the conference call and see what management is telling us. But I don't see anything yet to be super concerned about on this company. It's a volatile company, as we've seen over the past year. So
Yeah, it looks like at 7 Eastern, Jeff Santoro and Jose Najarro are going to go into CrowdStrike earnings. So
yeah, so you'll get a more detailed follow up from later on when they're looking at it now, so they'll have a detailed follow up for you guys in there. But that's our quick take here. So let's see some questions here.
yeah, I see one from Matthew Moeller that's apropos for our kind of consumer oriented show.
Yeah.
Matthew Mueller asked, just join the convo, keep or dump Walmart. They're doing well, but the tariff talk. We were talking, I think last time we talked, we were talking about Walmart pretty extensively. Yeah, so to me, it's a little, all things being equal, I probably like it better than Target. However, there's a huge differential on the valuation when it comes to Walmart and Target's, whereas Target has a PE ratio of about 12, especially after their decline after announcing earnings this morning. Walmart's PE ratio is about 39. So I don't know that Walmart's probably doing better than Target right now. But are they doing 3 times better? I don't know. I think it's a little bit on the pricey side. I think it's at least a hold. If you're looking for an exit out of Walmart, now might be a good time. But I don't know that it's not like a bubble valuation or anything. So unless you just really want to sell it now, I'd call Walmart more of a hold. But I think the price is slightly ahead of itself personally.
Right. I mean, I think that's sorry here. I'm pulling up our earnings report. I mean, that's the key, right? I too like Walmart better as a company. Price does matter, right, for some of these things. So if you're looking, I think Target might be the better value play here. And what does Walmart look like in a world of tariffs, Matthew? Higher costs probably, with I think a decent ability to pass on most of that to the consumer, because where else are they going to go, right? You're already the low cost provider. I think Walmart is better positioned to pass things on. I think they have more room to do that. How much of that will they do? We'll see. I mean, I don't think they're going to start selling stuff at a loss for sure. I think if they have higher costs, that's just what they're going to do. They're going to pass that on. But I think also when you're talking about Walmart, as between Walmart and their suppliers, I think those suppliers are going to bear a decent amount of those cost increases versus being able to pass them on fully to Walmart as they're dealing with tariffs, right? I suspect you'll see Walmart push back pretty hard and say, yeah, we hear you. Sucks to be you, type of thing, right? Now, they're not going to put their suppliers out of, well, I don't want to say they're not going to put their suppliers out of business, because in the past, Walmart has had a history of doing just that in some instances. But they'll work together, but Walmart's not going to bear the full brunt of this. So they have the power to kind of push back a little bit on that. They're probably better positioned, Matthew, I think, than some other retailers to weather this. But it's gonna hurt a little bit for sure. How much? We'll see how all this develops. It's something I don't know that I dump them in the face of tariffs. I'm not sure that I feel like if you're looking for a retailer that's a little bit robust, they're probably one I'd look at. So dumping is not my approach right now. I think you just kind of see how this goes and where we can go from that. That's my general approach to these tariff things. Will I don't think I'd overreact with any respect to any company that I own. I think
I'm inclined to agree with you there. There's probably going to be some effect. Is that going to make a great stock suddenly a sell? I doubt it.
Yeah. All right, we got some questions here. Ed notes CrowdStrike trending down to hours. Yeah, down about 6%. Where will it settle out? What will happen in the morning? We'll see how it goes. The report's fine. Not great, but not you know, not too
Yeah,
bad.
I think we need to hear the conference call on that one.
Yeah, I do.
before-
Like I'm kind of waiting, reserving judgment, and this is the conference call.
Yeah.
For that here. Let's see.
Yeah, and while you're looking for a question in regard to to Walmart, we also had Target report earnings this morning. So that one took a bit of a hit. It was down. Well, it was only down 3% in the end, but I think it took a bigger hit earlier, and then seemed to or I'm sorry, I need to refresh it to make sure. Yeah, it's still down about 3%. So it wasn't really a great report. I would say I don't know if it's bad enough to change your investment thesis per se, but it's pretty clear that they're still struggling with the economy. In comparison to Walmart, Target's sort of like the upscale discounter. So if we're having trouble with the economy, I think they're going to be hit a little bit harder than Walmart would be. For the fourth quarter, comparable sales up 1.5%. They were only up 0.1% for the full year. So that's not wonderful. Not falling off a cliff, but you definitely want to see better. They're looking for guidance for full year 2025. They're looking for net sales growth around 1%. GAAP adjusted EPS 880 to 980. Let's see how that compares to last year. Yeah, looks like net sales fell for the quarter 3.1%. It looks like we had 886 diluted earnings per share for this last year. So 880 to 920, which probably means they're going to go up slightly. Although it could still theoretically fall slightly and be in range, but yeah, I think it's going to be a very sluggish performance for Target in the near term. So, but again, I think this is priced into the stock. At 12 times earnings, this is just that's unusually cheap for a stock like this. And also, I think investors should take note of the dividend yield. Their dividend has gone up every year for more than half a century. So they are a dividend king. The dividend yield is up to 3.8% right now. So if you're an income investor, might pay to take a chance on the stock here. So looking at their cash flow, it looks like around about 4.5 billion in free cash flow. Their dividend only costs them just over 2 billion a year or so. They could easily pay down debt, probably have some money to invest in the company or repurchase shares. So I'm probably a little bit bullish on Target just because the valuation is so low and that dividend yield is so high. But yeah, this is not a great report. And I imagine, I think Target will recover eventually, but I think this recovery is going to take a while, especially with the tariffs coming. I think that's going to put a little bit more pressure on its margins. So the near term is going to be sluggish. But yeah, again, at 12 times earnings, it might be worth taking a chance if you're interested in looking for some income.
All right. On Holdings also reported today, this morning. And it looks like today the stock up not quite 6%, but up a decent amount on that report. Looks pretty good from what I can tell here. For the fourth quarter, earnings per share up I think this is in Swiss francs, 33 Swiss francs per 33 Swiss francs per share. Is Switzerland not on the euro? Is that what the
no, Switzerland has a Swiss franc. I think most of the except every country except Switzerland and the UK or
all right
in Western Europe anyway.
There we go. So 33 Swiss francs, which accounts to about 37 cents, right? If you're doing that math, the exchange rate's not easy to do quickly in your head. 20 cents per share. I think that's US 20 cents per share was the expectations. Revenue, I'm going to just give you the US number to the extent I can. Revenue is about 681 million. That's a 36% increase. That's for the quarter. And it looks like they had increases across all regions. in the world, right? So you're seeing a sales increase everywhere. The Americas region, 28% growth there. So that's kind of nice. 2.16 billion Swiss francs for the full year in revenue, net sales. They have a net income for the full year. That's good to see. They're looking for 2.94 billion Swiss francs for full year 2025 is their revenue projection. That'd be a 27% increase. That's pretty healthy.
Yeah,
That's a pretty healthy increase. Yeah, you like that. So that's why the stock, I think, is a little bit up here. They talked about some of their brand collaborations, the marketing, right? You know, Roger Federer, Zendaya, all those guys coming on board. Potential impacts from tariffs, of course, they're going to say that. They have to. So here's the thing. They think that they're going to be largely unaffected because most of their products, at least that they're selling into the U.S., are coming from Vietnam, right? So as far as I know, we haven't tariffed Vietnam yet. I mean, you know, it's only February or March, so who knows where we're going with that. But so if the tariff is on Canada, Mexico, and China, you're coming in from Vietnam, you're fine, right? At least for now. So assuming nothing changes, not too much impact from them, I think, from that. So cautiously optimistic for On Holdings on tariffs there. Yeah, it looks good. So this was a question from Matt, or no, this question was from Jim25 19 minutes ago. I would like to hear your take on Holdings earnings from your perspective. What's the 5-year outlook giving tariffs? So thanks for that question, Jim. And yeah, so from what we own now, right, given our current tariff situation now, it looks like On Holdings probably not going to be too impacted by that. Assuming now this could change, right? But right now, given where we have tariffs are, we're not super concerned about On Holdings being impact from those. And if it just moves forward and it's only Canada, Mexico, and China here, over, you know, who knows what happens over a 5-year period, but I suspect if they're looking to expand production capacity, at least for the products they're selling in the United States, they would probably not look to build plants in Mexico, Canada, or China, right? They either more space in Vietnam or maybe move something somewhere else, right? But I think if you're going to build new capacity, you plan that strategically based on what you know. The problem is, of course, the tariff situation is changing so quickly. It's hard to plan too long term around that. I mean, you do what you can. But for now, I feel like it's not a big deal with them. So, hey, hopefully that'll continue to be the case. So good news from On so far. I think this was a solid report, and if they can achieve that, 27% revenue growth next year, that's solid. This is a real player. Yeah.
Actually, I saw a question from Tim Jungles about an hour ago I wanted to address. It's kind of too late now, but in the future, how does the small investor protect their portfolio without taking profits? That's a good question. I think probably the best option in that case would be to buy what's called a put option. So if you don't know what a put option is, that gives you the right to sell a stock at a given price until a given date. So I mean, this won't be free, but if you have a stock that's $100 per share, you think it's overvalued, you think it might fall to 50, you can buy a put option that allows you to sell the stock at 100 for X amount of months. Now, if the stock keeps going up, that put option will expire worthless. But if that fear comes true, the stock falls to 50, you can exercise the put option and sell those shares at 100 per share, even though the stock has fallen to $50 a share. So
yeah,
that's probably the easiest way to do that. I mean, you do have to be careful about options investing. I would do your homework on and learn about that before employing that strategy. But that could be one way you protect your profits if you're not secure about them.
That's the most direct way, right? There's a cost that obviously, like whatever you buy on that put, if the stock doesn't go down, you're going to lose. So it will be a drag on returns overall. You don't even have to necessarily exercise it, Will. Like if the stock goes down, you can just sell that put for a profit, right? And take the cash
True.
and keep
That's
your
another
stock.
option.
There's a lot of ways you can do that, Tim. And I see some back and forth too from Zach to Fool and Tim on those questions there. But the general idea, right, is that's probably the most direct. And you can go a couple of ways. You can hedge an individual position that you're concerned about. You could hedge an index, right? You could buy puts on the S&P 500 or the Nasdaq or whatnot. If you're concerned about a general market drawdown, I want to kind of protect your larger portfolio with just kind of one strategy. That could be an approach you might want to think about. The other thing, I think, if your time horizon is long enough, maybe you don't care about a decline. If you're confident, as I think we tend to be, Will, that the market does bounce back whenever these declines happen, whenever these stock market drawdowns happen, whenever recessions happen. If you're looking out 5-6 years, you probably don't care too much about 6, 7, 8, 9, even a year of a drawdown there. So maybe that's not a big deal if you're more focused in the long term. If you're concerned shorter term for some reason over the next couple of years, maybe that becomes more of an issue for you if you've got expenses coming up or whatnot. Some people might also just say, look, I'm gonna build up my cash position as kind of a hedge against a decline, and that's one way. That's one way to approach it, to either have enough cash that you can draw on if you need to, and right out the decline, or have that cash on hand to be buying into a decline. So there's a bunch of different ways you can approach this, but those are just some things I think to think about, Tim.
Well,
when you're looking
at
at
some
that.
point you do have to watch valuation. I'm dating
Yeah.
myself by saying this, but in 2000, I owned Cisco when I think it hit a record of $82 a share, and now 25 years later, it still has not returned to $82. So sometimes these prices can truly get so far out, they can go into bubble territory, and it can take literally decades to return to that original price. So yeah, you do have to kind of take it with a grain of salt, and learn more about valuations. But if the valuation is just so high that it makes no sense, it might pay for you to either sell or buy a put option in that stock. But if you have a time horizon, it's not that far ahead of itself. Like we were talking about CrowdStrike, I don't think that's bubble territory exactly, although it is overvalued. I'd probably just ride that one out as a long-term investor.
All right, so let me hit this question real quick that just came in from Nicole. Nicole asks, companies like Amazon ranks high on Moneyball, but not a current rec, still worth investing in. So for one, Nicole, I just want to note that Amazon is actually a recommendation in Stock Advisor. So it is one of our current recs on our scorecard. Different services are going to have different recommendations and different focuses. So it may be that if you're a member of a service that doesn't have Amazon as a rec, it's because it doesn't fit into that service's philosophy or what they're focusing on. And that's fine. But in Stock Advisor, we do have it. It is also Amazon. Let me just, I'm going to confirm this here. It is one of our foundational stocks as well in Stock Advisor. So it is one that we hold in high regard, I should say. Kind of one of the companies we suggest that new members coming in could buy right away to form a core part of their portfolio. So yeah, I certainly think Amazon is still worth investing in, and the Stock Advisor team as a whole believes that. That's why we have it as a rec. That's why we have it as a foundational stock there.
Well, yeah, and I see its PE ratio is down to 37, which for Amazon anyway has been is a very low earnings multiple. I mean,
Right.
Amazon benefits because it has that huge e-commerce business that it does advertising and third-party seller services from, and it has the business where it makes the majority of its profits, that being the cloud business, Amazon Web Services. So it's made itself one of the top stocks by pioneering two major industries, and it's still a leader in both of those industries, and I don't see that changing anytime soon. So at a 37 PE ratio, I mean, it is a more than a $2 trillion company now, so it's maturing. Growth is going to gradually slow, but I still think that's a good deal, all things considered.
Yeah, and I'm looking at the Moneyball rankings here. Will, it ranks 32. on Moneyball, which isn't. I mean, it's not bad, right? It's not at the top, but it's still a fine. I think it's fine there. And you know, Moneyball is a tool, Nicole. It's a good tool, I think, but it's one tool among many. It's a way to get a nice overview of some companies and see where they fall against other companies on various metrics. I don't know that I'd necessarily say that it's dispositive in terms of, you know, only buy the top 10 or whatnot, especially if you're going to be a long-term holder, right? Because these things will shift and move over time. But it's certainly something you should look at. But you know, also look at what your services are saying too, and you know, kind of take that advice that you're paying for as well. Thanks for the question.
So a couple of hours ago, Ed asked, I found this to be an interesting question, so I wanted to address it. Will countries or companies sue the Mag 7 companies because they are so large, monopolistic going forward, and will this be an issue for these stocks? Yeah, I struggle with this. I mean, because some of these companies do look like monopolies, quite frankly. We had that with Microsoft in the 1990s, for example. You know, I see that kind of an Alphabet too, because Alphabet, I think they own like 200 different businesses. You see very few of those businesses in their financials. I think they just publish their financials on advertising in Google Cloud. But yeah, I can see why you might think that they were ripe for a breakup. But I think the two major breakups in history, one was Standard Oil in 1911, and the other was the breakup of the old AT&T in, I think, 1983, 1984, somewhere around there. And in both cases, the sum of the parts proved to be more valuable than the whole. However, you know, these lawsuits take years and years. So if it's going to happen, it would take a long time, and you know, the outcome is not certain. I mean, like I was saying earlier, Microsoft went through this in the 90s with their operating system, and they ultimately did avoid a breakup, even though it looked like it looked close, but it didn't actually happen. So it's always possible, but it's something I really wouldn't count on, just because it actually occurs so seldom.
Yeah. All right. Let's see. AeroVironment down 15%. Let me look why. That's not one I've looked at today. Is this one that you follow, Will, at all?
I do not follow this one, so yeah, it's down about 16% though.
Dang, yeah, down 16% now in the after hours movement.
Missed expectations by 55%. Ouch.
That's a big miss.
Yeah.
Why? How did that? Presumably that's analyst expectation. I don't know how you miss your own expectation.
Yeah, I would just think it's analyst, but still.
Let's see what happened here. We'll look into this in real time here. AeroVironment. Because whenever I see a miss that big, it does make one wonder what's going on here. So this is their Q3 2025. So that's an odd fiscal year. But we will pull up the report. I got it right here. Bear with me, guys. Just getting this to come up. All right. So third quarter earnings report. Here we go. So highlights. I want to do the highlights first. Highlights first. Third quarter revenue up. Oh no, that's not a highlight. Third quarter revenue down 10%. If that's what you're highlighting, okay, I can see why the stop's down. 167.6 million in revenue for the third quarter. That's down 10%, right? But a record backlog, a record backlog of 763.5 million. So I guess good news, bad news. They still have a net loss of 1.8 million. Looking at what they said in their release here, chairman said, we had a number of short-term challenges. I would say so, given this miss. So they're calling out the winds and the fires in California as a part of that. Does that make? I guess that's what it makes sense here. All right, so that's one issue they're calling out due to the sales, their unscrewed systems segment there, 44% drop. So that's kind of the big drop off there. And they just had a bunch of disruptions in their operation from the wind, the fires, blackouts in California, Southern California for the quarter. Gross margin down about 6%. So gross 63.2 million, down from 67.3 million last year. But it improved. So the margin on a percentage of revenue did improve a little bit, 38%. So that's nice to see there. And for those who don't know, right, AeroVironment, small tactical drones, right? They're a maker of drones, basically is what we're talking about here. For them, for the Defense Department, for NASA, also the commercial market too. So a kind of a range of products there. Let me look at their guidance. Did they give guidance here? I'm not seeing it right here. They are building a new facility in Utah that they say that's going to double their production capacity of the Switchblade unit. And one of the reasons they're saying, like, why are we doing this? Also to provide resiliency against regional weather disruptions, right? So right now, manufacturing concentrated in Southern California, they get that Utah plant, they won't have as many disruptions, right, from that going forward. They announced an acquisition of Blue Halo not too long ago. They still expect that to close this year, so that's in progress. Yeah, I don't know. I feel like this might just be due to some of these manufacturing disruptions we saw as a big drop off here, and hopefully they're going to get a little more robust with this new Utah facility to get that. Once that comes online. And you can see, right, Will, the difference between like where our revenue goes down and our order backlog goes up because we can't produce right, enough to meet. So the story they're telling us about these weather disruptions, actually the numbers bear that out. Like the numbers support that's probably the case here. They also, some of the stuff they make was used in Ukraine. Like some of their systems, their drones were sold to Ukraine, delivered to Ukraine, and they say they've been transitioning away from that because there's less of that happening. So maybe that's a factor as well. So a couple things potentially going on with them. But yeah, not great, right? Lower revenue, operating loss versus operating income last year. And some of that is driven by acquisition related expenses to this Blue Halo acquisition, right? That'll fall off. So that once that's done, you won't have that anymore. And if they get this new facility online, they can get operations back and going from the disruption we saw. Probably a short-term issue is my first, my gut reaction here, Matt, on AeroVironment. But definitely not a great quarter from what we've seen from them. So I would keep following this, and just you want to see that Utah facility, I think, come online pretty soon so they can start to meet some of this demand, the backlog they've got, and maybe kind of spread out their risk a little bit more regionally from some of the disruptions. So hopefully better news from them in Q4.
Ted has options asked about 6 hours ago. Thoughts on grocery stores, less dining out, more cooking at home. And then SFM, which is Sprouts Farmers Markets. I mean, it's possible. Yeah, I don't know that I would react too much to that. The grocery business, their margins are just so thin that even if they get a substantial increase in business, I don't know that it's going to change their change their profits all that much. Sprouts, it's kind of a special case because it's been growing. They've been expanding at a fairly rapid pace, so they've been growing faster than, say, a Kroger would be. Looks like in the latest quarter, they did beat revenue. They were by they got about 79 cents a share. Let me pull up their financials. Sorry, bear with me just a second. So yeah, revenue increased 18% in Q4. And see, they earned 79 cents a share, which was up from 49 cents a share in the year ago quarter. They added 12 stores in the quarter, which for a grocery store, that's a pretty fast expansion, because grocery, this is a very established industry and it's highly competitive. The profit margins are only like 1%, in many cases. So it looks impressive for a grocery store. Let's see if they. It's been a while since I looked at this one, so bear with me. They don't pay a dividend. PE ratio about 39. I normally be leery of a grocery store that was that expensive, but this one's growing a little bit faster. That's probably not outside of the norm. But this looks like a good stock. However, I don't think I'm not sure that a slight economic downturn is going to help them. It might help them a little bit, but I don't know if it's going to help them enough to change the investment thesis of the company or any other grocer, really.
Yeah, that's a tough business.
And also it's a lot of the other general retailers have taken it over. I buy a lot of my groceries at Costco now, and Walmart too is a major player in this industry, even though groceries aren't their largest source of profit by any means. So yeah, there's not that many standalone national grocery chains anymore. They did stop the merger between Kroger and Albertson. So I guess we have two national chains that are pure grocery stores, and then we have regional chains like Publix in the Southeast or HEB in Texas that are competing. But there's just so many options for groceries that it's like not a business that really interests me unless I'm just looking for a dividend, and that there happens to be a downturn in the stock that takes the dividend yield to a decent level. Then maybe I'm interested, but I'm personally more of a growth-oriented investor, so I'm not sure I would want one of these stocks unless, like I said, I was looking for some income.
Yeah. We have a couple of questions on Tesla here. Will, do you have any thoughts on Tesla? Mel asked about an hour ago. What's your thoughts on Tesla? And then Brendan Johnson asked thoughts on Tesla and Archer. Do you have any thoughts on Tesla?
Well, it's come up a lot. I think it's a little bit overvalued in the near term. I'm still kind of optimistic about it, longer term, but it has pulled back pretty significantly in, especially this year. So you're looking at the financial metrics, or the valuation metrics rather. PE ratio 133, forward PE 95. That's higher than it has been, even though this has traditionally been a fairly expensive company. But plus you have Elon Musk, who's managing 5 or 6 different companies and Doge. So yeah, you kind of have to. Yeah, I don't. I mean, who knows how this affects Tesla long term? But that does make me a little bit leery of the stock, just because the company's leader his attention is so divided. But I'm still kind of optimistic about the autonomous driving platform longer term. I think that could be the main source of income or revenue rather a few years from now. But for now, I think it's mostly driven by car sales. I think, and they've come down a bit, haven't they? I haven't looked at the financials for this quarter.
Yeah, Tesla's down like 30% over the past month.
Yeah.
That's a lot, right? Now, this is a recent thing, right? We're still up 44% on the year.
Yeah.
From Tesla. So I don't know, right? When you've got a company that is, and so can I do math? Well, it's clearly before, 11 months ago, it was clearly up a lot more than 44%, right? So down 30% in the past month, and still, despite that, up 45% over the past year. I think a lot of this, guys, we are cautious about talking politics on the show, but why might Tesla have driven up very, very quickly earlier or late last year and then be down in the past month? There was probably a lot of speculation, Will, about Elon Musk being and his connection to the administration being good news for Tesla, right, going forward. And then now there's a lot of talk about dissatisfaction with Elon Musk and what he's doing in the administration. And then Tesla stock is down 30%. I think, guys, a lot of this is Tesla is a proxy for the general impressions about what Elon Musk is doing right now on any given day, and less a function of the actual business of making and selling automobiles and solar panels and batteries, right?
Yeah.
That just is what it is, right? The stock has a pretty decent disconnect from the business, and it's connected to Elon Musk and the world's feelings about him. And that's unfortunate, but there's no way around that. And I think if you're going to invest in the company, you just got to know and accept that. That's just how it's going to trade. And we can work ourselves around in circles trying to value this from the fundamental level, but the reality is that's just not how the stock moves right now.
Yeah, I think. Yeah, I agree. I think there's a lot of politics or worries about politics anyway, driving the short-term performance of the stock. So
and sometimes this happens with a lot of companies. Sometimes the stock just moves. Look at AMC a couple years ago. Look at GameStop. Sometimes stock just move around and they have zero to do with the actual health of the business.
Yeah,
just the way it works for whatever moment in time. And if you're on the right side of those movements, enjoy it. If those movements get ridiculous in one way or another, maybe make a trade that takes advantage of that, right? If that's your approach.
But yeah, I wouldn't underestimate the influence of that significant run up Tesla had. That
yeah,
took valuation
when
to
you
a
go
very
up
high
that
level.
much in a year, it's easy to come down pretty hard too. So I think,
especially with the political, when you mix that in with the political concerns, that could, at least in the short term, have a negative effect. So
so that's just kind of that's just the way it is right now, right? And in terms of the business, the reality right now is Tesla is one of the few companies actually making money selling electric cars.
Yeah.
I'd rather be Tesla than Rivian. It's not even close.
True.
Right? I mean, the other one is BYD, which is doing makes money selling electric vehicles and does quite well at it. But Tesla is still making money. They're doing better than traditional automakers in terms of selling electric vehicles, right? Or vehicles in general. You kind of want to look at it that way in terms of their profit. So the business is pretty good. Whether that actually supports the valuation is a whole nother conversation, right?
Yeah.
But I honestly don't have a ton of concern, Will, about their business of selling cars because they do it very well.
I think the political concerns will pass over time. I think that's a fairly short term concern. But yeah, right now it probably is affecting the stock some. So we have about 3 minutes left. I wanted to get to Vihan's question to me before we ended the hour. So, Will, when approaching dividend stocks in Roth, position size should be relatively larger versus growth stocks for outsized returns in the long term. I think we're kind of getting into personalized advice when I go into this question. So I want to be a little bit careful. I think that the allocation of growth versus dividend stocks probably depends on age, especially if you have more than 10 years before you're going to take that Roth money. I would probably orient more towards growth stocks, but as I start to approach retirement, maybe you look at switching to dividend stocks a little bit more and switching a lot more to dividend stocks when you're actually retired. But I think this just kind of just depends on where you are really in your investing journey. That's how I would look at it myself.
Right. All right. So there was a question to me. I'm sorry, I don't know the full answer to this. I want to look at this and come back to it. From No Noise, thoughts on Capri and the potential of sale of its Versace division and other assets to Prada or other luxury good companies. So I'm looking at that. Didn't Capri used to be Michael Kors, right? And so they changed the names and acquired some other brands, and it's now kind of a luxury goods owner. They own Versace, Jimmy Choo, Michael Kors, right? It falls under there. Now I thought they were doing a deal with Tapestry was going to acquire Capri, but I don't know what the status of that is. I kind of lost track of that. Let me see if I can figure that out real quick. We got a minute here. because that was announced like a couple years ago. Will, I think it was 2023. Let's see here. Did that die? No, it's terminated, right? Okay, so that died. So that was announced in 2023. That has been terminated. Okay, so that's what happened. That fell apart because the FTC blocked it, right? So that agreement was terminated at the end of last year. And now that's why they're trying to sell. Okay, so I haven't been following this too closely, no noise, but that's why they're trying to potentially selling the Versace brand because that acquisition did not happen. Prada in negotiation. So that could, it's like about a $1.6 billion deal. If that were to happen, is the rumor. There's no announcement yet there. I don't know. I don't know, no noise. I need to look at this a little bit more. I suspect if that happens, I don't know what's going to happen with the rest of Capri. I feel like if they sell Versace, they've got Michael Kors and Jimmy Choo, and they're probably then themselves an acquisition target again, but maybe less of one, or you have an easier time getting through because the Versace brand is somewhere else, or maybe there's a split. I don't know. I just don't know how that goes long term. Will with because that was an unfortunate termination of that deal. That could have been a nice conglomerate. I feel like in this market, no noise, it's going to be a little bit hard for them to kind of compete long term with only those two brands. So they're going to have to do something else, either acquire other things themselves or kind of be split or merge those two brands with another company. I just don't think they can go it alone in that market with only what they would have if they sold Versace. So I don't have a buy, sell, hold opinion like that on it right now. I haven't looked at it too closely, but maybe in the next month or so we'll have some more news on what's happening with the Versace sale if it does go through to product.
Yeah,
So
with
thank
that,
you for
we're
the
looks
question
like
there.
it looks like we're about a little past at the top of the hour. So yeah, here we go. Here's Danny and Neil. So
Yeah, we got Danny and Neil coming in for the next hour here. Thank you guys. This was fun. Thanks for the questions. We looked at a lot of companies that reported. Had fun with this, Will.
Yes.
This hour. So we'll see you guys next time, and we turn it over to Danny and Neil.
Cool on.
Well, thanks, Toby. Thanks, Will. Thanks for
guys.
a great hour. Well, welcome, fellow fools. We're here for another hour of Fool24. I am Danny Vena. I am a Hawaiian shirt enthusiast and Fool contributor. As many of you know, my areas of speciality are tech. I do a little bit of consumer goods, a little bit of semiconductors, a little of this, a little of that. And I am joined by what I am told is a couch investor. Neil, welcome.
Thank you, Danny. Thank you. How are you?
I am doing well. This is actually our first time appearing together.
Yeah,
I am
that's
looking
true.
forward to it.
Same here. Same here. I've been reading your pieces actually for many years, so it's an honor to be here as your co-host.
Well, thank you. I thought maybe we would just focus on tech and semis for the hour. There's always a lot of stuff going on in the tech space, so there's always something to talk about. The two things that have come across my radar that I found the most intriguing, one of which was the recent introduction of Alexa Plus by Amazon, ticker AMZN. We know Amazon has had its line of Echo devices and companion devices for many years. They're a novelty item in homes across the United States and across the world. And it seems like, there was kind of a rut there. I know one of my relatives has one. They used it for the same things over and over again. They would ask about the weather. They would use it to compose a shopping list. They would use it to play music and to set timers or alarms. And that was pretty much the extent of it. But with the new Alexa Plus, apparently it has some features, let's say, that some people are finding pretty compelling. I read a couple of reviews online. One of them said that they originally weren't a fan of the new Echo show and the Echo devices, but Alexa Plus changed their mind. And the fact that the show has a display, which makes it a little bit higher end than some of its Echo colleagues, as it were. But what's really cool about this is that the new Alexa Plus is Alexa on steroids. Alexa with the added features that are brought to it by generative AI. Now, I hadn't done a lot of research on it, but what I did do, Alexa Plus, it helps with doing media searches, pulling up documentation on your home. It has feeds for your home security devices. It can help book reservations, order taxis or ride sharing, and it can even order tickets for you from third-party services. So I guess the biggest thing here is it's more like an agentic AI for the home, and I thought that was a pretty interesting development. I'm curious to see what you think about it, Neil.
Yeah, no, I agree. I don't have Alexa at home, although I have one device, but it's quite outdated. I am fully an Android Google type of person, but I've seen the announcement from Andy Jassy as well, and I think if you're a Prime member, it's free. If not, it's $19.99 per month, I believe, which again just goes to show the value that you're getting from the Prime membership. It's always getting more and more. And to be honest, 2025 to me is the year where we are going to see more of those chatbots being more personalized, more designed for you, I would say. And this, I think, is what Alexa Plus is going to be. It's in your home. It talks with you like more of a human. It knows all the devices that you have. Of course, they are connected to the same system. So it should be making your life way easier. And I think since ChatGPT came out, we've all been wondering, okay, when are we going to get into a monetization stage of all this generative AI product, software, and all of that? When is this going to make my life much, much easier? And I think with these types of products, I think we're getting closer and closer for sure.
Yeah, when I saw the announcement, I did go back and look at Amazon's well, not so much a press release as a page that kind of lists out the features for you, and what it talks about is how this new upgrade to Alexa, it remembers the preferences of the individual users. You can have a number of users in a household, and so it remembers, for example, what your specific preferences are in music compared to other members of your household, or favorite television shows, or what recipes you found intriguing, and what of the when you order from food delivery, what your favorite food delivery is, or different places that you order from. So, if you come out and you say, well, Alexa, I want to order some food, it'll go back and suggest places that you have ordered from before. And it might, spur something and you go, oh, that's right, I haven't ordered from there for a while. I might want to have that. So I think it actually is kind of the next step in the evolution of generative AI, which, primarily we have seen making workplaces more productive, care of like Microsoft's suite of Copilot tools and things of that nature. But, something that makes it easier for folks in their home, I think it could attract some attention.
Yeah, no, I agree. More personalization, and I think it fits the Amazon ecosystem as well, because if it remembers what you ordered, what you liked, then the next time you want to order something, or you're saying, oh, I ran out of XYZ, okay, maybe Alexa Plus will tell you, do you want me to order that again? You just have to say yes, and then the next day the package is arriving. And I think that's also something Google's Alphabet CEO Sundar Pichai said, I think a couple of months ago. He said that 2025 is the year where memory is going to become more and more important, because I think people were quite tired of always having to repeat the same thing again and again. I think in 2025 we're going to see that memory aspect, well, grow and grow. Something that you talk to a Gen AI, an agent, and it remembers. It remembers what you like, what you don't like, what you said a couple of days ago in another conversation. And I think that's key to a key stepping stone towards the future of whatever this is going to be in the end. I think you're muted.
I've been doing so good about not doing that. So, it was about time for me to embarrass myself. Helps keep me humble. One of the things that I think is intriguing is, in preparation for this, I went and I looked at my phone, and what apps on my phone I tend to use the most often. And it's interesting because I'm always checking the same things routinely. I check the front page of Fool.com to see which stories are trending. I check my email to see, whether or not there's any new emails. I'll check Slack to see, what kind of messages are on Slack from work. I might, check Facebook to see if there's any new posts from my relatives. And what's interesting is that I noticed over the past couple of years, when I get up and go walk the dog first thing in the morning, I will ask Siri on my phone, which is Apple's version of an AI digital assistant, to read me my emails rather than looking through them, or tell me what the temperature is in the morning before I head out the door, so I know whether or not I need to just throw on a hoodie, or if I need to grab my gloves. So, there's a lot of utility there, but also I think up until this point, it's been pretty routine. There's certain things that, we tend to do over and over again. And, perhaps we find those, a way for this AI to be helpful. But I think that the number of things that we can use to make our lives easier through AI is probably going to expand in the coming years. I think Alexa Plus is probably just the beginning of that. I'm curious to see what Apple is going to bring to the table as it continues to expand its AI. So that's pretty interesting to me. Although I think this is something that's going to play out over the next decade rather than the next 5 minutes.
I agree. I think I've seen a report that said that Apple is pushing out a new Siri until 2027 or something like that, which is a bit of a shame because, right now in this age of AI, I think a lot of players are moving extremely quickly. So for Apple to maybe wait until 2027 to see a more intelligent, let's say, Siri is a bit strange. But I think for Amazon specifically, since Amazon is also quite a big player in the robotics segment, I think having the software side of things, the, let's say, Alexa Plus side of things, being quite good already right now, would definitely help them in the future if they want to release small robots for your home, maybe also a humanoid robot. Who knows? I think we're going to see many companies come out with their own version of that. So yeah, it's going to be quite an interesting couple of years, I would say.
I completely agree. So the other thing that came across my radar, excuse me, over the past several weeks, we've had kind of a downdraft in AI related stocks, and two of the ones that I follow the most closely are NVIDIA and Palantir. And just looking at, after the market closed today, NVIDIA stock is now down about 23%. and Palantir stock is down about 32%. And we had a question a couple of hours ago from a viewer who wanted to know whether or not these stocks have gotten to the point where their valuations are intriguing enough. And so I went and took a look. And the two valuation metrics that I tend to use most often are the forward price to earnings ratio and the PEG ratio, price to earnings growth, which we dropped in the queue a while back. And I was just looking. So for NVIDIA, currently, NVIDIA has a PE ratio, a forward PE ratio of about 26. And I think that is actually pretty intriguing because it's getting towards the low point that it's been on and off of the past couple of years. That's pretty intriguing for NVIDIA. And its price to earnings growth ratio is down to 0.27 when anything less than 1 is indicative of an undervalued stock. So NVIDIA is certainly on my radar at this point. Now, I should say that it's likely that I will not be adding to those because I likely won't be adding to NVIDIA because NVIDIA is currently my second largest position behind just Netflix. And I've had Netflix since 2007, so it's had plenty of time to grow. Now, Palantir is a little bit different in that I have a position in Palantir, but I certainly wouldn't be averse to adding to it. However, this is one of those cases where, Palantir has a current PE ratio of, let's see, 444. It has a forward PE ratio of 151, so still a little on the pricey side. But I was looking at its PEG ratio just to see because it's growing like a weed. Now its trailing 12-month PEG ratio is 4. So that's still a little bit on the pricey side, but on a forward basis, that number has ticked down to less than 1. It's at a 0.78. So I definitely think that at this point, for me, Palantir is still a little bit expensive, but it's certainly starting to get to, that point where it's a little bit more intriguing, particularly since the fact that the stock has, fallen now by about a third. Now, I'm going to blow my own horn here. I did say several weeks back that I thought that Palantir stock was going to fall at some point over the coming year, and it could fall as much as 50%. Now, we haven't got to the 50% yet, but we've certainly got to 33%. So, again, it's one that I will be watching closely because it's certainly starting to get intriguing in my estimation of things. I didn't know what you think about those, Neil.
No, I currently do not own any of those companies. I did own Palantir for a long time. And I agree. Even with the pullback, I think it's still relatively expensive, all things considered. I would love for your prediction to work out. If it did drop overall 50% from the highs, I think that would be lovely for me. It would open up a great opportunity to add there. NVIDIA is certainly a lot more attractive at these prices right now. I thought the earnings were quite good, guidance as well, and yet the stock reacted negatively, maybe more on the macro sentiment rather than a company doing badly. But yeah, currently looking at the prices, plenty of semi stocks, in my opinion, are, in my eyes, fairly priced, whether you look at an AMD or an NVIDIA or the equipment makers, the ASMLs, the Lam Research, and all of that. I think, in my eyes, there are quite a lot of opportunities because most of them have taken a hit already, quite big hits compared to where the market is at right now. So definitely opportunities out there. Would love to get Palantir at around $60 or so. With NVIDIA, I mean, It's already a huge company, all in all. So for me to open a position in a company that's almost worth, again, $3 trillion, I'd have to make up some room for a lot of cash.
Fair enough. So, fools, if you have any questions, please get it in the queue. It's Slido, sli.do, and enter the code Fool24. Get us your questions. We'll answer your questions about tech or semis, or ask us whatever you want. We won't promise that we'll get to every question, but we'll certainly get to the ones that we feel qualified to answer and have the time for. I have one from Jimbo has a question from a couple hours ago, and it said, is it the start of the fall a la 2001, 2002, or is it more temporary as tariffs impact gets settled? The economy is cooling, and what will hit next? This is kind of the argument that a lot of market commentators are having with themselves and each other. I think it's a little different situation now than it was in 2021 because actually inflation is improving rather than getting worse. And as you recall, going back in late 2021 was when we started to see inflation kick up. And it took months to get there, but then we got very quickly to record high inflation, or records for, like a 20 or 25-year period. So it was certainly, you could see that the economy was devolving very quickly. Things were getting worse. And, whenever the economy starts to tank like that, it becomes a self-fulfilling prophecy. In that you had the stock market was, the stock market was at that time in mid-November. Tech stocks were near all-time highs. We had a situation where inflation was starting to get worse. We had odd issues with, businesses beginning to step back and kind of regroup in preparation for the economy turning down. And whenever that happens, when businesses slow their spending because they're, shoring up for a bad situation, it really only accelerates the inevitable. So we saw that over a period of months. Now, tariffs is a situation that, we have known were coming. It's something that has been telegraphed by the Trump administration for months, and maybe even longer, before the election even. And so I would say, I think we've known it is coming. The fact that it has come in several waves, and basically ratcheting up the potential tariffs, I think has caught market commentators off guard. I think investors are getting a little nervous. Wall Street hates uncertainty. And so I think some investors are beginning to, take some profits, build out their cash positions because, things are getting uncertain. As far as the economy cooling, I don't think it's necessarily that the economy is cooling. It's actually that inflation is revving up again. And that's the sign of an overheated economy. We saw that with the core spending, or the core inflation last month, in that, some of the most important items that people spend money on are getting more expensive. And as that happens, consumers get nervous, and then they tend to slow their spending. And while the economy has been very resilient for the past few years, I would not be surprised if at some point over the next year or so, we didn't see a full-on market correction, where we see the major market indexes fall by about 10%. And that's not a bad thing. I know that, seeing the value of my portfolio fall like that, it's certainly not a good feeling. And since my portfolio is more volatile than the broader market, if the broader market falls by 10%, my portfolio will fall between 15 and 20%. That's just the nature of the beast. But I think if we see a reset in expectations, I don't think that's a bad thing. A market downturn or a correction is, just part of the cost of admission when you're an investor. And so I think if that happens, I think it will be okay. I think we would probably see a fairly quick rebound. But again, we don't know what's going on in the political, geopolitical arena, in the broader economic arena. And so a lot of unknowns out there. And so there's nothing for certain at this point.
Yeah, no, I agree. It's funny because I had this conversation with another fool today, Jose Najarro. We talked a little bit about the comparison 2021 to today. And to be honest, today I am more comfortable being in the market than in 2021, of course, in hindsight, because I think today, valuation-wise, if you look at big tech, if you look at a lot of popular companies, let's say, they are far, far away from the super high valuations that we've seen back in 2021, the peak there. Although the markets right now were pretty close to all-time highs, I think a lot of the popular companies and also some non-popular companies are not trading at super high valuations, all things considered. Plus, then if you look at some macro things, unemployment rate still well below 5%. We're close to a full employment economy. It's true that inflation, there are some times that it is picking back up here and there, but all in all, I think today we're in a much better place than in 2021, 2022. That doesn't mean that we shouldn't be seeing or we couldn't be seeing a small pullback like we're seeing right now, because like you said, the markets hate uncertainties. And that's what we're having right now. Tariffs, yes or no, we know these were coming, and yet the market is still surprised by the fact that these things are happening. But I think Warren Buffett said it best, volatility should be your friend, something like that, along those lines. And yeah, as long-term investors, we like to look at companies that are suddenly cheaper, right? It's like when you go to a mall or a store and you look at your favorite sneakers and they're like 20% off, you're like, not bad. I'll take that deal. I think the same could be said with good companies. If your company is trading suddenly at 20% less, I'm not going to complain.
I certainly think that, I've been looking for some good deals. And what I have talked about is, many of the companies that are currently on sale right now, several of them are among my largest holdings. And so, they've gotten to the point where I would not necessarily, add to them at this point in my investing journey, simply because, they are already so much of my portfolio that it's not necessary really for me to add to them. And NVIDIA is a great example. Last time I looked, I'll say that it was roughly about 10% of my overall holdings. And so, when it gets to that point and the stock is already down a bit, I don't think there's any need for me to add to it because it's already such a large part of my holdings. It's certainly not, worth me adding to it because I don't need it to be a bigger part of my portfolio. Now, there are a few stocks that, we talked about earlier today when I was on with Travis. There are some stocks that are smaller parts of my portfolio that I'm beginning to find intriguing. Two of them that we mentioned. The first one is Alphabet. Alphabet is currently selling for just a really cheap valuation. And yet this is for a company that is, a leader in digital advertising, leader in search, one of the big three cloud computing companies. And it only takes a small adjustment to the company's algorithms for it to improve its search, which in turn improves its digital advertising, makes its targeted advertising more effective, and makes it more valuable, and brings in more money and adds more profit to the bottom line. So, I'm beginning to get very intrigued by Alphabet, and I am not concerned by the fact that Alphabet, is awaiting the decision from a judge about the lawsuit that was brought by the Justice Department, which found Alphabet, or more specifically Google, guilty of monopolistic practices. And we don't know exactly how that's going to play out. The worst case scenario is the company gets broken up, but even then, I believe we'd have three more valuable companies, or a few more valuable companies than just one. So I think that's intriguing. Do you have any thoughts about the tariff situation or the economy before we move on, Neil?
No, I think the tariffs, I think it's up and down, up and down. Like some days we're talking about it, then the next day it's implemented, and then maybe the next day it's already changing. So these things are moving topics all the time. I rather just look at companies and management, what they're saying. And with Alphabet, I actually agree. I also own Alphabet, and I think right now forward P of under 20 for such a quality business is in my opinion a no-brainer, a gift from the market for me, because like you said, leader in search, advertising, one of the big cloud players. You got YouTube, which quite a big and popular platform that is growing, and then you have a bet that Waymo becomes a huge player in autonomous vehicles. I believe last week, they announced that they reach over 200,000 paid trips per week, and that's a 20x increase in the last 2 years. So things are moving in the right direction. It's true that there are some uncertainties around Chrome, whether or not they'll have to sell it off. Me as a user, I hope that doesn't happen, because I want to get the best experience. And the best experience is given by Google itself. I don't know what other company can control a company like Chrome and can protect my passwords and all of that. So I really hope it stays with Google. I think they'll win that case, but that's just me with my predictions. But yeah, all in all, there are. I mean, Alphabet is definitely one that I've been looking to add more recently. And another one is an AMD, is another semiconductor player. In the last year, this stock has gone down 50% or so. It went from around $200 and something, the next NVIDIA, to now at $100. People say it's the next Intel, so it's a joke going around. To me, when I see sentiment, when a good company has bad sentiment, to me, it's like, okay, maybe it might be time to do some digging. And I liked what I saw a couple of weeks back. I like what I saw. Lisa Su, great CEO, great management team, and I think things are rolling in the correct direction. If the market wants to give me gifts each and every week, I'll take them.
Fair enough. So do you see any questions in there, Neil?
Let me check.
While you're looking, I'll go ahead and answer this question from Vihan about 8 minutes ago. Palantir, considering the volatility, would you be comfortable building a position in a Roth with limited capital versus a taxable or unlimited capital? What are your thoughts on volatile stocks in a Roth? Well, I can tell you what I did with my Roth. And what I did was when I rolled over this Roth, I took all of the most volatile stocks that I could find, the ones that I thought had the most potential for explosive growth, and I put them into a Roth. And the reason that I did that is because, it will only take one or two of those stocks, to become multi-baggers for that to become a very profitable proposition for me. Now, I'm really intrigued by Well, of course, the one stock that is at my largest holding in my now Roth is NVIDIA. I put that in there several years ago, back in, I think it was 2018, when the stock was much more reasonably priced than it is now. But I also thought that there was a potential for, very good gains, and that turned out to be correct. I have several other potential high growth stocks in there. And the reason for having a Roth is so that you can have tax-free returns. And by that same token, you want those tax-free returns. Obviously you don't want to put something like, I don't know, a dividend stocks in there, for example, because they're usually very steady gainers, very slow, very measured increases. Whereas, excuse me, if you put a stock in there like an NVIDIA or a Palantir, and then you see 8 times returns in several years, I think that can be a very solid way to approach a Roth, at least for me. I don't know if you have any thoughts on that, Neil.
Well, I don't have a Roth since I'm not in the United States, so can't really add too much value to that. I would have loved to have something like that, but unfortunately I do not. But in the meantime, I have no capital gains taxes, so at least there is that. I did find a question from, I think, your previous stream with Travis, from Travis Be Humble 3 hours ago. Uber and Waymo's announcement today. Care to share how this coincides with your Lyft thesis? So I happen to know what the thesis is from Travis, because I also looked at Lyft. I own Uber and I own Alphabet as well. So Waymo, they launched with Uber in Austin. And with Lyft, I think, going back to their last earnings report, investor day, and earnings call, I don't think this changes much from a Lyft standpoint, since they knew this was coming. They've made their own announcements with Mobileye, with May Mobility as well. I think Lyft is also positioning themselves as one of the players, as one of the platforms in that future where you have multiple AV players in the United States, especially because Uber is more of a worldwide play. Lyft at the moment is more of a United States play. And I think so far they're doing the right things. That they've laid out their goals for 2027, free cash flow being quite close to $1 billion. I mean, looking at the stock price right now, it's really not that expensive. It's true that if you want to look at one of those players, like, I could either go with Uber, which is the leader by far, or I could go with a Lyft, which stock-wise, price-wise, in my eyes, there is a disconnect with the value that you're getting. But after that Waymo and Uber announcement, I don't think anything should change from someone's thesis, because this is a known thing. But it's a forever evolving environment, the autonomous vehicle segment in the United States, especially with Uber, with Waymo, with Tesla, with Lyft and Mobileye, and many, many other players. Actually, I made a list a couple of weeks ago of how many players. And to be honest, each and every week I found out that there are more and more players. Of course, a lot of them might not succeed, but I don't think this is going to be a winner takes it all type of market. And platforms like Uber and Lyft could definitely benefit from various players, because the more players, the better it will be for them. Could also expand their total addressable market. So maybe take rate comes down a little bit, but they'll make it up through volume. I don't know if you follow one of those companies. We would love to hear what do you think.
I don't. I looked at both. Well, I follow Alphabet, of course, and I'm always intrigued when they send out another press release on what Waymo is doing. I looked at both Uber and Lyft when they were doing their IPO. I saw the debt levels and the valuation and some of the internal strife that was going on. and I decided to steer clear. And it turns out that maybe I should have checked back in, but I didn't. So I had a question from Ed a number of hours ago. If NVIDIA is not a buy at these levels, then you can't trust any of the analysts that follow and report on them. So I wanted to address this because, well, first of all, whenever I make a decision to buy a stock, I generally make that on my own, or I follow, Motley Fool's analysis. So I'm not sure if you're talking about Motley Fool analysts or if you're talking about Wall Street analysts, but I can potentially address both. If I start by saying I am not a Motley Fool analyst, I do not work on any of the teams, so I don't make stock buying decisions for rule breakers or stock advisor or any of the paid services. That said, if I go look and see what Wall Street thinks about NVIDIA, what I see is that there are 63 analysts that cover the stock, and of those, 58 have it either as a buy or a strong buy, and the rest listed as a hold, probably for valuation concerns. But you have to recall that not too long ago, there were a lot of Wall Street analysts saying that NVIDIA stock was expensive. And that was until they put up 5 consecutive quarters of triple-digit year-over-year growth. And then, another quarter of 90+% growth, and another quarter, I don't even remember what the most recent quarter was. But, this is a case where, this is a stock that is a company that is growing like a weed, and, has put up growth numbers that are, really enviable by any stretch of the imagination. I just pulled up the press release, and the quarter that they just announced on the 26th of February, revenue grew by 78% year over year. So, I mean, that's the kind of thing that I can't see how anybody could fault NVIDIA for its growth. Now, if you're talking about Wall Street, it looks like most of the people on Wall Street that follow the company say it's a buy or a strong buy at these levels. If you're talking about the Motley Fool, and again, I can't speak directly for them. However, I think we need to look at the fact that the Motley Fool has a number of different services. Each of those services has different requirements for the stocks that they choose. They have different end games. They have different goals that they're trying to achieve. And so I think it really depends on what the goals are of the portfolio, what kind of stocks that they are loading it with, what the this kind of goes back to individual investors and the different criteria that they are having to meet. Where are you at in your investing journey? And are you risk averse, or are you more are you okay with having risky stocks in your portfolio, or are you cautious? Are you looking more for ultra growth stocks, or are you looking more for maybe conservative dividend payers? And so I think that when the analysts for the Motley Fool services are looking at all of the criteria, then what they're looking for is what stock best meets, or what company best meets those criteria in a given time period in a particular situation. So I don't think that you can make a blanket statement that says if NVIDIA is not a buy, then you can't trust any of the analysts. So, again, If you're looking at Wall Street, it seems like most of the analysts on Wall Street rated a buy. There's only maybe half a dozen, not even that. There are 5 that say it's a hold, and the rest it's a buy or strong buy. And as far as the Motley Fool has a long track record of not only buying quality companies, but buying them multiple times over the years. So I think this is a situation where it's probably best to look at the totality of the circumstances and kind of reserve judgment. Neil?
No, I agree. I mean, with NVIDIA, like me personally, for example, I look at NVIDIA, great company. I do not own them at the moment, but that doesn't mean I have to buy them either, because it's all about what I want in my portfolio right now. Plus, I already have exposure to the AI team, the AI sector. So whether I pick NVIDIA or I pick another semiconductor or another big tech company, to me, I don't need that extra exposure at the moment. Of course, if it drops more and then the value that I'm getting from adding NVIDIA to my portfolio becomes too big, then I won't ignore that. But at today's prices, even after the dip, it still is a gigantic company, a great company nonetheless, but I don't feel like I need to have it. Just like I don't feel like I need to have a Microsoft or any other company in my portfolio. Currently, it doesn't fit my needs of the portfolio, and I think many investors could probably say the same thing about whatever company that they follow. Great companies, but you don't own them, and that's fine. You don't have, like, it's not like a Pokemon game. You can't catch them all.
So I saw an interesting question in the queue from Ed. This is actually from a day ago, but I thought, maybe it's worth taking a look at. How would you rank Arista Networks, ticker ANET, Datadog, ticker DDOG, Cloudflare, ticker NET, and Palo Alto Networks, ticker PANW? I think this is interesting because while there's a little bit of overlap in what these companies do, they're not necessarily direct competitors. So I wanted to start off with, maybe just giving a brief description of what each one of these companies does, because I think that kind of helps with this analysis. Arista Networks helps with data center solutions, and they, let's see. So we've got Arista Networks. We have, I'm going to go ahead and plug these into my Y charts while we're talking here, just so I can get a better idea. Now, Datadog, ticker DDOG, they offer solutions that help to ensure that your customer facing websites and systems stay online. And if there's some kind of a critical fault that would bring your website down, for an example, your IT department would get a notification before that happens saying there's a problem here, and so that problem can be addressed before it becomes critical. Cloudflare is another cloud-based service provider, and they handle software as a service. They have APIs for security. I think the biggest thing that they do is offer, let's see here. Cloud-based security solutions for a range of platforms. And then finally, let's see, my last one here.
Is Palo Alto.
Palo Alto Networks. And they're just, straight up cybersecurity, and have been for a number of years. What's interesting about this kind of eclectic group of companies is that there's a little bit of overlap, but when you look at them, there's also, a lot of difference in terms of, say, market caps and the markets that they serve. So I'm going to run back here real quick so I can get a look at the market caps. So let's start with, I'm going to plug these in here, Arista Networks and Datadog and Palo Alto Networks and Cloudflare. So just in terms of, the sizes of these, because I think that also helps, kind of inform this little analysis. You've got, let's see, the largest of the group is Palo Alto Networks that has a market cap of 122 billion. Arista Networks is about 107 billion. But then you drop down quite a bit when you have Cloudflare that has a market cap of about 49 billion and Datadog, which has a market cap of about 40 billion. And the reason that I think that that's worth noting is, if you're constructing your portfolio based on factors like market cap, that's something that you want to take into consideration. But also, these smaller companies that are growing faster generally tend to have higher valuations. And so that might be something that, you might want to consider if you're making a decision on, which of these companies you might want to add to your portfolio. Now, what's interesting is if I look at my preferred metric, which is forward PE ratio, Cloudflare is the most expensive by far. They have a forward PE ratio of 177. Arista Networks is the least expensive with a forward PE ratio of 34. And then Palo Alto Networks and Datadog with 57 and 68 respectively. So the only one that's even close to cheap out of that group is Arista Networks. I think if I had to rank them based on my own personal criteria, which are I'm looking for a company that has relatively fast growth, relatively dependable revenue streams, companies that have a large addressable market. And I think generally speaking, I would probably, the largest and with the most revenue is, of course, Palo Alto Networks, and the smallest is Cloudflare, which matches with their market caps. But I would say, let's see here. I think over the past few years, I think they've all done pretty well in terms of returns. Palo Alto Networks is up about 63%. Datadog 103%, Cloudflare 117, and Arista Networks 120. So they have the stock prices have all been growing remarkably well. I would say, for me, I think the one that has the most potential right now is Datadog. So I would put that at the top of my list. Now, mind you, this is during a normal economy and barring any, downturns, because then, of course, this all goes out the window. But I think, companies put a lot of value in making sure that their customer-facing systems stay up and online. There's also the issue of security, which Datadog has been increasingly, adding to its portfolio of products and services. I think the stock it's a little bit pricey, but it's one that I would be keeping an eye on to add to on any declines in the stock price. I think after that, I would probably go with Arista Networks. No, I'm going to change that. Cloudflare, then Arista Networks, and then Palo Alto Networks. and primarily because of the market opportunities that I see for these companies and the potential to, grow faster than the market from here. I don't know if you cover any of these, Neil.
I don't cover them closely, but I'm surprised you put Palo Alto last, because I would have put them after Datadog because of the cybersecurity industry and the fact that it's probably going to expand more and more. Now, I say that as someone who just looked at the CrowdStrike numbers as well. I've seen the reaction of the stock, weak guidance, so the stock is down close to 10%. But I know Palo Alto, to me, that's just my list. I think I agree with you. I think Datadog is one in that list. Then I'll probably go with Palo Alto, and after that, it's a tricky decision between Cloudflare and Arista Network, to be honest. So yeah, number one Datadog, number two for me Palo Alto. But if I were to change it a little bit and put CrowdStrike in that list, where would you put CrowdStrike, knowing that it's down now 10%, so a little bit cheaper?
I actually am I'm a CrowdStrike shareholder, and for full disclosure, Palo Alto Networks is the only one of the four that I don't own, because I own other companies, including I own Okta, ticker OKTA. I own CrowdStrike, CRWD. I own let's see. Arista Networks, ANET, and I own Cloudflare, ticker NET, as well as, of course, Datadog, ticker DDOG. And I think if you added CrowdStrike into the mix, I think CrowdStrike would be much closer to the top. I think it would probably be my number two right after Datadog, because CrowdStrike has been doing a remarkable job of expanding their cybersecurity offerings to kind of meet their customers' needs. And even though they had a very public black eye last year, when their systems went down from an update, I think the company has done really well at continuing to grow through several different market environments and economic environments. So, yeah, I think that would be my number two. What about you?
Yeah, no, I would agree. I would still put, at these prices, I would probably still put Datadog at number one, although we never know what might happen with CrowdStrike when the market opens tomorrow. But CrowdStrike definitely gets the number two spot. I was very, very surprised how quickly they could rebound after that outage last year. Very, very surprised. And it just goes to show how strong their platform is, how strong of a company that is, how important it is, despite, we could call it a public humiliation a bit. Despite all of that, they continue to perform extremely well. And I think that just goes to show how important and how strong a company really is. And comes at no surprise that this stock has recovered close to, I think, all of their losses since that outage. So yeah, pretty impressive.
Fair enough. So from the question that we answered a while ago regarding tariffs and inflation, Jimbo has a question. Who actually posed the original question? Came back and clarified. He said, there's certainly a question about inflation. And I was talking about repercussions of tariffs that could lead to an increase in inflation. So, yeah, I think, that's one of the big unknowns, because much of that will depend on whether or not these tariffs end up being long-lasting tariffs, or are they just being used as leverage and a negotiating tactic to get concessions from the parties that the tariffs are being levied on. And so, I know it's a highly politicized issue, But I would say if these tariffs stay in place in their current form, I think all of the economists and experts agree that it could, spark additional inflation, and we could go back to an inflationary environment. I am hoping, and mind you, that's all that it is, but I'm hoping that cooler heads prevail, and that eventually, there will be an agreement that is come to, and so that we don't have to, reap the long-term consequences, let us say, of the current tariff wars. That's just my 2 cents, Neil.
Yeah, no, I agree. I think right now we can just make predictions and see actually what happens. Like, it could lead to increase in inflation, but there are definitely other factors here that could also balance the scales. But yeah, I agree, and I've said it from the start. I think this is a negotiation tactic. I think this is to bring players to the table and start discussing a way forward. We'll see what happens. Every great legendary investor will tell you that he has spent not that much time discussing macro, way more time looking at specific companies. So I don't think I'm smarter than any of these legendary investors. So I will keep focusing on the companies that I own. The macro will do whatever it will do, and we'll see, we'll adapt accordingly.
I absolutely agree. And with that, we are at the top of the hour. And so our first session together, Neil, it went off without a hitch. And so very pleased to have made your digital acquaintance and shared the
Same
screen
here.
with you. And I think here any moment now we're going to be joined by our friends Will Healy and Brian Orelli. Guys, how's it going?
Doing well. How are you, Danny?
You know what? This is my last show of the day, and my dog is ready to go for a walk.
Sounds like a great plan.
All right, guys.
Fool on,
Have a
guys.
good one.
Well, welcome to the next hour of Fool24. I'm joined today by Brian